What you're seeing right now is the result of over a year and a half and hundreds of videos about personal finance and investing on this YouTube channel, which has grown to over 1 million subscribers. So what my team and I have done is we've gone through all the videos on this channel and picked out 15 videos which in order are going to relate to you, the basics that really matter and actually impact your financial future, specifically on the subjects of your career, personal finance, investing, economic, and credit. So you could think of this like a course. It is nearly 8 hours of content. And I recommend that you listen to this audio only. So just go about your day, plug this in, and if you do a few hours a day over 3-4 days, again, you're going to be in a much better position looking forward financially. So what I'm going to do right now is walk through the structure and the organization of the video. You're always free to use the chapters below the video. And after that, we'll actually get into the content. Now, what I want to say before I go into the structure is that there is no golden egg here. There is no hack, there is no piece of information where if you learn it, you can go and money is going to grow on trees for you. That's just not how finance, personal finance, investing, your career, that's not how any of it works. Instead, much more often, it's a matter of knowing the basics and going through the motions of those basics day in, day out, and compounding that over a long period of time. So over the next 8 hours, we're going to get into all of those basics. But again, don't expect to watch something like this and you wake up the next day and your life has completely changed. You may completely change, your ideas for the future or how you want to approach things may completely change, but reality is a lagging indicator. It's going to take some time for the world to catch up to you and the new habits, approaches, etc. that you implement. So that is how I recommend that you focus on the lessons and the frameworks and the systems in this video. Approach it from a long-term perspective first off, and second from a systems perspective. Think of building a system, a personal finance and investing, a career system in your life with rules, with goals, with do's and do nots, and then execute that system on a very long timetable over the course of years or decades. That is how you do extremely well for yourself. And that is what we're going to demystify and go over very thoroughly over the next 8 hours. That said, there are 5 big sections to this video. Now, the first is your career. So this is, okay, you have a job. Your job is going to be the main way in which you earn money for most of you. And you can also think of your own business as a job, for example. Well, how can we land you good jobs? How can you move up in those jobs faster? And how can you get the most out of those opportunities? That is everything that we're going to cover throughout the first hour or so in section 1. Now, section 2 gets more into personal finance. And okay, what is personal finance? What does that mean as a system for you? What are the different components? So shifting from your career and earning that money and earning more of it and moving up over time into, well, what should you do with that money? That is the essential question at the heart of personal finance. So that's about 1.5 hours. And then section 3 is one specific subject within personal finance, which is debt and credit, right? Which is credit and debt. That's a massive subject because everyone leverages their money, right? They use a mortgage to buy a house, they go to school with loans. Debt runs the world is something I say pretty frequently. And so I want to understand and help you understand debt and credit in a way that actually impacts you in a positive way. Now, after that, section 4 is all about investing. And that is, well, how do I compound? How do I grow my money over time, thinking about both risk and return? So if you've never invested before, if you have no clue what any of those words mean and what type of investments are out there and how to get started, we're going to cover all of that and approach it from a conceptual, again, systemic way so you can understand these things at a root level and then build them up into a system and a way that you can actually get started right now and then execute over a very long timetable. So those are the 4 main segments. And the 5th one is economics. And the reason that I included this is because economics is kind of the mathematical nature of money. It is the theory of why markets and individuals and firms act in the ways that they do. And that's not going to be as critical for you probably in watching this, but I think it is a extremely useful perspective and will unlock new insights for you in your personal financial journey. And so I'm currently working on my 2nd degree in economics, and I recorded a video a while back that is about 1 hour long, and it breaks down basically everything at a high level that I learned in my bachelor's and my equivalent of a 4-year study of economics. And so it's not a super in-depth thing because it's only 1 hour long, but what I did do there is I expose you to everything that you could go and learn on your own time, as well as what I think are some really interesting and actual impactful points on economics. So what you can do there after watching that segment or section, which is less in depth than the other sections, is go learn on your own time. And of course, with all of these videos, I want you to pull things out that matter the most to you, that will help you the most, and then go do your own research. That said, that's the video. 5 sections. You're going to see in the little header what those sections are, and you'll also see what the actual video is. That said, I'm excited for this one. I hope you enjoy it. Let's go. But that said, there's one quick thing before we get started, and that is that this video is sponsored on behalf of MindWalk Holdings. They're also known as HYFT, and they are a publicly traded company on the NASDAQ exchange, which is actually something we're going to cover in a few hours here. And they trade under the ticker HYFT. Now, you may remember the company IPA from this video, and MindWalk is the new name of the company IPA. And speaking of new, they just reported their quarterly earnings. They had record quarterly revenue, growth was 45%, they increased their margins, and they narrowed losses. Here's the big deal with the company and what exactly it is that they're building. So drug discovery is fundamentally broken. Over 90% of drugs fail and consume a massive amount of money and talent and effort while doing so. And even with AI, traditional AI models struggle with this kind of thing because biology is just too complex for simple pattern recognition. Companies are looking for solutions, and AI can be a solution, but only if it's done right. And that is exactly where MindWalk comes in. See, what are called HYFTs, remember, which is their ticker, that's the missing link. They're a way to index biology, kind of like Google indexes the web. And this eliminates the black box problem of AI drug discovery and replaces it instead with traceable insights. And MindWalk is putting this breakthrough to work with the Lens AI platform. It is a biological intelligence system that connects 25 billion biological relationships using RAG and knowledge graphs. And basically those are AI machine learning kind of methods to help understand data. And this lets MindWalk design better drugs faster to predict toxicity and optimize therapeutics before costly lab work. And in this way, MindWalk is bridging AI with actual wet lab capabilities. And that is a huge competitive advantage in a market projected to be worth hundreds of billions. Now, there's a lot out there already about their AI pipeline, but something I really want to double click on that I think is very important on a societal level is that MindWalk is pioneering an AI designed GLP-1 program. And they're doing that with a first-in-class dual pathway regime that aids with aging and longevity. So that's all pretty cool if you ask me, and all of this means that investors should pay attention. MindWalk is delivering results with AI in a massive space with proprietary IP, patents, and real-world technology, as well as partnerships with major biotech and pharma companies. These industries need better AI-powered drug discovery, which is good for all of us, and MindWalk has the tech to make that happen. So in summary, AI isn't just enhancing drug discovery, it's completely transforming it. And MindWalk, or HYFT, is one of the only companies out there that is actually executing on AI-driven drug development, and big players are watching, and again, investors should too. That said, welcome to this behemoth of a video. I really do think it's going to be helpful, and I appreciate you being here. Let's go. Okay, these are the top 8 career rules that I've learned from working in business over the last decade of my life. And this video is for you, and you should stick around for just the next 3 minutes to change your perspective on work and career if you are under 20 years old. First, just so you trust me, I have worked at 3 businesses across the business development and sales and marketing roles. I've also been hired to work on sales initiatives and develop sales programs by over 30 businesses. And I've started 3 businesses of my own across software, print, publishing, and marketing. And finally, I have written several books on economics, business, tech, and related subjects to these. The point I want to emphasize here is that I can relate to you, as in if you are under the age of 20, just like me, I know the feeling of trying and working with people a lot older than you and getting these positions and jobs and money in environments that you just have very little exposure to or have had very little exposure to prior. That can be intimidating in a lot of ways, and I personally have also messed up and just cost myself an enormous amount of time and stress and anxiety and money by just going about things the wrong way and by forgetting the 8 lessons that I'm going to share with you in this video. And that all starts with number 1. Okay, so number 1 is that the whole machine, quote unquote, of business is really just people having conversations, emails that are sent between people, so really digital conversations, and then contracts. As in, if you take the US government or Apple or anything, any organization or business smaller than that, it just breaks down into people, emails, and contracts. And that means there is no intimidating matrix in the business world where things just happen, and that you as a young person really can do that exact same set of things. It just comes down to knowing and interacting with the right people. And what that means is things are a lot more flexible than you think if you do, again, just know the right people and you do interact with them in the right way. Okay, now number 2 is that if your role or your job isn't exceptional, for example, if you're not a general manager making $300,000 a year when you're 20, then the amount of effort you would have to put in to get that amount of status, money, role, or just the amount of enjoyment you get from that job at a different job is relatively minimal. Now, what that means is that if you don't like the role you're at, just leave. For example, if you don't like your job, but you make $1 million a year from it and you're 21, then that's one conversation. But there is zero reason that you shouldn't leave your job if you don't like it and you make, say, $60,000 or $70,000 a year at, say, 24. Okay, number 3 is that having contextual and cross-domain knowledge will rapidly increase your value and productivity on teams. So don't just specialize at the intersection of different domains of knowledge. Okay, now number 4 is that even if you don't want to work a lot, your employers and also the people around you are primarily going to remember the few unique or exceptional things that you have. So if you're the guy that just brings up a new idea or proposes something at a weekly meeting or goes the extra mile every so often, then the relatively little effort and time that those things take are going to get massive yield there. Whether that's getting promoted faster, meeting new people, getting to work on things and in roles that you prefer, and also just having to put in less effort across the board. Okay, now number 5 is that relationships beat systems, and I kind of touched on this before, but to put it bluntly, people will go the extra mile for you and just make things happen if they like you and if you two have a relationship. For example, a very recent video of mine was how I got a $143,000 job offer when I was 18. Okay, now number 5 is a quick one that I think just helps with anxiety and stress about your performance or potential, and that is that if you just work a lot and just stay consistent and put in effort and time, then you are automatically going to beat a vast majority of people across any domain that you work in. As in, most people just either don't like their jobs or don't want to work a lot. Or to add to that, they're just bad at what they do, which you'll see a lot more as you start to work in big businesses. Okay, now number 7 is just quote unquote sharpen your sword, and that very few people actually just sit down and think about the systems, the workflows, the processes that they're accustomed to at their job. And that goes back to that quote of, sharpen the axe before you cut the tree. Like, if you can just sit for an hour and come up with one thing that will decrease the effort or the time required to do something else that you have to do for your job by 10%, then you're gonna save 100, 500, 1,000 hours for you or your team just by sitting down for that hour. And the people around you are not just crazy geniuses or smart, even if they have experience or are older than you. So question everything, question the system, and just come up with ideas and think about those ideas regarding potential improvements in anything you're doing. And before I tell you the last one, which I think is the most important, I want to tell you about Odoo. Odoo is an integrated suite of business apps that takes kind of all these different tools that you would use for your business as a business owner or an employee. So say a CRM tool over here, a website builder there, a course management tool, inventory, all these different apps, and Odoo pulls them together into one system, and it is the #1 business software in the world with over 15 million, and yes, that's 15 million users. I use them for 2 businesses of mine, and I can guarantee that they will help you save money and also just be more efficient and productive. Again, either as a business owner or if you work at a company where they could yield the benefits of just integrated and condensed tools. And you can click the link in the bio to either book a demo or just check out the website. Okay, now number 8, and I struggle to emphasize the importance of this, is just talk to interesting people. Like, trust me, you will get so much more out of just reaching out and talking to 10 interesting people, whether that's about what you want to do for your career and work, how to make more money or get promoted at your job, or if you want to figure out how to be a better employee or do better, or if you want to figure out how to grow the business or do better at your job. So I think you should just all the time be reaching out to these people. And if you do that when you're 18, 20, 25, the yield that will deliver to you, the opportunities, the doors that'll open are just absolutely just life-changing down the line. So if you're in school, go to your alumni network platform. Otherwise, just go to LinkedIn and search for people in roles that you want or doing similar things to your role. And not only is that socially useful and enjoyable, but again, in a material sense regarding your career and your work, you will be that much better off. And that's the video. I will see you in the next one.
So I made this video nearly a year ago, and to date it is the most popular video on this channel, and a lot of people seem to have resonated with it. So I've assembled my new list of 8 more frames, hacks, and practical tips for bettering your career and you within it today. I also have 4 spicy rapid fire cheat codes at the end, so make sure to stick around for that. And this is for you if you're in your teens or your 20s, and no matter whether you work at a job, you started your own business, or any combination thereof. So my name is Jon Law, and we make videos about personal finance, business, and entrepreneurship. You can watch this video to learn more about me personally, and I have nothing to sell you except this big red subscribe button. And that said, here's a rapid fire summary of the last video's 8 cheat codes. So number 1, most quote-unquote business is relationships, emails, and/or contracts. Number 2, if your career outcome is not comparatively exceptional, then regaining that outcome is not comparatively difficult, and you should thus allow yourself leniency in the amount of risk that you take and your willingness to leave that job. Number 3, specialize at the intersection of knowledge domains to avoid a lot of competition and level yourself up in your career quickly. Number 4, in a job setting, look for areas where marginal effort produces an outsized yield, and that most often takes the form of relationships or ideas. Number 5, a simple one, relationships beat systems every day of the week. Number 6, I can guarantee right now that you are capable of outperforming everyone in your ideal business or job or space just by putting in more effort, conditional upon that actually being what you want. Number 7, think deeply about the assumptions and machinery under the hood of the business that you work for, or your business. Number 8, best of all, you've heard it 1,000 times, but just talk to interesting people, and that will compound your network and your opportunities over time. That said, here are the new 8 frames for this video. And that starts by the idea of taking more risk in the domains where you have the least capital stock. And in economics, we refer to capital as generally something that has value, and stock is the amount of it that you have. So your capital stock could be the people you know, it could be the actual monetary capital or the amount of cash you have, or your skills. And there's this misconception out there that you should take less risk when you, for example, have less money. When actually, in a lot of cases, it's the opposite, where the more you have, the more you have to lose. And when you're young, one thing you do have is across the board, very low capital stocks. Maybe you've been to school and you've learned some things, maybe you haven't, or you've had some internships. But compared to where you're going to be in 10, 20, 30 years, the amount of people you know, the skills you have, and the amount of money you had is going to be comparatively very low if we think about that as a stock variable. And that's good, because in those areas where you have that lower capital stock, that's where you want to take more risk. And you have to be comfortable with that risk, because across the board, if one thing's true, it's that risk correlates with reward. And I want to dig a little deeper into that, so that ties into frame number 2. Now, before we get there, this video is all about leveling up your career and you within it. So I want to share a tool that's the best all-in-one content creation tool for consultants, solopreneurs, marketers, sales pros, and students alike, all powered with artificial intelligence. And with this tool, there are over 700,000 presentations created daily, and that's all due to this problem and this situation we've all been in, where we're staring at this blank PowerPoint or Google slide at 11 p.m. for our boss or for a sales deck or for school. And we're trying to make something that doesn't look like it was made in 2003, but also gets our message across. So I want to share Gamma, a AI-powered tool that is completely changing how we create content across the board. And I'm not just talking about basic presentations. We're talking websites, social media carousels, full-on sales decks, course and training materials, portfolios, and a whole lot more. So for example, watch this. this, I will type, make me a lesson about stock market investing, and in seconds, Gamma will create a beautiful and professional presentation.
And you can see me scrolling now through that final editable presentation.
And to see this image, with one click, I can replace the subject, change the style, or remove the background entirely with no Photoshop or any similar tool needed. So 50 million users are already using Gamma, and they're using it to create over 4 million AI images and pieces of media per day. That is more than the total amount of daily uploads on Instagram per day. The content you create is interactive, it's mobile friendly, and can adapt with AI to what you need in real time. So again, whether you're a consultant, a online teacher, a student, marketer, or solopreneur, you can ditch your own tools and start using Gamma today. And yes, you can still export to PowerPoint and PDF and these legacy tools if, say, your boss needs it. So you can try Gamma today by heading to the link in the description or just searching Gamma presentations on a browser. Your future self will thank you, and I look forward to seeing what you create. So that said, let's get on to the next cheat code. And so this is one that I consider generally very useful across any business or entrepreneurship or career setting, and that's to consider opportunities through the lens of three things. So the expected outcome, the potential variance or expected variance of outcomes, and then the second order variance of both of those elements. So your expected outcome, for example, if you make $50,000 a year in salary, is that $50,000. The potential variance is how much more or less you can make. So unless you get fired, right, you're gonna make the 50 grand, but maybe there's bonuses or there's tips, and so you could make some more than the 50. And then the second order variance is how likely both of those variables are to change. So maybe you could get promoted, and there's some likelihood of that, and that's going to change both that base expected monetary outcome and then also the variance of it. So maybe the amount or the size of the bonus that you could or maybe could not get. And so if you consider opportunities through those three variables, then you get this very holistic appreciation of the opportunity. You're not just looking at how much money am I going to make this year, but in a monetary and a financial sense, you're looking at, well, could that change this year? Could generally it change every year? How much do I think it's going to change by? And that's how, in a mathematical sense, you can justify things like working for free. And then that also ties back to the prior point of taking more risk in the areas, again, where you have lower capital stock. If you can take on more risk, and what you get for that risk in terms of some new job, a new opportunity, starting your own business, is a greater variance of outcome, even if the expected outcome decreases, or maybe out of all of that, the second order variance increases, then maybe that's a worthwhile opportunity to consider. And if you're on the edge, that is one lens to view it through. But there's a lot of other things to consider when we think about risk and, say, new jobs or promotions or all these decisions you have to make in a career sense. And one quip I like when thinking about that is frame number 3. And that's quantity beats quality in the macro because quantity drives quality in the micro. I'll say that again. So quantity beats quality in the macro, so over 1, 2, 5, 10, 50 years, because quantity drives quality in the micro. So over 10 years, if you just do something a lot, that's going to drive you getting really good at that in the moment, in, say, the marginal event. And if you are out-iterated and out-repped, even if that person is clueless or much worse than you when you start, you will mathematically be worse than them over a lengthy enough period, just depending on how many more reps they're putting in versus yours. And that's all conditional upon those 3 other things we talked about, so expected outcome, expected variance, and second order variance. Whereas those cycles or those reps have to make one of those things better, like you getting better at advertising or creating content or studying. If what you're doing and what you're putting more reps into affects one of those expected outcomes or variance, then over a long enough period of time, it is intelligent quantity of doing that thing that is going to enable you to move upward, either financially, work-life balance, or in terms of whatever else you care about in your career or your business. And that, hey, the thing you're doing reps of has to actually matter is also why, for example, working in a factory in a minimum wage position is a much more difficult situation to just apply reps to, because there's, even if you are that much more productive, right? It's much harder to say just move upward in that hierarchical situation. And now number 4 ties into the type of work that you choose to embark upon. And especially in the hustle culture online that you may be a part of, if you're, say, watching this video, there's this idea that initially it has to be all in on, say, the entrepreneurship or the hustle side of things. However, if you look at the type of people that you want to emulate, I would bet money that a lot of them or most of them did some combination of the two for some length of time. So specifically, if you want to be an entrepreneur, to run your own business, frame number 4 is do not discount getting a job as you learn about the new thing and put effort into that new initiative. That funds your living expenses, and critically, that funds and gives you capital to test things in that new business as you start to grow it. But then, especially if you're young, how do you grow it, right? What's the fundamental kind of lever there? And also not just in your own business, but in any type of job that you could have. Well, at its core, labor pricing, or how much you get paid for your time and your labor, is about the value that you produce, right? In a capitalist and a free market environment. And that, in a lot of ways, for frame number 5, makes your career path in a lot of ways dependent upon your leverage as an individual. Either your time has to be worth more, or there have to be vehicles that transcend you so that it's not just you trading your time for money. And that's not to say trading time for money is bad if your time is worthwhile and gets you the amount of financial resources that you'd like. Now, in thinking about leverage then, when we're young, we don't have capital or people like employees as a form of leverage. And that leaves you with 2 very material forms of leverage. So media and code, because you write it once or you make it once and millions of people can see it or use it, or more generally, ideas and processes or systems. And that, I think, is a very useful frame, or at least one I found useful for career opportunities and your position within a business or within your own business. Whereas when you're young, the leverage that you can apply to generally have more opportunity, to earn more money, to move yourself up in your position is probably going to come down to ideas and processes in some form or fashion. And so you can ask, does this opportunity, or replace that with, does this XYZ, let me apply leverage in the form of ideas or processes, or develop yourself to then get better at doing those things. And the more flexibility you have in that idea and process domain, then the more variance is present in the outcomes, right? In the amount of money you make or the amount of status that you gain. And that's because that idea can transcend you as an individual, right? One good idea can impact the whole business that you work at, or the whole business that you started, right? A revised workflow or process can be used by 1,000 employees and so on. And that differs in its scale and the scale of the outcome there when you do get it right, versus being slightly more efficient at, say, getting a project in on time. But those basics do matter. Things like being nice to the people around you and having good relationships and being on time and being consistent. And that ties into the last video where I said relationships beat systems. But something else in frame number 6 is don't discount the basics. And I mean this in a very practical and tactical sense. And one example of that I've seen a lot just because I've worked around it is pay-per-click advertising, things like Google or Facebook ads. I would bet everything I have that if you took some of the best practitioners or creators and strategists of, say, Google ads in the world, and you went to 1,000 or 10,000 businesses that spend, let's say, $1 million or more per year on Google ads, that those guys who were really good at ads could double or triple or 10x the results that those companies are getting from their ad spend. And you see that all the time, even when you have a team of smart and intelligent people at those companies, working in marketing, working in sales, working on ads. Because even if you're working on the ad graphics, the copy, there's still this holistic element to the whole system, or to tweaking and testing certain elements that just gets forgotten when some automated, some very standard or normal process gets embedded into a business. And in a lot of cases, there's just ads that are running and just a check that's going out of a business account every month, and no one's even checking on the ads. But digital advertising for a lot of businesses is just the cornerstone of their marketing. It's the most normal thing that's just been around for them for 5-10 years that gets them a lot of their clients. So if you're an intern or you're just starting work at that company, my point here is, before you, in this analogous settings, start working on sales automation or working in AI or brand messaging, just look at the ads. Look at the basic thing that's been going on forever, question that, and see if there's improvements to the ideas and to the processes that run that fundamental established part of the business. And again, I think that's analogous, at least in my experience, to a lot of other domains in your job and career setting. Now, for number 7, the best career case is that the bottleneck is you. So if you are what you think is holding you back in your career, that's good, maybe counterintuitively. And if it's some number of other things or something else, then not good. For example, let's say you're a barista at Starbucks and you want to earn multiple 6 figures per year. Well, how being a barista at Starbucks, which is a great job generally, but let's say you want a lot more than that, how are you going to get there? Is the bottleneck you working harder or having better ideas? Well, probably not. It is the amount of hours that you're allowed to work by your boss. It's the corporate marketing team, and just the number of people that walk in the store, which you can't personally really do that much to affect. So that's a really difficult position because you don't personally have control. You aren't in a position to affect the expected outcome, the variance of the outcome, and a second order variance, at least comparatively, right? Compared to, say, if you run your own business, if you work in sales or any number of other roles out there. So if you can work to put yourself in a position where you have more control and initiative over your career and over you being the bottleneck of what's holding you back, that's better across the board because you can do more, right? You can have ideas, you can spend more time, you can put more effort in, you can do this whole set of things to actually put yourself in a better position. And if that requires changing jobs or doing something on the side, maybe it does. And that ties back to that risk reward dynamic from earlier and also into something else, which I think is critical. And that's in that Starbucks example I just gave. That's all conditional upon you actually wanting to make that multiple 6 figures. Because again, Starbucks, at least in my opinion, is a pretty good job. You get to serve people coffee, people like it, you get to talk to people, you get to work on different things and make different types of drinks. And generally, depending on where you are, you probably get paid well compared to a lot of other people, either in your country or around the world. And so what I generally observe is that a lot of career suffering and personal suffering comes from a mismatch between work optimization or career optimization and life optimization. And by that, I mean, for most people, your career is inherently a money-making vehicle, right? You clock into work, you make some money, hopefully you kind of like what you do, and then you clock out. Whereas life as a whole is obviously not a money-making vehicle inherently. There are other things that you want to achieve and to be present in your life. And so there's this kind of push-pull that could happen there between you working for money, but your life not being about money, and then conflating that with other people's life and what they choose to optimize for. For example, some people, for some periods of their life, may optimize purely for money. Other people, never matters to them. And especially today with social media, and if you live in a Western country with the capitalist, or at least in the US, the capitalist environment there, then people take other people's models for what those people optimize for in terms of their life or career and apply it to themselves. And at the end of the day, it's fine if your job is just a money-making vehicle and you clock into work and you have a happy life outside of work, if that's what you want and if that is what you're optimizing for. Or maybe for your 20s, you want to focus purely on money and you want to optimize your life and your work for money so that those are aligned. And then you make your money, you go start your family when you're 30 and you're financially well off. And so if those two aspects are aligned, right? So what you want out of your career, what you want out of your life, and then also the desires of other people or what they're optimizing for that you compare your model to, that's where suffering and confusion in a career sense comes from. And I see this a lot having been in college, and a lot of people that for the first time in their lives have to ask themselves for the first time, again, those very serious questions about their life and career and what they actually want. So to tie that together, it's fine to want what you want as long as you actually want it. But if it's the things other people want, or if there's this misalignment where within your career, you want to make the most money possible, but generally in your life, you don't really care about money that much. You want a family, you want to travel a lot, let's say, but within the career of your career, what you do, we're so conditioned to associate that, say, with making more. When if you align those two, if you align your career goals with your life goals, maybe you just want to make 80 grand a year and like what you do for the rest of your life. And that's great if that is what you want and what you want to optimize for. Those are the 8 frames. Now let's get into the final rapid fire of 4 more cheat codes. So first is that everything that I've seen work financially and career-wise in my life has taken 3 to 5 years to hit its stride. And I think framing a job, a skill, a new business in this minimum 3 to 5 year time horizon sets you psychologically up much better for success, because if you are the bottleneck, like we were saying earlier, it's going to be about you and your mind and how you treat this and how you work at it. And maybe, if you're watching this and you can make something happen in a month, that's awesome. And I truly wish that it works out that way for you. But at least in my experience, if I want something to work, I'm going to have to work at it for 1, 2, 3, 5 plus years. Next, if you want an unusual outcome, you must have unusual inputs. Life isn't deterministic. It's not like in a career sense, you start one business, you take one new job or a promotion, and something else happens in a financial sense. Like you're guaranteed if you start a business to make this amount of revenue in your first year. Everything is stochastic. There are different likelihoods associated with different outcomes. And because there are different things that can happen and everything, again, is stochastic, and the problem there is we start to associate some minute possibility as being the much more probable possibility. For example, what's very common in the digital space when we think about, say, entrepreneurship is that people see videos of people who got really lucky or just hit a gold mine with crypto, with an agency, with whatever it may be in their first 6 months or first year. And that is possible, but it's not probable, right? If you're 99 out of 100 people, you're going to have to put a lot of years in for that to work, and for some amount of people, it won't work. But for some minute amount of people, it'll just take off. And that could be you. But if you bet on that being you, then psychologically, you're going to be in that much worse of a position. Next, most of the career advice that you hear is real and correct and valuable, but it is meaningless until you live it. Again, maybe you're watching this and you're just much better at this than I am, but I can hear a lesson, a note 100 times, and then only when I actually am in a situation where I fail and then I'm like, hey, this thing actually caused it, do I actually learn the lesson? That applies tactically in your job and in little, say, projects you may be doing or a business that you want to start. And then also generally in life, right? Everyone with money says money doesn't make you happy, but you have to make the money to go find that out for yourself. And finally, we slightly touched on this earlier, but I think it's an important point, so I want to end things with this, is people very rarely ask if the question was asked. Just because it seems obvious or you think someone else is managing it or it hasn't been tried before does not mean that someone else asked that question or checked up on the ad account or whatever it may be. In that idea capital, those ideas that actually impact things, or just that low-hanging fruit of, hey, no one did try this, those are the things that in a career sense can meaningfully impact your trajectory. So ask the question and question the assumption. Now again, make sure to go check out Gamma by clicking that link in the description for that whole host of AI-powered content creation tools. Otherwise, that's the video. Wishing you a great day wherever you are in the world, and I'll see you in the next one. Cheers.
So I got a job offer earlier this year to work at this really innovative company where my starting salary would have been $75,000 to $85,000 a year. And then I would have got somewhere between $50,000 and $75,000 in stock options. And also, I quote, the salary and options package would rapidly increase with very strong performance. Now, I got that job in a totally non-traditional way. And if you're under 25, then this video is for you, because I'm going to break down exactly how I was able to do that and how you can too. And I'll note this was also an industry in which I had no prior experience. So in the next few minutes, I'm not just going to share the story of how exactly I got that job and how you can replicate it, but at the end, I'm also going to share 3 hacks that will really just add gas to that fire of you getting these crazy positions and really good compensation as a young person. So here's the story. I was listening to a podcast where this business owner and entrepreneur was being interviewed about his company. And it was this really just fascinating, deep tech business. That is something I was super interested in, even though I didn't have prior experience in the industry. So I went and I searched for his name on LinkedIn, and then I just sent him a message. And it was not a sales pitch. It was not an I want a job message. It was basically just, hey, I think what you're doing is great, and I just want to connect, and let me know if I can help you out at any point. He responded a few days later and said, hey, just let's hop on a Zoom. And I hadn't asked for that, and in retrospect, he actually thought that I was asking for a job, even though I was really just saying, hey, let's connect. So we had this 30-minute conversation over Zoom. By the end of it, he was like, hey, do you want a job? Now, I was kind of taken aback there because I was like, hey, I didn't even think a job was on the table, but I'll think about it. And so I did think about it, and ultimately I had a few other conversations where I met not just him, but his co-founder and then their lead investor as well. And throughout that entire time, my pitch was basically, here's a bunch of ideas I have for the company. I think a lot of great things can happen here, and I think you aren't doing a lot of those things. And so after those few conversations that took place over probably 3 or so weeks, I got this email with the $140,000 initial compensation package, which would also have increased if I had joined the company. And they knew that I was 18. They knew I had no prior experience. I think in retrospect, what really sold them was the unique background that I had, combined with, and this is really the critical part, the energy, the ideas, and kind of the novelty of what I was presenting to them. Now, I ended up not taking the job because a company that I co-founded was really starting to take off during that month. But the fact that I did get the offer, and it was at a just dream company that if I was going to work for anyone, I'd want to work for them, with really cool people and a great starting salary, is just really something. And in retrospect, here are the key things that made it happen, which I've also vetted across other similar experiences and also just through my businesses as well. But before I tell you exactly how I made it happen, I want to tell you about Odoo. They are the sponsor of today's video. Odoo is a suite of integrated business apps for So you must hear all the time, and you must get ads and watch videos about different business softwares that can help you, right? Like a CRM over here, an accounting tool over there, inventory management there, sending invoices, payments, creating a website, all these different apps. Now what Odoo does, and they are the #1 business software in the world with over 15 million users, is take all those different apps and pull them into one platform. So as a business owner, or if you want to start a business, they're super helpful with just, again, saving time, saving you money, and generally making you more efficient and just really making you more money as a business owner. Also, compared to all those individual softwares, they are much cheaper. So you can click the link in the bio to book a demo or just learn more about Odoo and how they can help you. And with that said, it's back to the video. Okay, so first off, regarding how I got that kind of job offer, I want to say that the traditional hiring path today is just the worst, and you should absolutely avoid this at all costs. And what I mean by that standard process is just sending your resume or CV to Indeed or LinkedIn, or just applying to jobs in those very traditional manners. And the very simple reason as to why you shouldn't do that is because you have insane amounts of competition and you have almost no ways to stand out. For example, a few days ago, actually, for this YouTube channel, I put out a job offer on LinkedIn that was for a short form video editor. I got 650 applicants to that job post in the span of 36 hours, right? That's 650 people who wanted that job in less than 36 hours and applied for it. And I've had very similar experiences across my other companies with job posts on Indeed and LinkedIn. And also when I've applied to the few companies that I have across those platforms, you most often just get some kind of default response where maybe they'll go for an interview, but oftentimes they just filter you out based on keywords. And for example, in the job that I detailed in this video, I 1000% would not have gotten that if I was just one out of 700 applicants. There also are just really good alternatives to this traditional path, which I'm just going to explain shortly. So instead, the vastly superior alternative to this traditional job application path is just through relationships. And I've said this before and I'll say it again, all of business really is just relationships and people who know each other working together and building relationships and so on. And it should absolutely be the same with you trying to find a job. So for example, you just going to LinkedIn and searching for interesting people at roles you want or at companies you want to work for, or going to, if you're say in college, the alumni network where you can reach out to people that are willing to mentor you or introduce you to, open positions or people who are hiring at their firms. Just reaching out to those people is the first step in this process of getting jobs and compensation that really you shouldn't or are very unusual to get as a young. Now, this is somewhat company specific, right? Like if you want to crack Google as a company, that's much harder than say startups. And also if you work in medicine or say hardcore finance, it is a lot harder to get those jobs. But apart from those edge cases, if you do want to make really good money and just work at your kind of dream job when you're young, again, just forego the entirety of the standard job application path and just focus on building relationships with interesting people through a combination of cold outreach, so just messaging them, emailing them, and so on, and then warm outreach, so just people that you already know, introducing you to people they know. And there was another job offer we put out on LinkedIn probably a year or so ago, where I think all of the 50 or 60 respondents to the job application that we interviewed had college degrees, right? Some of them had college degrees from top 20 schools. Like the degree of competition there and just the difficulty in interviewing and just figuring out who to hire from that many people that are all really, really qualified is nearly impossible. You're just frankly never going to get a really good job when you're young, when you don't have experience, when you're applying through all these, again, just traditional route. Now, if you don't have someone's information and you do want to cold call them or send them an email, then you can go through databases like, say, Rocket Reach or other kind of lead platforms to get that information if you are willing to spend a little bit of money to do this. Otherwise, just working through LinkedIn, social platforms, and so on is just really the way to go. Okay, so the first key to getting these really good jobs is to build relationships first and to not apply to jobs through the traditional path. Now, the second key is to offer free value. So don't approach this as a job when you're talking to these people or meeting them or as a sales pitch, but rather here's what I want to do for you and here's the vision I have and the ideas I have and all the energy that I want to put toward your idea, your company, and so on. Again, when I reached out to the founder of this company, I wasn't asking for a job. At no point was I hard pitching him, right, on getting a job. What I did do is brainstorm with him, is come up with ideas for him, get him excited about what I think in the direction that I think the niche I was focusing on, so the marketing, the sales, the branding of his company could go. When you're directly talking to people in a format that doesn't feel like an interview and you're talking about ideas and companies that you want to emulate and you're brainstorming together and you have cumulatively all this energy, that is how you get these crazy jobs that you never would have on LinkedIn or Indeed. So focus ultimately on the value that you're presenting, not the job itself, and then always have the most energy and creativeness in the room. That's the bottom line. Okay, that's step 2. Now here is the third element of this process, and that is do your research. And you just have to know what you're talking about, period, whether that's the person you're in the room with, the company at hand, or just the ideas that you're presenting. Right? One problem with standard interviews, if you go and interview 100 people for a job, is that none of them have actually done the research on you or the company. They just read some, brief description somewhere. If you are the singular person that knows everything there is to know about the company and the person, and you're approaching them with ideas that make sense for the company and are making connections to these other things that they haven't thought about, then they will create jobs for you. They will give you jobs that didn't exist before because they realize in a sense that you're solving problems they didn't know they had, or you're presenting radical solutions to problems that they absolutely know they had. So you don't have to have some crazy resume, just sell them on your ideas, your motivation, and your work ethic, and ultimately just on your personality. In that if someone likes you as a person, you are so much more likely to get hired versus the inverse. The question for them isn't really that much about experience. For the person that is potentially hiring you, the question is, will they follow through on their value prop? Or will they follow through on the ideas and the person that they are pitching themselves to be? And I mean pitching not by directly pitching, but just by the conversations that you're having. So in combination, build direct relationships, offer free value, and do your research. And now here are the 3 hacks to finish off this video to make sure that you do get that dream job. And I will ask that you just subscribe before I get into those if you do find this video helpful. So first, just volume and organization are your best friends. Again, I spoke of databases like Rocket Reach where you can get the contact information for people. There's also plenty of others like Uplead, Cognizant, and so on. But it's not just having the potential or the ability to reach people, it is following up with them and is contacting them en masse and then tracking the information that you have on them. For example, just make a list of 30 companies that you really want to work for. Then from that, find a list and get the information on, say, 100 key people in that company. Then reach out to 10 of them at a time, and then do your research and have information written down on the company or the person. And you can take that structured approach and do the same thing with asking friends if they know anyone in a given industry that you want to work in, or going to a portal for your university and say reaching out to 100 or however many people that have said that, hey, they're willing to mentor you or give you a job. And that number 2 is put together a presentation or visualizer describing the ideas you have for the company you could potentially work at. That's exactly what I did for the story I described in this video. You can see that presentation right here. And there is a time and a place to do this, like probably not just off the bat. But what that does is show that you took the initiative, you actually have valid ideas, you can create things that visually look good, right, and that detail your ideas. And ultimately that you are willing to put effort into something when, again, you haven't directly pitched them for a job. Okay, and then number 3 is, again, it really just comes down to the relationship and people. So really, you should focus above getting the job on just meeting interesting and influential people. So then this third hack, quote unquote, is in a very material sense, try and get jobs in which you also meet influential and interesting people. And that's because these caliber of people that have this status, this network, this money, whatever it may be, those are the people, and that is the point of this whole process that are going to get you into unusual positions, whether that's salary-wise, just influence or job role-wise as a young person. So if you can get any kind of job in which you're rubbing shoulders with all these really interesting and successful people, then maybe it's not that job, but they are the ones ultimately that are going to get you those really, really good positions when you're still very young. Now, a lot of all these hacks and this whole process may sound kind of self-evident in retrospect, but I look at most people around me that are my age and also just going off the numbers job application wise, where all that everyone does nowadays is still just apply through these very traditional portals or just sending their CVs or resumes to job application websites or just the website of a specific company. And if I can nail in one point, it's just that I strongly recommend that you avoid that whenever possible. And of course, that's dependent upon the industry you're working in. But there is just a 0% probability that you're going to stand out, that you're going to get anything that's unusually good in terms of your role, in terms of your compensation or salary. Ultimately, it is just playing a game in a much harder way than you otherwise have to, right? It's like trying to fight the maxed out boss on the final level instead of just going and meeting all these interesting people, developing relationships, and then just, going about it that way. That's the video, and I will see you in the next one. In the next 40 or so minutes, we're going to do a deep dive into everything you need to know to set yourself up for success in the world of personal finance. We're going to cover everything from learning about the basics of finance to earning money to saving it and finally to investing it. And if you're wondering why you should listen to me and or watch this video, you can check out these videos here or any of the books that I've written about these subjects. I've also done full deep dives into a few subjects like debt and the stock market. So those videos and those subjects I'm not going to cover as in depth as I will these other subjects, but you can always go and watch those videos if you do want the deep dive. Like I said, the video is going to break down into 4 subjects, the first of which will cover your introduction to basic financial concepts. Then we're going to cover how to earn money and how to approach earning money and wealth generation. Then we're going to cover spending money and how to spend it correctly. And then finally invest, so how to grow that money through a number of assets and investments. Now, personal finance at its core is about first how you generate and how you make money and then what you do with it, whether you spend it, you invest it, and then how you spend it or invest it if you do so. Now, at its core, right, anything personal finance related is going to break down into these subjects at some point, and these are just the tools or the frameworks that you're going to involve yourself with in a financial sense. The first of those is the concept of assets versus liabilities. If you've seen my other videos, I am beating a dead horse here. But assets and liabilities break down into things that make you money and things that cost you money, right? So if you buy something like a house that appreciates over time, as long as you aren't spending more money than you should on it, say through a mortgage, then that's gonna make you money. If you own a business or a stock that appreciates in value, you're similarly buying an asset. Meanwhile, a liability is something that costs you money. So if you have a loan for a consumable, say like a new technology, say like your Apple Max, right, phone that came out. If you have that through a loan and you're paying every month for the loan, then that is a liability. That's something that costs you money over time. Now, really the core concept of personal finance is you want to buy more assets and you want to have fewer liabilities. If you have more assets, you're making more money. You're making it when you work for it. You're also making it when you don't work for it, right? And that if you own, say, a stock and the stock goes up, you don't have to put in your time. You don't have to work, say, get paid by the hour for that stock to go up. So you can make money via owning assets as opposed to trading your time for money. Meanwhile, if you have more liabilities, well, you have to pay more, you owe more, and generally you're less wealthy and you're not financially free. You are tied to these things because you are obligated to pay people back or pay things back because essentially they are cost, they're a liability. So the core tenet here is just, okay, we want to figure out how to get more assets and how to earn more and then how to have fewer liabilities over time. The next concept is taxes, right? Everyone has to pay taxes. What do they say? It's taxes and death are the 2 things you can't escape. That really is true. However, most people approach taxes in the wrong way, in that at its core, taxes are a system of incentives, right? The government uses taxes to fund everything they do. They're a deeply integral part of society, but they set up the tax system in a way so that if you know what you're doing and if you do things that the government wants, they will give you tax breaks. They will give you incentives to do things that they want, right? That's also in part why the tax system is built as it is, whereas if you make more money, you pay more as a percent of your income in taxes. And that's because if you're not making as much money, you're not doing, you're not going to give the government a lot of money anyway. And so the incentive there from the government's perspective is for you to make more money. So if you pay less in taxes, theoretically you have more so you can earn more later. And the logic there as well, the top 1% of people, of earners and individuals by net worth in America do pay the majority, right, the vast majority of taxes. So in that sense, that is an incentive. And then if you do things like provide housing for other people, if you own an apartment complex and you rent those units out, right, you can get a lot of tax breaks there. And generally, if you own a business, you're going to get a lot of advantages tax-wise. So again, in that sense, if you start a business, if you provide economic value, that's good for the government, that's good for you, and so there are tax breaks there. So we can think of the tax system as a matter of incentives, and one that if you play the game correctly, if you do things the government wants, if you approach it in the right way, and if you know what you're doing, you can minimize what you pay. And that's not to say you shouldn't pay your taxes. You absolutely should pay your taxes. but it's a matter of doing it correctly and doing it in a way that saves you money and that encourages you, right, to make more money, to make more and earn more assets. Now I'm going to do a whole nother video that's a breakdown of taxes. Generally, just my 10-second spiel is track everything and make sure to take write-offs and depreciation on various items. At some income level, it also is absolutely worth it to hire a professional. It's not worth it to do it yourself. But if you're below that threshold, then don't worry about it and just file those yourself, but also just keep in mind those tenets of, okay, track things and then write off what you can and take depreciation on items additionally when you can. Now, this third financial leg is that of banking. And the reason that this is on here is because anywhere you store your money, generally a bank is going to be involved. If you want to use other people's money through a loan, a bank is going to be involved, right? The whole financial system at its core runs really on banks because banks hold your money, they invest your money, they give you money, and so on. There's a lot of different types of banks, right? Most people have their checking account with a bank, they have a saving account, and then they have an investment account, say with a brokerage or an investment bank. Now there's a lot that you can do here with banks, right? Banks are there and they're financial tools that can help you. For example, if you only have, say, a savings account right now and you keep your money in there and that savings account makes you 1% per year, right? If you just transfer that over to a brokerage and you put that in bonds, now your money's making 5% a year. And if your money makes 5% a year versus 1%, right, over time, that's going to look like this versus this. So if you want to be there as opposed to there, simply by holding your money, say, in a brokerage account, by investing it versus keeping it in a savings or a checkings account, you're going to make more money down the line. So understanding how banks work also, that ties into things like credit, as in banks are the ones that are going to give you money. So you want to be nice to them. You want them to trust you with their money. And to do that, you're going to use a credit score, which we'll touch on here in just a second. I also want to touch on economics. This is our kind of fourth leg here. And the reason for that is the game of money and personal finance really at its core is a matter of economics. Economics being just how people interact when it comes to products and goods and services. A lot of how you live your life is going to be, in a financial sense, is going to be determined by your macroeconomic situation, right? Your macroeconomic situation is, well, how is the country you live in performing economically, right? Where were you born? What are the opportunities there? And then things like, right, education, language. These are all big things that ultimately will impact your personal finance. The country you're born in, the people you know, the level of wealth around you, right? And then how your investments perform, well, that's going to be a matter of, in large part, of the macroeconomic situation. So understanding those things is really helpful when it comes to deciding how to earn money, how best to earn money, and also where to put it or how to invest it. For example, the federal bank in the US right now, right? They're doing a lot with interest rates. And over the last year or two, how they've raised or lowered interest rates has drastically altered the economy, right? You saw a COVID tank in the stock market. Is that on screen? Yep. And then you've seen this massive run up over time, especially in the stock market and in some other asset classes as well. And all of that is really fundamentally tied to the federal bank playing around with interest rates, or again, the macroeconomic situation. Same with COVID-19, right? That was a macroeconomic situation. If you live in South Africa, right, in India, wherever you are in the world, there are these decisions that are made on a countrywide level, and also just situations and events that unfold on a national level and a global level that really will impact, again, how you can make, how you can spend and invest money. So understanding those things is critically important. And we're not going to do a deep dive on just your sort of macroeconomics now, but that is something to look into on your own time, and I'm sure we'll do videos on that in the future. The last financial leg here that I want to cover is that of credit. Now, I did do a very long deep dive into debt. Debt and credit are pretty much synonymous, right? Credit is you owe someone something. Debt is an IOU or an obligation. Credit is important because it gives you leverage. It lets you use other people's money while using less of your own. Now that's a dangerous thing in concept, because if you think that you can get away with using other people's money and you use too much of it and you can't pay it back, well, that's a bad thing. That's why too much debt, too much credit is a bad thing. However, it is in large part, if you do it safely and approach it safely, a very valuable element of your financial portfolio and health and capabilities, right? So a very basic but also great example of that is the mortgages. And most people buy their houses using the bank's money. Why? Because they have to put less money down and they're going to make more money over time. All right, so in that sense, a mortgage is more valuable. In a similar line to that, your credit score is the degree to which banks and institutions and people trust you with their money. It is so there's credit, right? There's debt, and then your credit score is just, well, the score, the indicator, the metric they use to figure out if they should give you credit and debit, or debt and not, right? So your credit score, and again, you can watch this in the debt video, but it works on a scale that maxes out at 850, and generally if you pay back your loans on time or your credit debt on time, if you keep the number of credit cards you have fairly low, but you also are active on them and you use them for a long time, your credit score is going to go up. The higher your credit score is, the less you're going to pay in interest on loans, with interest being the price of money. So how much you pay for loans, say like a 12% yield versus a 4%. And then generally, if you pay less for debt, you're going to earn more. So generally, just your credit score is a core element of your ability to use debt and to use credit. And so the bottom line there is have a few credit cards, use those credit cards fairly often, but reasonably so, and then pay back all your debt, right? Your credit debt, or the amount of your credit line that you've used on time. If you do that, the banks will like you, and then you're going to be able to get more assets and have less liabilities. Now, generally, if you understand in some part, to some extent, all of these things, you're going to be able to make educated decisions about anything relevant to finance, right? Say buying versus renting a house, right? A lot of people make this decision at some point in time. And let's say renting an apartment, right, versus buying a house. Now, we can use these various tools to figure out whether we should buy or rent, right? Take assets versus liabilities. If we're renting, that is a liability. We're not making money because we don't own the property. We're just spending every month on the property. However, if we buy and say the house goes down in value, well, now that becomes a liability because we're also paying on the mortgage. So we can think about, is the house going to go up in value? Is it going to be an asset, or are we going to pay too much for it? Are we going to pay, say, $6,000 a month in rent? That would be ridiculous, but let's say $6,000 a month, and I only make $7,000, right? Is that too much? And is this, in that sense, a liability? We can also think of it in terms of taxes and banks and credit. For example, if you want to get a mortgage for your house instead of just paying 100% in cash, well, you got to go to the bank. And the interest rate, or how expensive the money is that the bank gives to you, that in turn is a function of credit and your credit worthiness, or your credit score. And one last point I want to touch on is that analytics and data is key to anything you do in finance. Most financial things are trackable, right? You can figure out how much you spend and exactly what you spend it on. When it comes to your performance at your job or in your business, you can break that down into, well, what am I good at? What can I improve at? And so on. So generally, the more data you collect about everything you're doing, the better off you're going to be in a financial sense. So if you have a business, right, that needs to be broken down into, here are the 8 parts of the business, here are the different people, here are the products, here are the costs, and then how can we improve based on that data and those analytics. And then this, again, the same applies in your job, the same applies in your personal skill set, because that really is what decides how much money you can make in the market, whether in a job, again, or your own business, and so on and so forth. Generally, you're going to be better off with more data. So focus on analytics and track what you can. And that also applies in a very material sense, again, like say with storing your receipts for the purpose of taxes. That covers learn. Now we're going to get to the fun part, that being, well, how do we earn money? Now this is a big question and a largely personal one, in that you're going to spend a lot of, if not a majority of your life working for money. If you work 8 to 12 hour days and you're only awake for say 16 hours out of the day, if hopefully you get your 8 hours of sleep. So earning money, the best way I think to break it down is this. Earning money is a reflection of value which ties into skills. And by that I mean money is a competitive asset. Many people want it and it's valuable, which means what? It really comes down to value itself. The more value you put out into the world, the more value you're going to get back in the form of money. Because money is just a metric form of value. Let me write that down. And by what I mean by that is before money, let's say I wanted a goat from my neighbor, right? And I only have, 2 sheep, and maybe my friend today, my neighbor, wants apples instead of sheep. Now, if I had apples, I could trade them for the goat, but otherwise, I'm stuck. What money does is provide a medium of exchange there, right? So if I have good A and my friend has good C and wants good D, we both agree that good B has value. Good B can be exchanged for good A, for good C, for good D. Everyone agrees, everyone can use B to buy anything, right? That is essentially what money is. So as opposed to just trading A for C because, say, I don't want this asset C, I just get some asset B with my asset A, and then I use B to get C. So with enough people in the market of money, everything has a fair price. So if I want to buy, say, apples at the local grocery store, the reason apples are sold for a certain price is because people are willing to buy them, other people are willing to sell them and make them, and that intersects to form a market, which is really just a bunch of buyers and sellers. So since money is a metric form of value, we can just think then of how much money you can make and how much money you're going to make in terms of value. Now, there are a lot of ways to think about value. It is in a sense an arbitrary thing, but we all intuitively know what that means. If something is valuable, that means we want to use it, we want to have it, and we want people around us to use it and have it, right? Health is valuable. Love is valuable. Money itself is valuable, not for the sake of money, but because I want to go on vacations, because I want to buy a new video game or a new phone, and so on. There are these things that are valuable, and money lets us buy them because money is a metric form of value. It lets us put a price tag on something like a vacation. Then the question is, in an economic sense, what form does value take? And one indicator of value, which is imperfect, but does make sense when you think about it, is your hourly wage, right? If you go work at McDonald's, the amount they're willing to pay you is going to reflect how much money you make them, how much value you provide for them. The value in that case may be making the fries, taking the orders, and so on. And then let's say you provide the company, right, $30 an hour in value. They're going to pay you some amount of that. They're not going to pay you more than that, otherwise they wouldn't want you to work for them. They may pay you $15 an hour, and then they're going to use the other 30 to pay investors, to build new stores, to do marketing, and so on, do everything else you need to run a large company. So any job, right, essentially the amount of money you make from it is the amount of value that you give to the company at hand. The same applies in, say, entrepreneurship or starting your new company. The problem there is that, value is is more arbitrary. It's less of a known than it is when you go to a job and you flip fries and you can make 4,000 fries an hour that's worth $80, and so they're going to pay you 15. If you're starting a new company, you don't know how much your product or service is worth. You're hoping that it works out and that it is a valuable thing. And if the product or service you create and provide, if that is a valuable thing, if it's better than what exists, if it doesn't currently exist and it solves a problem, right, then you're providing value. Because you provide value, right, metric value, e.g. money, will be returned to you. And that is why the free market, as it does, functions. It really is just an exchange of value. Whereas when it comes to earning money, it's, well, the company is going to, I'm going to give the company some amount of value, and customers, they're going to give me some of that. And in the case of creating, right, a product, a company, a service, etc., that is a function of, well, let me try and create more value than what's out there, and then I'm going to give my customers a certain amount of value and take a cut of that in return. And by that, I mean, if fries are worth $4 to you, you're not going to pay $5 for them. If they're worth $4 of value to you, you might pay $3. You might pay a certain amount. So as a business owner, if you create a product or service, you're going to give people, say, 10 units of value arbitrarily, and they're going to give you, say, $8 back, right? Or whatever the units are there. So in that sense, again, money really just comes down to value. And when it comes to how much money you can make, again, I said value and skills is what we had up here. The amount of money you make then is a reflection of the amount of value that you can provide either to customers in the form of a business, a product, or service, or to a company that you work for. Now that generically we can think of coming down to skills, or your ability to do valuable things. And to do valuable things, you need to be able to create or to do things that most other people can't. So pretty much anyone can, right, flip some fries and make their $15 an hour. That's why that pays $15 an hour. Now to make a, let's say, code a new app, right? That maybe might pay not 600, let's say 200,000 a year if you do that for a big company, because maybe that app is going to go and make $500,000 a year. You're still just taking a cut of your value. Now the counter argument to this, the easy one is, well, the CEO isn't really skilled, right? And yet they may make one decision and get paid $100 million for it. The logic there, however, is that they have some sort of skill set, whatever that skill set is, that is still going to provide more value than it takes. As in, if you run a $10 billion company, you don't have to be that skilled, sure, and that's not to say CEOs aren't. They are usually very skilled. But if you make a decision that makes the company $1 billion, you getting paid $100 million is $100 million, but you still created more value because a single decision for the company goes and does a whole lot of things that are going to make money for the company, hopefully. And CEOs that don't make money for their company, they're going to get fired eventually, or they should be if the market functions correctly. So no matter how you look at it, and especially in your situation, whatever that is right now, the focus should be, let me get more skills, let me change or hopefully further in a better way my ability to do things, to create things, all so I can provide more value. And if I provide more value, the market will return that to me, their customers or my employer, in the form of money. Now, the next question we have to ask is, well, then what are those skills? What are the things that will impact my ability and increase my ability to create, hopefully, valuable things that either an employer wants or that customers want? The way we can think about that is hard skills versus soft skills. Hard skills are going to be your technical knowledge, right? So, and let's think of these under the framework of high value skills, right? So a hard skill is the ability to code. It is engineering. it is engineering. It is, say, creating ads or graphic design. These are hard, these are material technical skills that most people are not good at. So if you are really good at coding, well, you can now create things, right? You can create a web app, you can create a website, you can create, let's say, AI or a large learning model or machine, right? So you can create these things with this skill, and this is a hard material skill. It's material because it's quantitative. It can be measured, right? You can create something very visible using X amount of lines of code and Y amount of algorithms and so on. The same applies with, say, your physics knowledge if you're an engineer. Same with ads, graphic design, and so on. The alternative is your soft skills. Soft skills are things like leadership and your ability to sell and negotiate. And these can still be, there still can be metrics that are used to describe these, but they are quote unquote soft in that there's some more wiggle room there. Like if someone is a good leader, it's hard to measure why they're a good leader or how good of a leader they are. Again, that doesn't mean you can't, you can't figure out what makes a good leader, and that maybe they say have a daily sync with their employees, or they listen to people about their problems. But compared to something like code and engineering, you don't need a lot of technical training to become a good leader. Some people just are good leaders, whereas no one is born as a good coder. So generally, we can break down your situation and the amount of money you're going to make in terms of hard and soft skills. And the more hard and soft skills you have, either all hard, all soft, some combination of those, the more value you can provide to customers or to an employer, and the more money you're going to make. Right now, if you don't have those skills, if you don't have a unique skill set, you're not going to make much money. That's just the fact of the day, unless you get really, really lucky. But you shouldn't play to the exception, you should play to the rule, and the rule is the more skills, the more unique skills you have, the more unique value you can create, and the more the market will reward you for that. So right now, if you want to make more money, right, the way to do that is, okay, just pick a hard skill or a soft skill and go out and work on those. And over time, the more unique your skill set is, your ability to earn money will exponentially increase. And by that I mean, if you're just as good as a coder as everyone else who codes, if you're the average coder, you're going to do a lot better than someone who doesn't code, right, or doesn't have a hard skill. But if you're the 99th percentile of coders, well, your income doesn't just go from, let's say, 2x what it was to if you were, say, in the 80th percentile, to say 4x if you're in the 90, it goes to, well, now you're going to make 100 times more. Now you're going to make 1,000 times more. So the more skills you have, the more money you're going to make through any number of these. Generally, I'd recommend, if I had to, just selling as a semi-soft skill. If you can sell over the phone, if you can sell in person, that is just a core ability that will really translate into everything you do. On the side of hard skills, generally knowing your way around code is very valuable. Otherwise, things like graphic design and ads are also very valuable, just generally today across most of what people do. That's my general spiel on making money and approaching that conceptually in relation to value. What I want to touch on now is some material aspects of earning money. The first of those is entrepreneurship versus a 9-to-5. I think there's a lot of stigma on both sides of, oh, you can start a company versus, oh, you should go and work a 9-to-5. Generally, I think that's just a reflection of you. That is what you want and also what you can do. Sure, starting a company is great in that if you keep doing it for long enough and you are good at what you do, you're going to make a lot of money, probably more than someone who works at a minimum wage job. That doesn't necessarily mean it is better to start the company. There are a lot of risks there. There is a lot of stress there, and there's the risk that you fail, and also say you can spend less time with your family and so on. So there are trade-offs to all of this. There is no right answer. You shouldn't feel pressure to be pulled in either direction. It is just, well, what do you want to do? What do you want to create? And where do you see yourself? What's the lifestyle you want when it comes to entrepreneurship versus a 9-to-5 where you're employed by someone else? Now, in terms of starting a business, I want to cover a few types of businesses. First, we can think of nonprofits. Nonprofits are any sort of business that does not directly aim to turn a profit and distribute that to stakeholders and really doesn't aim to maximize its own profits. Then in terms of entities, and these are companies you're either going to run into or you may start if you choose to start a business, there is a sole proprietorship, right? So that's just right there. There's a lot that goes into this. Generally, if you are a sole proprietor of a business, that is something that you're doing without it being an actual entity. So if you run a sole proprietorship, you own that business, you're doing something, but you don't have to file it with the government. That's very useful for taxes because you can be doing something in an economic sense and you don't, you can take write-offs, depreciation, you can get tax benefits from starting a business. There's also an LLC, or a limited liability company. This is sort of the most basic form of business entities. An LLC can be single member. If it's single member, it's just one person. Multi-member is many people. And if you want to start a company, this is a great way to protect yourself from liability. What that means is if you run a sole proprietorship, you are the business. That means if someone sues you, they can take everything you own if the damages, if what you cost them are that amount. Meanwhile, if you run an LLC or a limited liability corporation, the LLC is a person in a sense. It is its own entity. So if you mess up a contract and someone sues you for $1 million and you only have $80,000 in the bank, well, instead, they're actually suing the LLC. Right? And if the LLC is $20,000 in the bank, the most they can take from you in the $1 million lawsuit, in most cases, is the $20,000. It is the assets of the limited liability corporation, right? It's in the name. It is limited liability. So in that sense, well, that is really why most people go for an LLC versus, say, just run a sole proprietorship. Pretty much anyone can get in any state can get an LLC for anywhere from a few $100 to start it up to, say, $800 a year in California and a few other states to continue to operate it. You also see a few other business structures. You see S Corp, you see C Corp, and then you also get things like your B Corp. B Corp is kind of a combination of a nonprofit and a for-profit enterprise. So it is companies that have a mix of, say, social purposes and also profit maximizing purposes. Your corporations are the structures that you hear, like your Apple, your Nvidia, your Teslas go off of, right? So most of those are going to be C Corps, in addition in part to LLCs. But C Corporation are most of your big companies. You also see S Corp, which is just a smaller version of your C Corps, or your really big enterprises. I now want to cover just a few tips when it comes to personal finance or earning more money at a job, and then also just businesses you can start if that is the route you want to take. When it comes to your job, again, it is a function of skills and value. So just try and do more and try and do unique things. If you're assigned to a project at your job, well, just put in 10% more effort and create something that your employer didn't think you would create, that no one else on your team is going to create, right? And if you do that, you're going to stand out, you're going to get promoted faster, and so on. Also, if you switch jobs, in some cases, if you're, say, an engineer, the more you switch jobs, the more you're going to get paid. On average, if you do have a skill set and you work at Tesla, and then you go to Apple, then you go to Facebook, then you go to Snapchat, and so on, you're going to get paid more every time. That only applies at a certain income threshold. That doesn't apply for, say, minimum wage. But generally, the more experience you have, the better off you're going to be. Also, again, just try and do different things than the people you're competing against, either for a job, in a job interview, while you're at the job, etc. If you can just do different things and stand out, you're going to get promoted faster, you're going to get more opportunities, and so on and so forth. Now, in the case of starting your own business, I'm just going to take a minute to write out a whole lot of businesses you could start, or just genres of business in a sense, and then we'll just briefly touch on all of those. So here are 8 sort of genres of business that you can start. We have e-commerce, an agency, affiliate or affiliate marketing, retail, an info product, a consumer packaged good or CPG, content, and then a hustle or a side hustle. To begin just with a hustle, right? That is a side hustle. That is your dog walking, your curb painting, your lemonade stand, right? As the trope goes. Generally, these are going to be things that don't require a lot of skill to start or get into, and are fairly. It's easy to generate cash with them. As in, if you want to wash cars, you're just going to get a rag and a bucket of water and some soap. And then you're going to go around to houses. You're going to make $20 in the next hour, right? The best side hustle that I know for anyone, especially those who are young, but really anyone, period, is curb painting. A good friend of mine and a partner as well. He was making $8 to $10 grand a month in high school, right? Just painting curbs. I know that sounds crazy, and he put a lot of hours into it. It's not like it's an easy thing, but you can make a lot of money with side hustles. I also started out just reselling on eBay, on Nextdoor, and so on. And that was just going to garage sales, buying certain items, and then flipping them or selling them for more on those other platforms. So these are a really, really good way to start off. If you make no money and you want to make $1,000 next month or $100, whatever the number is, a side hustle is a great way to do that and build skills while you do it. For example, if you paint curbs, you have to go door to door. You have to say, hey, can I paint your curb number for $20? And then you get that skill of selling in addition to the money you derive from it. Then content, right? That is creating media. So this could be starting a blog. It could be creating social media theme pages. It could be a personal brand, like vlogging on social media, like what I'm doing in this video, right? All of those are content businesses. Again, there's a lot of great there's opportunities there as well, because the world really does run upon social media and content nowadays. I think what's really nice about content, especially, is that it works for you over time. And that if you make one video, one YouTube video, right? You can put an hour into making it, or 10 hours, whatever the number is, but then you put it out there and you're done. Assuming you have an audience and apart from marketing and so on. Generally, that's going to keep working for you. People are going to be watching that video. It's going to be making ad revenue for years in advance. And same with getting followers on a social page and so on, or just readers on a blog and that blog ranking over time. In that way, starting content businesses gives you leverage because you create one piece of content and then it goes out there and works for you, and it's passive in that sense. Then we have CPG or consumer packaged goods. That just means creating a physical product, a food item, whatever it may be, right? As in, there's a company we're going to start working with soon at a business of mine. They spent about a year creating a health product. I won't say what it is, but it's generally an item that they actually invented, right? They're working with manufacturers to create it and so on. So if you do anything like that, well, now you're creating a physical product that you can go and sell to people. Generally here, my advice is very similar in that we'll just make sure that people actually want this thing, that it solves a problem. And if it does solve a problem, then people will pay for it. The market will return that value to you over time. Then we have info products. These are things like books, like a course, anything in which you are selling fundamentally information. Even if you go and teach a class, right, at a local, say, senior center, you teach them how to use technology, you are selling an information product. The same applies if you create courses and you teach people how to do something. These other 4 businesses, first is going to be e-commerce. This is selling things digitally. So drop shipping was very popular for a while. That is a form of e-commerce. And then e-commerce as well is just, let's say, buying a product from China is what most people do, and not what you have to do. But and say creating a brand out of it. So let's say they buy hoodies and they create a surfer brand out of it. They have a cool logo and a cool name. they have some content, they have a cool story and mission around it, and then they sell those on the internet. One point I want to make as well is these should be combined. Ideally, they are combined, right? So if you create an e-commerce business, you're going to be using your content skills. You're going to be creating content to sell the brand and the product. Maybe you're also, the e-commerce is for selling a consumer packaged good, right? And so on. So these do intersect. The sixth business or genre is the agency model. This got popular with Iman Gatsi and a lot of those sort of influencers. What this is really is selling a service. Typically, people get customers for an agency by cold calling, cold email, or ads in addition to referrals. So people use these methods to sell a service, for example, a marketing service for a business or a maintenance, say like creating websites for a business. If you're creating websites for a business, you have an agency business where they pay you monthly to go do that work for them, or they pay you a one-time fee. The second to last one here is affiliate or affiliate marketing. What this is selling other people's products. So if I created a $80, say, course, right, that a lot of people like, but I don't want to go out there and sell it. So instead, what I'm going to do is I'm going to say, hey, why don't you sell this for me? If you sell it for me, for every $80 course that you sell, I'm going to give you $40. And that is the business of affiliate marketing. Whereas you can go, if you're really good at ads, if you want to go door to door and sell a product, they're going to give you, say, 1/2 or 1/10 or 1/100th, whatever it is of that. So this ties back to what I was saying earlier of that selling is a really, really valuable skill set because, well, if you can sell well, you don't need your own product. You just become an affiliate marketer. You sell other people's products. And that is functionally what salespeople do, even when they're hired by an employer to do that. The last one is retail. This is just going to be any business with a physical location where you sell to consumers or customers. So if you start a local coffee shop, a bookstore, a clothes shop, and so on, those are all retail businesses. Now, all of these businesses are just fantastic ways of making money if you want to start your own business. You can also think about the type of company you want to work for if that's what you want to do. So if you really like content and social media, maybe you want your job to be something in the domain of creating content for other businesses. So these are businesses you can start, but also skills and areas that you can get good at, that you can build those skills in. That covers the earn section and earning money. Now we're going to get into spending money. I am going to go quicker here because we don't have that much time. Now with spending, the idea that I want to get across here is that you fall to the level of your systems, right? Money inherently is an emotional thing. It is something that emotionally affects you because things you want cost money and things you don't have cost money. And everyone wants something. Whatever you want, you can probably get with money. And if you're feeling bad, right, you can probably get quote unquote happier or feel slightly better with money. What that means is when it comes to spending money, you want to break down how you spend money into systems. For example, budgeting is a form of a system because if you are only allowed to spend $600 a month, well, how do you actually go about only spending $600 a month? You set your budget first off, you plan for that, and then maybe if you have a $1,000 paycheck, you set it, you set $400 of that to immediately go to a brokerage account so you can invest it, right? And in ways like that, by setting systems, by putting barriers between you and your money automatically, you can stick to the amount of money you want to spend and spend it how you want to spend it. So, automatic payments are an example of that, whereas if you get a paycheck every 2 weeks for $3,000, you can set some amount of that to automatically be sent to an investment account. Another way of doing that is just by, say, removing cards from your phone, from Apple Pay. That way it's harder to spend your money. You now created a system that doesn't involve you, that makes it harder for you to spend your money. So generally just create those systems and then focus on spending not necessarily less, but focus on spending what you want or on things that are
valuable as well, right? So this ties back to assets and liabilities. Generally, if spending some amount of money on something is going to make you more money, if you're buying assets with it or things that will become assets, great, spend money on that. If you're buying a bunch of things that will only cost you money, well, you probably shouldn't be spending as much money on that when it comes to spending. And most often when people have problems with what they're spending money on, it is because they're buying things that aren't going to make them more money. They're going out at night, they're going to nice restaurants, they're buying nice cars or whatever it is. They're buying things that will cost them money, and that's when they need to put those budget controls and spending in. Also, don't forget about you as an investment when it comes to spending money. You aren't going to see a direct return there, but you are an asset as well. So spending money on yourself is sometimes worth it if you do that in an intelligent way. For example, that shouldn't be an excuse to not just go on YouTube and learn something for free. Now we're going to touch on the last section here. That is investing. Again, money as a whole in personal finance breaks down into, well, you earn it, and then what do you do with it? There's a lot of things you can do with it. You can spend it, you can save it, you can invest it, you can do this set of things with it. And investing is deciding essentially what to do with the money that you have, that you've already earned. I made a whole video on the stock market that's like 2.5 hours long. That's going to break down a whole lot relating to not just the stock market, but also asset classes and different ways of investing as well. So I'm not going to do a deep dive here, and you can watch that video right now on the top of the screen. But I'm going to cover a few central ideas about investing. The first is that investing will make you a lot more money over time. It is a deeply necessary part of personal finance. And that is because of inflation, and I've covered this again in other videos, so I apologize if you watch those. But if you just save money, if you put that in a checking account, if you keep it in cash, it's going to grow linearly, right? If you make, if you put $100 a year into a savings account, or let's say you take $100 a year out in cash and put it under your mattress, right? Because you want to send your kid to college in 10 years. That's going to grow like this. And that's only going to grow when you put effort into it. When you go to your job, you work for $20 an hour, you take $2 of that times 100 hours, and you put that $200, say every 2 weeks into that. That's going to grow linearly. If you invest, your money can work for you, because when you invest, you're buying assets that increase in value or make you money. And very, very often, if you invest correctly, right, those things don't require your time. And say if you buy a stock and the company increases in value, you didn't work for the company to increase its value, but since the company increased its value, it's making more money, the stock price went up, you just made money. You just made money without working for it, without putting in time. And that doesn't mean you can just magically make a bunch of money with investing. You do have to put effort into it. But what it does mean is that over time, right, it's going to look like this. You're going to be in a position where your money works for you without you trading your time for money, and you're going to have a lot more of it down the line. So that's why investing is so valuable. And that also ties into the idea that you should invest for the long run, right? Investing is not something where, let's say this is years, where you're just going to do it for a month and then you're going to stop, right? And then you do it for another month over here, then you're going to stop. Investing is powerful because if you do it over long periods of time, it works for you. Your money makes money, and that is what makes you wealthy. So in that sense, the best way to approach investing is in a systemic way. It's by creating systems, just like in the case of spending. So for example, that could be, I'm going to take $200 every month out of my $5,000 paycheck, and I'm going to put that in an investment account. And in that investment account, maybe I'm going to buy a set of stocks, or I'm going to buy a set of bonds. If you create a system like that, well, now you're going to put $200 in every month for the next 30 years. And if you do that, who cares if the market goes up 5% this year and down 6% the next year? If overall it grows at, say, 5% a year, it will look like this. You will get that exponential as opposed to linear or a line growth over time. So invest for the long run and invest with your goals in mind. And also, as a final note there, invest based on what you like or what you want to put effort into. And by that, I mean, if you invest in things that you don't know about or that you aren't very good at, you're going to have generally a subpar time. You're not going to make as much money as other people in it. But if you invest in things that you like and that you put time into and that you become good at and make and have skills in, right, that is when you're going to make great investments and have great returns. So if you like investing in the stock market, like let's say you love stocks, well, great, go buy a bunch of individual stocks and maybe that's how you invest. But you don't have to like stocks. It's fine if you don't. If you don't, well, you still want to invest because that's going to be much better for your financial health and the amount of money you're going to have. But maybe you just buy one index, right? Say like the S&P 500 or QQQ, right? These are buckets of stocks. We covered that in the stock video as well. But if you do that, you're still going to get a lot of returns and you don't have to put the effort into that you would if you had to force yourself to research a lot of individual stocks. The same applies to, say, real estate. If you just like owning properties and renting to people and renovating yourself, and that's what you're good at as well, you can make a lot of money by investing in real estate. So go and do that. But if you really just like real estate, don't invest as much money there. That doesn't mean you shouldn't diversify, which just means you should spread your money out so that if one investment decreases in value, you aren't totally screwed over. So let's say gold over here, stocks and bonds and so on. If you don't know what bonds are or stocks are, any of that, again, just go watch the video. But generally, if you invest in different assets, you spread the risk around. So overall, you're going to be safer and make just good returns every year. But again, if you really like precious metals, maybe just put a little bit more of your money into precious metals. If you really like real estate, well, still try and diversify within real estate, but maybe you're going to put more money into real estate. There also are going to be some accounts that you're going to want to invest through. So Roth IRAs, your Roth, your 401ks, those are example of, here, I'll just write that down. Those are examples of accounts where they're tax advantaged accounts. So if you put money into accounts like these, so say your Roth IRA, for example, and you've probably heard this term, in some way or form, you're going to save money on taxes. For example, you're going to put money in, you can invest it in those accounts, and when you take it out in 30 years, you are going to not pay taxes on it. So you're going to save a lot of money there. So it's a very core piece of financial advice that you're going to hear often. It's just, well, max out your Roth IRA. The actual structure depends on whether you're employed or not employed, or you want to buy a house or retire or so on. I suggest you research those yourselves, but those are absolutely accounts that you should have. Now, generally, I want to touch very briefly on asset classes, right? Real estate is one of those. Stocks, or really equities, is another one. You also have debt instruments like bonds. You have precious metals like gold. You have collectibles, so that's, say, valuable watches or cars. So these are all different ways in which you can invest your money. Now, I already said invest in you. I want to touch back on that in that, again, if we think of your earnings potential, the amount of money that you're going to make as a reflection of value, then if you work on your skills and focus on being able to create more value to customers or to a business, you're going to make more value. And then over time, the amount of money you can make, your earnings potential, regardless of luck, just your skill set, is going to go like this as well. So you are something that you should put effort into, that you should focus on learning more and creating unique things. If you do that, the market will reward you, and then you'll have more money to invest. And at the end of the day, if you're just flat broke, if you have, say, $200 to your name, like that's fine. But $200 isn't going to, even if you invest it, that isn't going to make you wealthy or get you to a point of financial freedom. Instead, spending that $200 on changing your ability to earn money. So if before you can only make $15 an hour, and now you spend the $200 on a few books or courses or so on, and you learn how to, well, now make $30 an hour, or how to start something that can make ultimately, say, $1,000 a month, then as opposed to this trajectory with $200, you get this trajectory, right, with $1,000, say, or $1,000 a month, and so on. So focusing on making more money in addition to investing money is what will get you to that point of financial freedom. Now, there's a lot more in investing, like seriously, but that is just what we're going to call it with here. I do suggest you watch the stocks video, or just put anything you want me to dive into more in a more in-depth manner in the comments. With that being said, we've now covered those 4 major segments of the video. So your learn, earn, spend, and then do I have space, invest, right? As a last note, I am giving away a number of the books that I have written on personal finance related subjects. If you want to see those, you can just go to the link in the description and you can download them just totally for free. There's also a Google Drive I have with a bunch of free resources. Other than that, not just with investing, but with personal finance, there's a lot more there. But I think if you do understand the things in this video that were touched upon, you will be in a much better position moving forward. So just put whatever in the comments that you do want me to do a deep dive on, or if you have any questions whatsoever. And with that said, I will see you in the next one. In the next 10 minutes, I'm going to break down 7 financial concepts that either are costing you money right now or will severely impact and or impede your financial future. With that said, let's get into it. As always, I have nothing to sell you, and all I ask is that you subscribe. Number 1 is the notion of saving money, right? And I know this sounds strange, since obviously versus spending money, saving money is preferable. And it's also very common advice, like, hey, you should save money as opposed to wasting it on, say, your $6 Starbucks or so on. I want to touch on 2 concepts here. One is the actual utility of something like, say, buying a coffee a day. The other is saving versus investing money, right? Saving infers, say, taking it out in cash and putting it under your mattress, or keeping it in a checking account, right? It infers a lack of use, right? The problem with that is inflation. It's that the real value of your money goes down if you don't do anything with that money, right? So inflation, let's say it's at 3%, right? That means all goods and services will be 3% more expensive next year, right? So if we have $1,000 in a checking account that's just sitting there, right, the next year, that $1,000 will only buy 3% less, or $970 worth of goods. So in that way, you actually lose money if you quote unquote save it by just letting it sit, say, in a bank account or in cash or so on. The opposite of that is investing money, right? So as opposed to saving, investing money. Now, if you invest money, this happens, right? Compound growth or compound interest. And you probably heard of this, so I won't cover it much. All that means is your money makes money, and then the money your money makes more money, right? So let's say, as opposed to 3% inflation, let's say you make 3% a year, even after inflation. Your $1,000 makes 3% next year, right? So you go from $1,000 $1,000 to $1,030, but then that $30 also makes 3%, right? So the $30 makes what, 90 cents? And then you make $30, so the 3% on the 1,000, plus you make your 90 cents, and then so on, and that grows just like this in a compound curve, right? And that really is how the rich, the wealthy make their money, right? It grows, it works for them over time. Now, the second concept on saving money, and why I think that's bad advice, is that we want to think about money in terms of utility, right? And I somewhat touched on this in a previous video. But let's say you have your $6 coffee, right? And every day when you go to work, you buy this $6 coffee, and you don't need it, and that's truly overpriced for coffee, but you really enjoy it, right? You wake up, you look forward to it, and it makes you productive for an hour, right? That $6, sure, that isn't what the coffee should cost, but if that gets you, say, 1 hour of productive work per day versus not being productive throughout that hour, and let's say a slight edge in terms of happiness, right? That all is utility, right? Let's say expected utility of that $6. Therefore, sure, you're spending $6 on something that shouldn't cost $6, but that $6 will ultimately more than pay for itself in a financial sense, right? Purely in a utility-based financial sense. And that, for varying reasons, that's why I think the advice of, hey, you should save your money by not spending it across the board, and also by just keeping it in cash, why that is bad advice, again, purely in a financial sense. Now, number two, and this is somewhat similar and related, is the idea that being frugal will make you wealthy, right? This really just isn't true, in that wealth really is a function of income, right? It's a function of income, and then it's a function of investing. And for most people, there's a certain amount of money they can save because there's a certain amount of money they make, right? The vast majority of the population in the US and the world, let's say, makes $50K a year. With that $50,000, right, you have to pay for rent, you have to pay for food, you have to pay on, say, dates for your partner or your kids, right? You have all these expenses that you have to pay for with that $50K. Sure, you can make your life worse by spending less money. You can cut down on food, you just don't travel. You can do all those things, right? You can save an extra 5% a year. That 5% a year, e.g. being frugal, right, that will help you somewhat, but is that really going to make you wealthy, right? No. You used to need, say, $1 million to retire. Now that number's at about $3 million to comfortably retire. By the time, say, if you're under the age of 30, you're going to be 50, 60, that's going to be $4 or $5 million you need to retire. If you're making $50K a year, if you're making minimum wage, right, you can save 5% less or 5% more all you want. That's not going to get you to the 5 million mark, right? That's an exponential curve that looks like this, right? So really it is a function of income. It's, let me get that 50K up to 70K, and then let me just save an extra 20. And $20,000 a year for 40 years, right? That will help you really hit the financial marks you need to go to, right? To actually get you to that point of financial freedom, right? So as opposed to being frugal, and again, this ties back to expected utility, focus on raising income. And again, that's the difference between let me try and cut down on food this month and save an extra $100 versus, okay, let me think about a way to make an extra $100 this month and so on. And then that turns into $1,000 and so on. And again, this somewhat varies, right? If you make $200,000 a year and you spend 80 grand of that on completely unnecessary things, sure, right? Save some money and invest that. That really will make you money down the line. But if it comes down for you to, saving an extra $100 this month, that's fantastic, really. But that will not make you the $5 million you need to retire, right? That will give you some money down the line, and that's better than not, right? But what really will get you to that point of financial freedom is just bringing up the income. Now, number three is the notion that all debt is bad. And I did a full hour-long breakdown on this. You can see that video right here on the top of the screen. And I'll just summarize that right now. Debt generally breaks down into good debt and into bad debt. This is a productive way of looking at debt, right? Debt inherently is a form of leverage, right? It's, okay, let me use other people's resources and money in a financial sense to do things that I want, right? And that's why people use it to, say, buy a house with a mortgage or a car or so on, or get a loan to start a business. Those are all forms of debt. Debt really lets you leverage resources that you couldn't otherwise, say like buying a house while only putting 10% or 20% down, and then also accelerate returns, right? Since if I have to only spend $200,000 to buy $1 million house instead of $1 million in cash, I can use that $800,000 to go do other things, right? So you're making more money per unit of your money, at least in that investment. And again, that's all in the other video. So generally, good debt is debt that buys you assets, that makes you money. Bad debt is debt that buys you liabilities or things that cost you money. So if you take on debt, right, to start a business, to buy a house, to do all these things that will make you more money and bring you more value down the line, great. That debt is awesome. The bad debt and the debt that royally screws people over is, okay, let me get into credit card debt to buy a watch, right? That will screw you over. That is bad debt. Do not do that. But generally, the notion that debt is bad is horrible advice. It's an extremely powerful financial tool that everyone uses, that the world really runs upon. And again, that's all broken down in that other video. So just watch that if you want or don't. But just bottom line is debt is not bad. It's just about how you use it. This fourth idea and bad piece of advice is that money won't make you happy, right? There is truth to that, right? But the notion, the idea that money will definitively not make you happy is very much false. And I want to think about what actually do you value in life, right? What matters? And here, let me move this value over to here, right? Let's say love, family, and again, I'm just going off the top of my head, but health and freedom and travel, right? Let's say these are the things that actually, matter in life. Money is false, right? It's pieces of paper, it's number on a screen. Money doesn't actually matter, right? But let's say these are the things that you actually care about in your life. And let's just add happiness onto the bottom, right? So happiness generally is a catch-all. I think for most people will agree, happiness breaks into things like, okay, I have a great partner, I love my kids, I'm healthy, I'm wealthy, and so on. So let's say these are the things that actually matter apart from money, right? Then let's ask the question, well, does money enable or does money make these things more difficult, right? If I have money versus not having money, with everything else as a constant, will I be better off or worse off in pursuing these things, right? An easy case is health. If you have more money, right, you can buy better quality food, you can pay for a gym membership or a personal trainer. Generally, your health will be better off if you have money than not having money, right? So health, you're better off having money. Say traveling, right? Obviously, if you have more money, you can pay for travel, you can take time off work, etc. You're better off, right? Freedom, same thing. If you don't have money, you have to work for money. You have to spend your time making that money. That is inherently somewhat a bound on your time, right? So if you have money, you are more free, right? Then in terms of your family, right? Let's say you want to send your kids to school, right? Or your wife got hurt, she has cancer. You need to pay for her medical bills, right? Your family is going to be better off if you have money versus not having money, right? Love. Love matters. It's not a function of money, and it's not to say, again, that without money you can't say find love, but are you going to be better off? Are you going to have more time? Can you afford dates? Can you do nice things? Can you go on a honeymoon, right? If you have money or if you don't have money. You generally will be better off regardless of all other factors if you have money when it comes to, say, finding love or sustaining a healthy relationship. And if happiness breaks down into all of these things, you are better off having money versus not. That is not necessarily true, right? There's one more thing we have to consider. Sure, you're better off having money than not when it comes to all of these things, and I think everyone can agree on that. But then it's a function of, well, if money contributes to these things, what do we put in to get money, right? So let's say we put in X amount of hours, Y amount of effort into making money, right? Then we really just have to weigh these two sides of the equation. What we're really doing, and the real question of money versus happiness isn't about money, it's about what do we put into money and then what do we get out of money, right? Money is just the tool. Really, it's the time and effort we put into it and then what we get out of it in terms of what actually matters in life. And that is the question of, well, is money worth it, right? Should we put effort toward money? Should we not? And in that way, the general notion of, hey, money is bad, money will not make you happy is really just false, right? Because theoretically, right, let's say you can put in no time and no effort and make $1 million a year. Well, if you have $1 million a year, you can travel more, you're likely, statistically speaking, to be healthier, you have time for family, you can take time off work, and so on. So then just walk that back. What if it's 2 hours a week, right? What if it's a little more effort, right, every day? So it really is a function of what you put into money. And in that sense, I think most people would agree that it makes sense if you're confident in your ability to, say, make more money, if you put more effort or time into money for a few years, to do so, right? If you're 20 or if you're 18, let's say, starting a business, reading some books, taking community college classes, right? Doing those things to bring you from, say, 40,000 a year income potential to 80,000 a year, right? That 2 years of extra effort and time, that's worth it to you, right? For all these things. And then for some people, at a certain point, it's not worth it, right? To put in 80 hours a week for 30 years, right? For all of these things. So this, I think, is really how you systematically approach that question of, well, does money make you happy? And that notion of, hey, money won't make you happy is just erroneous in that if people ignore money, right, they don't get any of the benefits of it. If they don't do the basic things that ensure financial health and safety and freedom, right, they will be screwed over in a lot of ways, and that's just the world we live in. Okay, now number 5 here relates to actually starting a business, right? Now this ties somewhat into the digital entrepreneurship space and a lot of the online influencers. So, if you're older, you're out of sort of that circle, this may make less sense for you. For anyone pretty much under the age of 30 who is attuned, right, to sort of digital entrepreneurship, this will make a lot of sense. And this relates to business models, right? And there's always a business model that there's hype around, right? There was, let's say, e-commerce and drop shipping, right? And crypto, and what else? Let's say AI, and even something like fintech, right? That is a hype cycle as well, or SaaS, or software as a service, right? All these things are hype business models, right? There's a lot of digital content about them. Everyone's like, hey, this is the thing to jump into. You're going to make a lot of money, right? Again, right now that's AI, used to be drop shipping, and so on. The problem and the notion that of this whole space is that it assumes that some new model is going to come around, like AI, and then you can jump into it and make a bunch of money, and then just get out and you're set, right? Really what that says is, I can get lucky, I can take advantage of something before everyone else does, get really rich, and then I'm done, right? That is fundamentally a horrible way to approach money and wealth and business and entrepreneurship as a whole. Rather, the way to do it is, well, you should put in effort over time. You should get really, really good at what you do. And I think the notion there is, people ask like, oh, is dropshipping dead? Is e-commerce dead? Is self-publishing or crypto? What if the models are just dead, right? The models never die. These are really all solid business models. AI is great. Dropshipping is useful if done correctly. Same with fintech and SaaS and crypto. Fundamentally, the business models were successful once, right? Because they are valuable if done correctly. Therefore, if none of these models are dead, it's really just, let me get really, really good at any one of these models versus jumping into the next one. And that is much more systematic. That's saying, hey, let me get really good at one specific thing. Let me learn how to provide value and create something of value and build, a product or a service that people actually want and are willing to pay for, right? And then let me get really, really good at that one thing and make a bunch of money that way, right? That is a systematic way that actually works when it comes to wealth generation. And approaching it like, okay, let me just jump into the next model, you will long run fail if that's how you approach finance as a whole. That is somewhat less personal finance related, than the rest of this video, but I see a lot of young people doing that, right? Like your 15, 16, 20-year-olds. They're like, let me jump into the agency model. Let me jump into e-commerce, right? And then they just do that for a few months. It doesn't work for them, and then they go on to the next thing. If you just keep going on to the next thing, you'll ultimately be screwed over. Rather, just choose any one of those things, right? And go really deep into that thing. You will be so much better off that way versus just jumping along here like this, right? Now, number 6, right, and this is more of a straightforward financial concept, is the idea that you are much better off researching your own investments. That sounds so incredibly logical, but I think the problem is if someone says X investment is great, right? Like your friend says, hey, this meme coin, this altcoin is great, right? Or this stock is awesome, you should invest in it. Anything like that, then you're probably going to have a bad time with that. Or at least if you repeat this, say, experiment 100 times over and you listen to that advice 100 times out of 100, right? You're going to generally lose on average, right? Well, you can think of people investing in a few ways, right? We have fundamental analysis or investing. We have hype investing, so going off hype cycles, and then we have technical investing or going off patterns and chart movements, right? So generally people invest either via fundamental analysis, technical analysis, or hype analysis, right? Going off your friend giving you advice about a stock or something like that is really hype analysis. It's, oh, you heard about this from someone else, you're doing no research, and then you're jumping on that bandwagon. They can say whatever they want, right? But you haven't done your own research. You don't really know what you're doing, right? Hype analysis generally will lose you money. That's not a great way of approaching investments. Technical analysis too, on paper, generally loses your money, right? Like your day traders, your crypto traders, and so on. On average, out of say 100 people that try that for say, over the course of a year, they will lose money, right? The real way that most people, most especially wealthy people and institutions approach investing, whether it's real estate, whether it's stocks, debt instruments, starting a business, etc., it's via fundamental analysis. It is what are the fundamental determinants of the success of this asset or business, right? What's the risk and so on, and then what am I going to get out of that? So if you just take advice from anyone on like, oh hey, you should throw $100 or $1,000 into this call, right, or this this asset, whatever it may be, or this project, this NFT, and so on, you will long run be screwed over. Generally, right? Find your own investments, do your research on those investments, and you will be better off that way. Now, number 7 is a very sort of basic financial concept, and this just relates to your credit score. And I did touch on this in the debt video as well, but this is the idea that, hey, your credit score really matters, right? Your credit score is equivalent to your trust score. It is a bank and an institution figuring out and analyzing, say, how much should I trust this person with my money, right? The more they trust you, the cheaper debt or loans become, right? And the cheaper debt and loans become, the more you can do, the more money you can get at a lower interest rate, and then you end up making more money, right? Like let's say we want to buy a house, it costs $1 million. If you have a high credit score, banks trust you, so you can get more debt, you can get cheaper debt, you can get it at say a 1% interest rate. With a 1% interest rate on $1 million house, you're just paying $10,000 a year to own that house, right? Initially on the $1 million. It's more complicated than that than in a literal sense, but let's just say $10,000, right? Meanwhile, if you have a low credit score, that debt is going to be expensive, let's say a 4% interest rate, and then you're going to have less money because now you have to pay $40,000 a year instead of $10,000 a year just to own that house or to buy it with debt. So in that way, credit scores really matter. Now, one very common piece of bad financial advice there is to just pay the minimum, right, on debt, right? So let's say I spent $400 this month on a credit card and the minimum payment is $40, right? What people very often do and what they tell people to do is, hey, you should just pay $40 off the 400, right? And then next month, if that goes to 450, right? Well, I should just pay $50, right? Really, you will always be better off with your credit score if you just pay the entire balance down, right? So if you spend $400 this month on a credit card, right? Pay your 400, go to zero, spend 400, pay 400, go back to zero, and so on and so forth, right? Generally, if you pay in full the balance on your credit vehicles or your debt vehicles like a credit card, you will have a higher credit score, you'll get cheaper debt, and you'll ultimately make more money. Now, those are the 7 tips. I do have a number of books that I've written about concepts like these and those of related domains that are available completely for free. There's a Google Drive link in the description. You just click on that, and they're just PDFs or docs. You can just download those and read them if you want. No pressure to do so. With that said, I hope you enjoyed this video. Let me know what you want to see, and I will see you in the next one.
So I can nearly guarantee that game theory is something, and a science really, that as an individual, as a player in the game of your life, as a leader, as someone in business or your work, as someone in school, that you haven't properly considered and really integrated the concepts of into your life. And at least in my own life, I can say that game theory as a frame of mind, as a way of approaching challenges, of improving myself, of improving work, and so on, really is just fundamental to that, and is extremely valuable across all of those domains. So in this video, this will not be an analytical deep dive into game theory. This will not have math or anything of that sort. This is really a practical approach to game theory. Also, this video is sponsored by Odoo, the all-in-one business software company, and you can stay to the end to learn more about that. And now back to the video. And I think the perspective on game theory that will most benefit you, again, as an individual, but also in your business and your relationships across really every domain of your life, in which approaching it with strategy and approaching it with rational thought is better than the alternative, which is just thinking emotionally, acting on impulse, not thinking through decisions, and so on. And that's the point I want to start off with, which is that game theory is not practical at all. As in, you've probably heard of the prisoner's dilemma. You may not have heard past or much of game theory beyond that. Game theory is really the art of decision making and the art of strategy, but in a very mathematical and very scientific manner. And once you get into the math of it, there are not many overlays into reality at the individual level, right? I could give you 1,000 examples of games where players make X amount of decisions, and sure, that's the rational decision, that's the rational outcome, but that doesn't impact how you should act as an individual. That doesn't impact the decisions you should be making or how you should be even approaching decision making. But what's really interesting about game theory is that the #1 degree held by billionaires isn't computer science, it's economics, right? And that understanding how monetary systems work is really just valuable in approaching the game of money, really in the game of wealth and work and output and so on. And in a similar sense, game theory is economics, except strip it of the money. And now you have decisions, you have individuals. And game theory really is central to economics in that sense, because it asks the question of, okay, you are in a game, you are in a market, right? There are different players, there are different things you can do, there are payoffs. What decision should you make? Economics is the monetary branch of that in a sense, but game theory strips that down to its core of, okay, well, I need to make a decision. What kind of decisions should I make? And then what kind of decisions are other people going to make, right? That is the concept of kind of an equilibrium. I have not formally studied game theory. I'm not an expert in this. I have studied it to some extent at Stanford University, at Boston University, and at College of Marin. But again, this is not an analytical foray into game theory. You should not watch it if that's what you're going for. Instead, I just want to give you the most the basics of game theory in a sense, as in different aspects of the economics of information, game theory, and so on, but more so what's actually going to impact you once you finish watching this video. And going back to what I said about game theory impacting me, it really is the frame through which I approach things. And that's because game theory inherently is a formulaic manner of approaching decisions and situations, and then ultimately how you go about coming to a course of action or deciding a strategy based on what you think other players are going to do, based on your assessment of outcomes, and so on. The first concept, right, at its core is just that situations are games. A game is not a game in the video game or a board game sense. A game is a situation in which you have actors, or what we're going to call players, and then you have decisions that have to be made, and you have outcomes associated with those decisions. So we have a game, we have players, and then I'm going to call the decision nodes. A node is just a point at which multiple decisions can be made, and then we have payoffs. So for example, let's consider we have a game, and we have player 1 making a decision, so that's just, let's say, U. They can pick between A and B, and then we have player 2 at this decision node, right here, who can make a second decision and choose between C and D. at either of these nodes, excuse me. And then there's certain payoffs associated with the ultimate outcomes here, right? So let's say player 1 gets a payoff of 1 here, 1 there, and I'm just writing numbers. Here we have 4 payoffs, right? So if player 1 chooses A and player 2 chooses D, you arrive at a payoff of 0 and 1. Here, if player 1 chooses B and player 2 selects C, you get a payoff of 2 and 1. There's a lot of concepts here I want to break down. The first is just the overall frame with which we're approaching this with, right? This could be a decision in real life. This could be a decision in which, say, you and a business partner have to either collaborate or you're working independently on projects and you get certain payoffs depending on the course of actions and depending on whether you work together and you're happy about it, you're forced to work together, or you choose to work independently and how you go about that. So the first concept is that the people you're around when it comes to a decision you have to make are players, and you can expect certain things of people, right? There's this concept of rationality, which is that people are going to do what maximizes their own payoffs or their utility functions, essentially. Not all players are rational, and that's one kind of practical problem of game theory, and that people don't always do what is mathematically best for them. But everyone else will act in a certain way, and you have assumptions, right? You put probability distributions on what you think other players are going to do. Then we have decision nodes, right? Decision nodes just breaks down very complex decision processes, as in, okay, I want to start a business. How should I do it? Into just very specific decisions, as in, okay, I can make a decision here. I have different courses of action. I can do, say, I can start this type of business, I can start this type of business, I can start this type of business, right? A, B, C. And then there's also decisions that other people can make that then impact you as a player in a certain game. Then you have payoffs. Payoffs are what you assume the outcome will be. And this is, again, slightly different in an academic context, but for the case of this video, what you assume payoffs are going to be, or for everyone involved, who gets what based on what they want, based on the decisions that are chosen. Okay, so let's assume that this is a new pen, A and C are chosen, right? So player 1 chooses A, and then player 2 chooses C. If that happens, if these decisions are made, then player 1 gets a payoff of 1, and player 2 gets a payoff of 0. Now, payoffs are utility functions, right? Utility, in a sense, is the net result that someone gets from an ultimate outcome, right? A state of a world. So again, in the case of starting a business, if your business does well, you might get all things summed as in, okay, I make $1 million, but I spend 2 years doing it. I spend less time with my family. If you, in a theoretical sense, combine all of that, let's say you get a payoff, a utility payoff of 40, right? And then if you don't start the business, you get more time with family, you make $50,000 a year at your job, and let's say you really enjoy your job and you don't have to work that hard and you don't want to work hard, maybe then your payoff is, your utility payoff is 45. In that case, you wouldn't want to start your business. So utility functions, in a sense, are the net result or the outcome in the state of world that is produced by a series of actions. So in that sense, any decision that you have to make, any process at its core can be broken down into the components of there are actors, there are people who make decisions that are going to affect the decision or the result of these decisions. They're going to affect the game or bring about different outcomes in a sense. There are different decisions that can be made. So each player can make a certain set of decisions, and then there are certain payoffs associated with those decisions. Now there's a lot more that goes into here as well, right? For example, this assumes almost perfect information. This assumes that you know what the other players' payoffs are. This assumes you know the structure of the game, and that's a lot of assumptions, whereas if you take that into reality, you get this very messy situation where not everyone knows everything about the game, about the other players, about their own payoffs even. And so in that sense, some players may have more information than others. That's going to affect the game and so on. But at its core, what we can see already right here is a very structured way of thinking about decision making and about strategy. And that's what I kind of want to emphasize off the bat here about how you go about decision making. If you just break decision making down into its components, right? If you break any difficult problem down into its components, you're going to be so much better off versus what nearly everyone does across the majority of decisions, which is not approach them with data. It's not approach them by thinking through them, but it's just, okay, I feel this way, I think this is the best, I recall this, or so on, and then going about it and committing to an entire course of action because of that. So game theory is not perfect, it is not practical, but as a frame of mind, as, okay, I'm approaching a difficult decision, what should I do? It's very useful in that sense. What it does off the bat too, in a emotional sense, is it forces you to take a step back, right? As in, let's say you get into a difficult situation at school, right? And it comes down to someone thinks you cheated, but or someone is pinning their cheating on you. Your friend won't like you if you go to the professor. Your professor will think you cheated and give you a bad grade if you rat on your friend. In that sense, that's a very difficult decision to make. Emotionally, you're going to think one thing, but if you break that down into its components, you get a much more structured view, right? So in that sense, you have let's say you're player one, you might have player two being your friend, and then you have player three who might be the professor, right? So you've broken down this problem into 3 players, and then you have a certain number of decisions, right? Let's call this D1 and D2. And let's say D1 is, okay, go to the professor, I tell them what really happened. D2 is I take the hit to my grade. And then we have payoffs associated with those actions, right? So we have P, and this P, let's say, gives you a negative payoff of 14. And this of negative 12, because whatever happens, you're going to be in a bad situation. But then there's also player 2 who's your friend. And in one case, if you do screw them over, let's say player 2 is going to get a payoff of negative 30, because they're going to get, they're going to have to drop the class. In case 2, they get a payoff of 4 because they cheated and got a better grade. And then the professor is kind of indifferent. The professor doesn't really care. We've now broken a difficult decision, a difficult problem into 3 players, 2 decisions that you can make, and based on just what you think about the decision, the payoffs associated with them. Of course, in a mathematical sense, you're not going to know these numbers, but simply the process of let me step back, let me analyze this situation, here's what I can do, here's what other people can do, and here's how that affects me. That's an incredibly useful process beyond school when you step into business. When you step into, hey, I'm running a business, I can allocate resources here, I can allocate resources there. There's a whole lot of things I can do with certain partners, with people, with my effort and my time and that of employees. Whereas thinking of things in a strategic, an inherently strategic sense will beat any other way of just going about those decisions. Now it turns out that this is exactly how banks, insurance companies, all those types of big organizations in large part go about viewing the world and making financial decisions because of it. For example, let's say we have, asset 1, which produces, let's say, a yield of 1. Here, let's not go 1 and 0. Let's go 3, 2, and then we have asset 2. That produces 2, 3, and then we have 2 states of world. So we have state 1, state 2. So let's say, for example, that state 1 is a stock doing well, or a company doing well. State 2 is a company not doing well. So let's say that's their earnings call. Asset 1, if we buy them, if the company does well, will produce a monetary yield of 3. If it doesn't do well, if the company doesn't do well, so in state 2, it'll produce a monetary yield of 2, and then vice versa for asset 2, that'll produce 2 instead of world 1, 3 instead of world 2. And then we have certain costs associated with these assets, right? So this may cost $1.50 to buy, this may cost $1.60 to buy. What banks do, what insurance companies will do, is break down the world, and I shouldn't say just banks, but investment firms will break down the world into certain assets, certain states of the world, and make decisions because of that. Insurance companies too, for example, right? There's a whole branch of kind of information economics, game theory, relating to moral hazard, which is the idea that players in the game are going to respond differently in an insurance sense based on their own characteristics. For example, I'm more likely to buy health insurance if I'm going to die from cancer in 2 years because I smoke, a pack a day. So considering that's how some of the biggest companies in the world, in a mathematical sense, analyze and make decisions that affect trillions of dollars, considering how that's what CEOs do, how that's what presidents do, and their analysts, right, do to come to decisions, that really is something that if you take it into your own life will be just as valuable. Now, everything we've touched on thus far is you as a player. What that means is the game is a constant, right? So you have certain decisions that can be made. You have certain payoffs that you think will come of your actions or decisions or that of other players, but you cannot fundamentally change the game. Now, that's the thing about life. That's the beautiful thing about life. That's the beautiful thing about running your own business, right? About being in your own relationship with someone or whatever it may be in whatever context. And that is, you can change the game. You can affect the game. Now, game theory is just one side of the coin. Game theory is where you're studying decision making, you're studying strategy given games as constants. Now, mechanism design, and here I'll write that down, is the other side of the coin, and that is taking behavior as a constant, taking rationality as a constant, and then designing games to get certain outcomes. So an example there would be, let's say we're a company and we know that our customers want to make money and don't want to put effort into making money, right? That's kind of like the scales there. You could ask the question of how do we design a rewards or incentive program that maximizes the amount of customers that are going to use it. In that sense, behavior is a constant. The pool of potential customers, let's say, is a constant. It's just a question of how do we design the game itself? How do we design the decisions that can be made? How can we set the payoffs and so on? So the beautiful thing about that is that if you apply mechanism design to your life, if you become the game maker, then you can, in an academic sense, on paper, you can design your life to get a certain outcome. Given that, for example, that, let's say you want to be healthy, you want to spend time with your family, you want to travel, and you want to make good money doing things you enjoy, whether that's $1 billion or $100,000 a year, whatever it may be. You now know the payoffs. You know what you want. You know what you don't want, and not in a literal sense, but you have some, ordinal ranking there in a sense. Well, now how can you design your life to bring about those outcomes? And that's what every business guru is telling you to do in one sense or another. They're telling you to do a wake up, a morning routine. They're telling you to do X, Y, and Z in your business, to use these SOPs or whatever it may be. Those are all fundamentally structures that affect the game that is your life to theoretically change the outcome. That, as in, they should, if they work, will change the outcome of the game. One useful thought there as well is that if we think of decisions as, if we think of ourselves decision-making wise as constants, that makes designing a game a lot easier. For example, it's very hard to go against your natural will. So let's say we want to wake up, let's say we want to put 4 hours of extra work in the day. There's a few things we could do there. One of which is, okay, I want to work more. I'm going to force myself to do it through pure force of will. I'm just going to find time and I'm going to get it done, right? If you do something like that, you're now going against you as a player. You're doing something that will bring you pain, bring you suffering, that you haven't structurally altered things to do. You're probably going to fail.
Same thing with New Year's resolutions and people who go to the gym, right? They say they're going to go to the gym. They just say, okay, I'm going to do it. I bought my membership. And then they don't structurally change anything to bring about the outcome that they want. And so they will fail. Now, if you assume that you are lazy, that you will default to your system, to the game, to the decisions that are presented to you, to what will bring you less suffering, then it's just about designing the game. Then it's just about, okay, how can I change things so that I, as a player, will make the best decision available to me, and that best decision will bring about the best outcome, or the outcome that I want. An example there is, let's say going back to work. If you go to an apartment in a new city, let's say you move cities, you call your family once a week, you don't see them in person anymore, you don't really have any friends, you're just in this apartment, right? And you have your computer, you have good Wi-Fi, you don't have much else. What are you going to end up doing? You're going to end up putting 10 hours, 12 hours a day into work. And over time, that will probably change how you view things. That will probably change what brings you purpose and joy in your life, because now the game becomes, okay, I'm in this apartment, there's really nothing else going on. All I have is my computer, and I have progress to make on whatever I'm trying to work on. Like, let's say you want to write a book, you need to write 100,000 words. As opposed to just forcing yourself to write the 100,000 words, you've done that. You've structurally changed the game. You've put yourself in a new place. You've removed a lot of the other decisions that you could have made. For example, going out today with friends, or just, let's say you used to live in a nice house, right? Like, let's say I could go and I could watch a movie on the couch. Now you live in a one bedroom. You can't do that. You have no friends. You can't go out. All you can do is, say, write your book. But over time, writing the book then becomes enjoyable because your brain has nothing else to focus on. All you can do is continue to improve at writing the book and researching and so on. Now, what's going to happen there is you will ultimately write the book. You will write it much faster, and you will write a better book than you would otherwise. That doesn't say that those can come without costs, right? You saw your friends less. You didn't do anything you would prior have considered as fun, but you did get the book done. So that's an example of I'm drastically changing the structure of the game to bring about an outcome that I want, with that being writing the book. In a pragmatic sense, maybe that's not what you want, but all of this is just based on what you want. If you really want to spend time with your family, if you want to go out all the time, if you want to party, well, change the game to bring about that outcome. Structurally change your life, change the decisions you can make. And ultimately, that will put you in such a better just frame of mind, and also just ultimately better outcome versus the inverse, which is, okay, I'm going to try this, I'm going to try this. You're not really thinking about how you actually try things, how you approach trying things, and so on. So once again, whether you view yourself as a player in a game when it comes to approaching difficult decisions, or when it's you actually making the game, with the game being your life, overall, the frame of mind that is presented by game theory and by mechanism design will really help you in that sense. And so I urge you to research those things on your own time. Again, I don't think the academic side of those things are valuable to you, or will be valuable to you by any means beyond just intellectual interest. But in terms of the general concepts, so again, the value of information and rationality, and payoffs and decision nodes and players and indifference and things of that sort, just approaching things with that frame of mind, stepping back, thinking through decisions, that is such a better frame of mind, that is such a better way to approach decisions and challenges versus the polar and unfortunately the more common means of going about those things. Now, before we go any further, I do want to mention a company called Odoo. They are my partner for this video. They are a suite of business tools, a hub for business in a sense. And I polled you guys on YouTube, because of my audience, and about 60% of you said you wanted to start a product or a business. If you do that, Odoo is really the best place to do so. I will release a video in a few days. It may have already come out. About a business I'm starting that I'm completely running through Odoo. They have everything from a CRM and sales tools to product and inventory to accounting and compliance, and really just this whole range of business apps that as they do come together on the platform, will seriously help you with synergies, right? Efficiencies, just eliminating the headache of running 15 different apps for your one business, and then ultimately make things easier and cheaper and better for you. So whether you're already running a business, I highly suggest starting with Odoo, or you're looking to start one as well. They will help you do that. It's also free for one app. You can click a link in the description. You can go just play around with their at least one app for free, and then you can also pay a small fee for access to all of their apps. So again, I'll break down how exactly I use them in a future video with a business of mine. But other than that, that does wrap up the video. So thanks to Odoo, and then also thank you to you for watching this video. And I do hope that you walk away with at least some intellectual interest in game theory, and also just that really fundamental thought here, which is, okay, if I strategically analyze my life and the situations presented to me, I will be that much better off in terms of how I go about them and then the outcomes that I arrive at. This is going to be quite the change in subject from last week's video that was about self-publishing. In this one, we're going to jump to the subject of debt, and that is primarily, well, how do you get less of it? Now, I filmed a full 3-hour video on the history of debt, the whole context of debt and how to approach debt, good debt versus bad debt, just the whole domain of, hey, you owe someone money. What do you do about it? Should you do it? When should you do it? That's not what we're doing today. If you want to see that video, you can click right up here. Instead, in the next few minutes, I want to just cover primarily the 3 approaches that you should take when you have a lot of debt, the 3 ways basically to pay off that debt and get less debt. In addition to that, we'll cover a few of the general things you can do right now beyond just, those frameworks and approaches and strategies, and then basically a secret sauce strategy to just cut a lot of the debt right now down that you owe. I have no course, no nothing to sell you, and again, if you do want to see the basically expanded version of this video, you can click right here. So the subject today is going to be, once again, debt, and I'm going to assume a few things about you. First is that 1, you have a lot of debt, 2, you're relatively young or you don't have a very high income, so in some form you are struggling to pay off that debt, and then 3, you came to this video, you clicked on it, you're wondering, hey, what do I do about it? The general, core focal point that I want to impart first off is that there is no secret sauce when it comes to, getting rid of a bunch of debt. The only secret sauce is bankruptcy, right? Which is, hey, next week you're not going to have any of the debt that you have now. So I want to start there, kind of start at the end. The problem with bankruptcy comes down to your credit score. And we covered this in a different video, but your credit score is basically your trust score when it comes to banks, the government, other people deciding how much they trust you and whether they should trust you with a certain amount of money. So if you have, say, an 800 credit score and 850 is the max on the popular scale, then you're going to get super low interest rates. You're going to basically have infinite money that people will give you to do whatever you want with. Now, if that, 800 is, say, a 500 flat, no one's going to give you any money, and if you want to borrow money from people in the future, well, you're going to be screwed from day one just because of that little number. Now, the problem with declaring bankruptcy is that no one's going to lend you any money for 5, 10 plus years, right? You're going to have a super hard time just finding money to do anything. And the problem with that is that debt is not inherently bad, right? If you came to this video, maybe you have a lot of debt for something that wasn't worth it, but there's an equally good chance that you have debt from school, which is a comparatively valid use for it. You have maybe debt from, flying to visit a sick family member, or buying a mortgage on a house. Things turn south, maybe you lose your job and you still have that mortgage on the house. So debt is not inherently bad,
declaring bankruptcy, so the easy way out there is just going to essentially screw you over from doing any of the good things that you can do from and or with debt in the future. So that is not the solution off the bat. It is an option, it is a way out, but you really have to have just no way of paying off the debt possibly before you consider bankruptcy. Now I want to stop here for 1 second in that debt can be crippling financially. It also 1000% can be crippling emotionally. And if you're struggling, I suggest that you consider therapy with the sponsor of today's video, which is BetterHelp. Online therapy is a safe space to talk and receive guided help from a trained mental health professional. And this doesn't just make you feel better, but also is a portal to personal growth that helps you better understand yourself, overall just develop healthier habits and also learn effective ways to cope with, and solve problems like debt. You do not have to be depressed or have anxiety to go to therapy. It's just generally beneficial across the board. And options like BetterHelp you can do from the comfort of your home, and BetterHelp is very affordable. In fact, they've completed nearly 400 million sessions of online therapy for around 5 million customers. That's like 1.5% of the entire United States. You can go to betterhelp.com/Jon Law to get a discount on your first month of online therapy. And with that said, let's get into number 3. So the alternatives, like I said, are not a done for you type of thing. There is no secret algorithm there. All it comes down to is, hey, you need money to pay off that debt, and B, how do you go about paying off that debt? So that's what we're primarily going to cover today. Specifically just what are the best approaches in the short run, in the long run, to pay that off as quickly as possible. And hey, ideally, if you can keep up with minimal payments, right, then your credit score stays high. And if you want to get future debt for valid, economic reasons, like say getting a house or whatnot, or maybe starting a relatively low risk business, then you can do so. And also having a high credit score makes it a lot harder to actually go into very serious debt for the reason I'll describe now. And this is actually the first subject and the first debt kind of strategy that I want to cover. So let's say you, have a, not even 750, let's go 820 credit score. So you've been paying back your credit on time perfectly for 15 years, and a lot of it at that. And you have one, say, line of credit that you can't pay down, that's a 20% interest rate, and let's say $150,000. Well, if you have an 820 credit score, what you can do is go to another lender who, based on your credit history, is going to give you, say, $150,000 at a 3% interest rate. And then you take that 150K, you pay down this 150K, and now instead of paying 20% a year, so that's 20%, 30 grand a month, that's roughly $2,500 per month there. That $2,500 per month suddenly becomes 3% of 150, which, just quick math here is going to be like $4,500 a year. Divide that by 12, you're talking, $400 or so per month, right? So immediately, if you have good credit, you're going to get your credit score down, or your monthly payments down on this debt from $2,500 to $400. That's an 80+% reduction there. Now, you probably can't do this if you have a lot of debt, but the concept here is using other debt to kind of quote unquote refinance your current debt. So what that means is, and I want to touch on this as well, is first just write down and kind of index the debt that you have. So let's say, for example, you have 3 sources of debt, right? You have student loans over here, you have your credit score over here, and let's say you have your mortgage over here. And let's say, for example, your credit score is 25% interest rates, so roughly 2% per month. Student loans, 14%, and your mortgage is, let's say 8%. So these are the 3 kinds of debt that you have. Well, what you want to do in the concept of refinancing is looking for other sources of debt that you can use that are cheaper than your current debt. And that breaks down into the 2 principal kind of aspects of debt, which is the principal amount, not to reuse the term there, and then the interest rate, right? So we have the principal, and then we have the interest rate, right? So if you owe $100,000, $100,000 is your principal, and then if you're paying 20% a year on that debt, 20% is your interest rate. Now, The real killer when it comes to debt is not even the principal, it's the interest rate. And that's the problem a lot of people are dealing with now when it comes to especially student loans, but also things like credit card debt, right? Is that they're paying, say, the monthly minimums, if that, so then the principal isn't going down, or the principal's even going up, and then just paying down the interest, it's what's killing them. And you obviously know this if you're in a similar situation. So in this case, let's say that you have D over here, and D debt source is a credit line. And if you open a credit line with, let's say, this bank, and maybe they'll give it to you, maybe they won't, you can get a 10% interest rate annually on that debt. So if you're in this situation, what you can do is, hey, look at this 25%, and let's say the interest rate's 25%, let's say the principal amount is, $20,000 on that. You want to go over here, you want to get $20,000, pay down the $20,000 on B, on this credit, card debt, and then now instead of paying 25% a year, you're paying 10% a year, right? So 25% of 20 is $5,000 a year. That comes down to 10%, which is, $2,000 a year. So you can cut your monthly payments by a few $100 there. So that's the concept of debt refinancing. In your situation, that's just looking at, hey, here are all the possible ways I can get other forms of debt or borrow money. Well, what are the interest rates on those, and how do they stack up to the interest rates on my current debt? And if there's any overlap there, so if you can go and get debt at an interest rate that is cheaper from a legitimate source, right, than any of the current debt that you have, well, that's when you want to go and refinance there. Now, the other kind of implicit strategy here is just pay down the highest interest rate debt first, right? So let's say your student loans are $4,000, this is $20,000, and then you have $200,000 out on a house. Even if the student loans are at $4,000, and you feel like, hey, I can pay this down, I can just get it off my chest because I'm not paying for this anymore. The real killer here is the 25%, the really high interest on the credit card. So that's what you want to pay down first. So 2 strategies thus far, right? Refinance, so look for other sources of debt and use that to cover your current debt or kind of close out your, say, credit lines or your loans. And then number 2, just pay down the high interest rate debt first. Okay, so the third approach here relates to, hey, what should you pay down first? So let's say you've exhausted all the options when it comes down to refinancing. So going to that external, potentially new source of debt or credit, and then taking that money to pay down or completely, or just part of it, right, the current debt that you're dealing with. If that's not an option for you, then it's a question of, well, how do you use the money that you currently have to pay down this debt that you're dealing with? I'm also going to assume that you can't just, pick up some more shifts, get another job, and then put that extra money toward, paying down your current debt, and also make sure that money, the new, extra income that's coming in, does significantly impact, the current debt that you're dealing with. So the best approach here is to look at all the ways in which you're paying debt, or the different kind of credit lines that you have out there, and then find the one with the highest interest rate, and then pay the minimums, the monthly minimums on all other debt sources than that one, and then put all the extra money you can toward that highest interest rate, in this case, source B, so the credit card type of debt that you're dealing with, right? So, for example, in this situation, just to back up, again, we have student loans or debt over here, we have a mortgage here, and we have credit card debt here. Let's say your monthly mortgage is $1,200. Your student loan or your student debts minimums are $600 a month, and for credit card, it's, let's say, $200 a month, right? So even though you're paying $600 a month here, $1,200 here, $200 here as minimums, this doesn't mean you should just put, say, $1,000 into this, $1,400 into this, $400 into this a month, if that's the amount you can put toward your debt, but rather pay this $600, pay this $1,200, and put everything else you can into the $200. And then once you have paid down fully this 25% on the $20K, right? So let's say we fully pay off the credit card debt, then you switch over into, well, here are my other 2 sources. I pay 8% interest on this source of debt, 14% over here. We'll now just pay the $1,200 here, but don't pay $600, pay $1,500 a month if you can, right? And then you take that amount of money, you fully pay this down, and then you shift into that last source of debt. And if it is truly impossible for you to work hard, and if it's truly impossible for you to pick up extra jobs or just work all that you can, make as much money as you can, and put all of that toward your debt, and you're just saying, hey, I still can't even pay down the interest, only then is when you consider bankruptcy. And again, bankruptcy is a valid option. It just kills your credit score because really, really bad. And then finally, just negotiate, right? A lot of people have a lot of debt in the US. We're talking trillions and trillions of dollars on all kinds of debt, whether that's, student loan debt, your mortgages, credit card debt, gambling debt, just whatever that may be. And what that means is the companies that you owe money to, the people, whatever that may be, are likely very used to people being in your exact situation. And what that means in turn is, well, just talk to them. And maybe they have some sort of approach, whether that's, a lump sum payment up front or a, payment plan that just gets your monthly payments down, or a deferment plan, whatever it may be, just talk to them, try to negotiate terms, and they'll be lenient, more often than when they won't be, to some extent, right? That's not saying they're just gonna be like, hey, you're off the hook, but maybe you can negotiate that interest rate down a few percent, just defer payments by 6 months, whatever it can be, to just give you a little bit of breathing air that you need to just pay down what is the highest interest rate and then get on to the next source of debt. Now, overall, there is this kind of sunk cost fallacy when it comes to debt, where it feels like if you're just, above water, or you feel like you're drowning, metaphorically, so to speak, in debt, you feel the need to go and do crazier things or riskier things to try and just get back to where you were, right? So that's where you see a lot of like gambling, very high risk investing, taking out more debt to go and say do, day trading or buying crypto or whatever that may be. The general approach that you have to take, and I say this with emphasis, you have to take this with anything finance related, much less debt, is that it is inherently emotional, but the way you get out of it, right, is with logic, it's with reason, right? Finance is inherently a numeric game, it's an algorithm. So the way you win that game is similarly by breaking it down, by making a plan, by doing what you can so that the numbers work, not so that you feel like the numbers work, or not so that you feel like, hey, maybe I have a shot of just getting back to where I was. I get it. There's such a deep, emotional relationship we all have there with money, with our standard of living, with how other people perceive us. But in a lot of ways, again, you're playing the wrong game there when it comes to finance, personal finance, and debt. That is the video for today, and I will see you in the next one.
So I've started well over 15 businesses over the last 8 years or so of my life, and that has cost me an incredible amount of time and money, and not in a good way, really. It has set me back by years. In the next 3 or so minutes, I'm going to get into why that is and how you cannot be basically as dumb as me. This is a list of just some of the businesses I was involved in. By business, I just mean something that either is meant to make money, or a physical entity, or selling a product or service. Again, pretty much everything on here was just some sort of popular hype thing at some point where, hey, if you Google how to make money as a young person, right, you're going to get basically this list. Now, I think not just me has been in this situation. I think a lot of people are in that situation, and it really is hurting a lot of people. And the reason for that initially is that the barriers of entry to starting a business have really fallen, as in to create, say, a website, a product or service, to pick up the phone and call people, to sell them something, right? The barrier to entry to all of that has fallen, and that's a really good thing in a lot of ways, but it's also a bad thing that the reward cycle associated with starting a business is now skewed against the effort you need to quote unquote start one. By that I mean, when you start a business initially, and by start I just mean pick a name, create a website or a landing page, or pitch it to a few people, or create a logo. All those things are really, really fun. You're just getting started, you're just selling it, you're just sinking your teeth into it. The novelty is right here on this curve, right? Whereas it's the most fun and it is the least difficult throughout the course of the lifespan, right? The life cycle of the business. So again, that's those things like name, landing page, pitching people, etc. Meanwhile, making a product or service, like the actual core of what a business is really, really difficult. So what happens is you pass this first phase of the novelty, of the least amount of difficulty, and then you get into the second phase of, okay, well, now the novelty is wearing off. Now you actually have to go and build this thing and create something valuable, and then the difficulty just exponentially multiplies. And that's why you can start, at least in my case, all these types of things. It's really fun, it's not that difficult. You learn a little bit, but really not that much, because you just haven't been doing it for long enough. And then the novelty dies, the difficulty increases, and ultimately you fail, like in my case, nearly all of these did. The result of that for society as a whole, and not just me, is that the count of businesses, the number of businesses that people start has just gone through the roof. As in nearly everyone who's under the age of 25 now has some sort of side hustle, has some sort of business, has some way of making money outside a classic, say, 9-to-5 or job. Meanwhile, the impact of business, right? The profit, the revenue, the number of customers, all that kind of stuff has really just decreased. And that's why you have all these high schoolers starting their agencies, and then the average return to that agency, to starting that business or any similar one, really has just fallen. I'm phrasing this as a bad thing, right? And I think the logical counter argument to that is, well, is there not value in doing something and starting something? And I will argue yes there as well, and that, say, to just put the rep in of starting a business is valuable, to create the website and talk to people about it. However, that's an absolute scale. And on a relative scale, if you are going to go through the motion of starting a business, you're going to get so much more out of what I'm about to describe here versus, like I did, start, say, 15, 20, whatever the number is, different businesses that are in totally unrelated industries. And what that is, and the question I'm going to pose to you is, what do you actually want out of starting a business or entrepreneurship if that's what you choose to do? For a lot of people, it is just the dopamine, it is the excitement of starting a business. And that's why they get caught in this first phase here, which then dies out over time. Meanwhile, the actual curve of a business over time, with time being the x-axis here, looks something like this with regard to whatever you want out of it. Most people want some combination of these things. So either you want the business to financially do well, you want the money, you want the freedom to do what you want, the impact, as in the ability to give back of the business and so on. That looks like this. You have this first phase where, as we just stated, right? It's novel, it's exciting, it's not that difficult. You're just setting up the infrastructure. Then you get into the whole months, the years, the decade, whatever it is, of grunt work here to actually build the thing. And then you get this exponential curve of results once that's all set up, and it's just really a matter of scale and really scaling something that already works and delegating and automating and all those kinds of things. So over the last 8 years, what I most often did was get caught up in this first phase here. And then I hit phase 2, right? Gets more difficult, it's not as fun, and then that's where I died, so to speak, in these businesses, or the businesses at least died. And then the same happens for nearly everyone who, especially who's young, but across the board, who starts any sort of business. And then no one gets to that stage 3 of the results, the exponential results, and really getting to what you actually want. Right? So the point I want to make is that depth wins as opposed to breadth, and that the actual catalyst of a successful business of these 3 things is this phase 2. It is the effort and the experience and the connections you've derived from putting in a lot of effort over a lot of time at a very specific thing, at a very specific product or service, right? And you can build cross-disciplinary skills like learning how to sell, learning how to build, right? All these things while doing one very specific business, but you are ultimately going to be so much better off in just pursuing the one business, the one model, the one product or service, or at the very least one industry, versus this trying all these different things like nearly everyone does today, right? At least everyone young, and especially those in the sort of influency online sort of digital entrepreneurship or nomad culture. We've all seen graphs that look like this, but generally what I want to say here is just that the probability of progress is never a given. It's never going to be a certainty that you're going to succeed, but the probability that you succeed is going to be higher if you just do that one thing versus try all these different things. Another counterpoint here is, well, we've all heard of someone who gets into crypto and they play around with it. They don't really know what they're doing, but they just strike gold and make their $1 billion and walk off into the sunset. That is the exception. That is the 1 in a million to the rule of, okay, if you just stick to one thing, you get really good at that, then you're going to succeed over the long run. So I urge you to play to that rule, not to the chance that, hey, you happen to get lucky. And in that sense, I think if you want to sum this video up, right, your business count, the number of businesses you've started, is practically equivalent to your body count, and that generally you want to keep it low, and quality matters a lot more than quantity. So if you think of the amount of businesses that you start like that, I think, and you frame your where you're at in entrepreneurship and starting a business like such, you will ultimately win over the long run. You will get out of phase 1, work your way through phase 2, and then finally get to that exponential curve of stage 3. That's largely the video on my spiel for today. What I do want to cover is this free just drive with a bunch of resources. That's totally free. Just a link is in the description for that. You can see a number of books that I've written there, as well as resources we use at my companies. With that said, I will see you in the next one. So I first wrote a book about the stock market in general, personal finance, when I was about 14 years old. That covered not just the stock market, but pretty much this whole breadth financial and personal finance related subjects like assets and liabilities, earning money, spending money, and so on. And a lot of people found the value in that, not necessarily as per the stock market related information, like how to pick stocks, what the stock market is, and so on, but more so about that general breadth of information relating to investments and personal finance as a whole, right? And the book was targeted toward teens. There was a whole range of customers that really enjoyed that for the value of the personal finance information, right? So there were seniors that read it who were like, hey, I didn't know that, what a credit score was, or what the value of diversifying your investments are. And they really enjoyed it for that reason. And I walked away from that thinking, there is so much information out here about personal finance, but there's also such a lack of common understanding about those subjects. And you are seeing that in financial trends today, right? We're not doing well in the US, nor really the world as a whole when it comes to personal finance, right? Especially younger generations, like your Gen Zers. They're making less money on average. They aren't saving as much. And in terms of spending, right, credit card debt is at an all-time high. College and student debt, right, it's just going through the roof. And there's a lot that goes into that. But I think as a whole, the situation would be better, and everyone would be better off if we all did understand more about just your basic concepts within that domain of personal finance. And so that's why this video will be the first in a series where I break down the personal finance concepts that I have found most applicable in my life and that I think could help the greatest volume of people. And I want to do this all in a way that is hopefully engaging, right, and enjoyable for you. Finance as a whole has quite a bad rep. Like I remember I presented in a classroom last year about basically personal finance and investing and the stock market and so on, and people were just dead, and they were fully clocked out of that. And I don't think it should be that way, in that A, money is important and personal finance is something you will absolutely do. B, it's kind of fun in theory, right? Like this is you making money, making decisions that will impact you in the future. And then C, there's a lot here to cover that I think can be sort of taught in a more enjoyable manner than you'll get from, say, a textbook or a teacher or many other videos online. So the first video that I want to cover, and the subject of today's video, is going to be that of debt. And debt is a really interesting subject in that it gets a horrible rep overall, right? And that the number one thing in personal finance that you're taught is, hey, debt is bad. You don't want to be into debt. Debt is equivalent to bankruptcy and so on and so forth. It's something you should get away from and then go on and live your life with no debt. Now, I think what's interesting there is that view of debt is almost the inverse of the actual applicable nature of debt and how debt is actually used in the modern world today. And I'll explain what I mean there. But to start out, right, the subject, again, of this video is going to be debt. And what I want to make clear off the bat is that I am not for debt in this video. I am not saying, wow, you should go get into debt. But what I do want to do is just bring the contextual awareness, really, and information about debt and how it's used, and the good debt and the bad debt and so on. Because it is something, again, like personal finance as a whole, that you are absolutely going to be involved in at some point. So I want you to feel comfortable with the notion of debt because, again, it will severely impact, whether for better or worse, your financial sanctity and health and growth over the course of your life. And then B, I think you'll feel better walking into any situation relating to debt if you know the kind of information that I'm going to be sharing today. And that applies to everyone, whether you're 65 and you've had your mortgage for 25 years and you want to retire, or you're a student and you're thinking about, well, should I take out student loans for college, or should I get a credit card? Should I pay down my credit card bill every month or not, or just pay the minimum, right? Those are all questions that fundamentally relate to debt, and those are some of the questions that we're going to tackle today. So I first want to touch on debt as a whole and how it's used in society. Debt essentially is a form of obligation. It's like, I owe you something and I will return something to you at some point of time. And that doesn't mean you're going to return the whole thing at one point in time. There's a whole variety of setups there. And debt is almost synonymous to credit, right? A credit-based system is, oh, I owe you something, I have it on credit. Those are basically synonymous concepts. And the concept of debt and credit goes back thousands of years, right? People quite literally thousands of years ago were engaging in all kind of economic activity based on debt, based on basically IOUs. And then as you saw modern stock markets come into play, right, and the modern financial system, debt became even more important as a concept. And it is really the birth of the overarching financial system and the capitalist system that we see today. And the Ducks were an example of that, where they leveraged debt in a lot of early expeditions and credit in a way that just hadn't existed before. And this notion, not only of the stock market and shares that they came up with, but also just debt and credit as a whole, laid the groundwork for the, again, workings of the modern financial system. And by that, I mean, consider the biggest global, the biggest institutions essentially in the world, right? You have your governments on one side. I'll use a different marker for this, right? You have your governments, you have your banks, right? So that breaks down into your state banks and then into your private banks, right? These generally are, right, the biggest institutions in the world. You have governments that run societies and people, and then you have banks. Here, I'll write that out, of which there are state banks and private banks. And state banks kind of ties into government as well. Beyond that, you also have private institutions. Let's just get a different color out there. We'll call that P for private companies or institutions. And let's think about how debt relates to all three of these kinds of organizations, right? On one side, you have the government. How much debt, right, does the US government have? Let's say 40 odd trillion, like 30 plus trillion, right? And I'll put up a screenshot of what that debt counter looks like right now. There's a pretty cool website where you can see actively what the debt looks like in real time. The government runs fundamentally on debt, right? And that's not a bad thing by any means, and we'll come back to that, but just as a whole, right? We owe a lot of money, we owe everyone money, and we can do things because we owe a lot of people money, right? The government prints money, they owe the whole, other states, they owe people, they owe companies money. Because of that, they're able to function, right? An example of that is the bond market, right? Government bonds are essentially a form of fundraising for the government, where they get money from people to go do things like, let's say, build roads, and then they pay that money back, just a little bit of it over time. Right, so say you're a city, right, or a town, and you want to build a bridge. Either you can try and raise the money yourself or just fund it out of pocket. But let's say that costs $1 million and you don't have $1 million, right? That's bad. You're not going to build the bridge. Everyone is worse off, right? The alternative is to put out bonds, which are, again, basically a I'll pay you back kind of deal. And then let's say the people in the town buy $1 million worth of bonds, right? The government takes that volume of bonds, they use it to build a bridge. Well, now the consumers, the customers, the people in the town are better off because that bridge was built and the government got the bridge built, and then they're going to pay that back a little bit over time, and therefore they were able to afford that, right? As a whole, that's a win-win, and that basically at scale is how governments operate, right? Now we can think about banks, right? Banking fundamentally is about lending, and we'll get into sort of the Federal Reserve and fractionalization and how really the whole financial system works. But as far as banks go, their whole business model is when you deposit money in a bank, they take that and they lend it out to other people, right, in the form essentially of debt or credit. And then essentially they owe you the amount of money that you've deposited with them, but only when you actually take it out of the bank. So if you take it out of the bank, then they'll return essentially their debt or their credit to you. Meanwhile, they just made money basically leasing your money by giving you a return on it. if they even do that, and then go and giving that out as debt to other people. So banks too just functionally run on debt, on owing other people and organizations money, right? Now in the state case, you see this at a massive scale. Private banks are the exact same thing, right? Every big bank, every bank period will do this. Their business model is that of debt and credit. And then we can think about your private companies. Let me write this out. So, and this ties into the stock market as well, and also just venture capital, private equity, and so on. If companies want to do something, they will leverage oftentimes some form of debt to go and do that, right? Lines of credit are a very simple version of that, where there was a company I used to do some work for, and they, as opposed to raising, I think it was $40 million, what they went and did is they got a line of credit for $40 million. And that just means they can pull on that $40 million if they want to finance any sort of short-term obligations they have, if they want to build a new office, right? They can use that $40 million at a very low interest rate, because it's a line of credit provided for 10 years, right? We return that $800,000, but let's say that we invested in the stock market or in bonds, and that turns into 1.3 million, right? So now after 10 years, we got a loan for the $1 million, we paid that back, but we made 1.3 million in those 10 years. We paid back the $1 million, we have $300,000, and we have an asset that's paying us $100,000, right, indefinitely. So that's just an example of really the spread, and what I do want to highlight is just the spread in returns here, right? This is the power of debt. In this case, you make a 10% return on your money. On this case, you make a 500% return. And the concept here, right, it may sound foreign, like, oh wow, the amount of money you're making on $1 million asset, right? We can think about this in a very simplistic manner, right, through mortgages. Everyone has a mortgage. They're everywhere. We don't think about them really as debt, but that's exactly what they are. You know, when you get a loan from the bank to buy your house, all you're doing is just taking on debt. And the exact same concept applies with every other asset. Let's just consider, right, a mortgage for a house, right? Let's say this is a $5 million house, right? Very expensive house. But let's just say that's a $5 million house. You once again have two things. Let's say you have $5 million in cash, right? The wealth of individual A is $500,000. And they can do two things with this, right? They can buy their house. That costs them $5 million now. Or they can get a mortgage, and their cost for the mortgage is 20% down on a $5 million place. So that's $1 million. And then let's say it's a 30-year mortgage. So they have to pay the remaining $4 million back over 30 years. In the case where they spend $5 million on the house, they have $5 million less dollars. That sucks, right? But they get the house. They own it clear and outright. In this case, you spend $1 million and you now own the house. Sure, you owe the bank $4 million, but you own the house. You can live in it, right? And then you have you spent this $1 million, so you have what left, right? You have $5 million minus $1 million. You still have $4 million, and you get the utility, as in living in the house. So our $5 million, let's say we proceed down this path, right? We use debt. We spend $1 million on the house, we get the house, and now we have $4 million. Well, we still have $4 million in cash, right? We get the utility of the house, we're living in the house, but we have $4 million. Well, now what can we do with the $4 million? Let's say we are risk averse, so we put half of it into bonds, right? And bonds are a kind of debt instrument that I'll cover a little bit later. Our bonds are going to make us right now, or CDs, money market funds, about 5%. Then we take the other half and we're going to put down a stocks. Stocks on average, let's say, will generate 10% a year, right? So we're going to take $4 million and we're going to invest it here. That out of the $2 million, right, the 50% that goes to bonds, we're going to make 5% on it. So that's $100,000. Let me not write this sideways. I'm going to make 100 grand. And then this 10% is earned on half of the 4 million, so the 2 million. So we're making $200,000. And that means in year one, we make $300,000 with the 4 million. And sure, we're paying the bank, every month, every year to pay them back on the loan or the debt for the house, but we just made $300,000. And the purchase price of the house is $5 million. That means we paid for 5% of the house just by taking on debt, right? And that's just what we made in year one. In year two, we'll have slightly less money, but that $300,000 is just what's earned in year one. In year two, we'll have paid the bank, let's say 100 grand. So we have, instead of 4 million, we have 3.9 million. That 3.9 million is going to make slightly less than 300, but let's say 280 grand. Well, now in 2 years, we just made $500,000 that pays for 10% of the house that we can do whatever we want with, right? So and that's why everyone uses a mortgage. It is just a better use of your money. So in that case, here I'll erase this. It is clearly better to use debt to buy the house. What I want to do now is think about how that's relevant to you, and we can think about just the underlying concept and utility of that. And then I want to lastly touch on some specific debt instruments. So let's say bonds, CDs, money market funds, and then a really core concept that I want to discuss in the last few minutes here will be about is good debt versus bad debt. And let me just write that down. I want to stop thinking about debt as one thing. I want to start thinking about bad debt versus good. Good debt, right? So we have bad debt, we have good debt, and then we have how that's applicable to you, and then we're going to have debt instruments. That's what we're going to get into next. I'm going to resume filming tomorrow. It's getting kind of late here, and I will see you then. Okay, we're back. Today is a Saturday. This is part 2, at least on my end, of the debt video. And like I said, we're going to cover a whole lot relating to debt instruments, to good and bad debt, and so on. What I want to cover first is something I didn't touch on yesterday, and that is a generic perspective and view on how debt impacts general economic activity and performance, right? We looked at that example with the company and the $1 million decision and the $5 million mortgage, but we didn't really generalize that into, why fundamentally is debt better for economies? And to look at that, let's think about 2 situations. One of those situations, let's call that case A, is one in which debt doesn't exist, or at the very least, it's very expensive, right? And then one of those is case B, where we have better debt. And a core concept that's going to be used in this example, and we somewhat touched on this, is the interest rate of a loan or of debt being the price of money. And by that, I want you to think about it like this, right? Let's say we have $100, and let's say you want $100 worth of debt, right? If I charge you $1 per year to own the $100, right? Then that $1 is going to be the interest rate, right? Which means, say, if you're good with those terms, I give you $100 and you say, okay, I'm going to give you $1 every year, and then say 10 years down the line, I'll pay you back the original amount. That means your cost, right, to own this $100 worth of debt is the dollar. Right? And since this dollar is the interest rate, you can really think of this as the effective cost of debt, right? The price of money. Because debt, right, it's just a form of, at least financial debt is a form of getting money, of using other people's money, right? So then the cost of that money is the interest rate. And the interest rate, to clarify that, is the amount that you pay every single year to take on debt of that sort. So let's go back. We have case A, we have case B. In case A, let's say interest rates are, let's say 10% interest rates. So that means, say, every year, right, if you want to take on debt, if you want to use other people's money, you have to pay 10% of that. So in that $100 example, if I give you $100, you have to pay me $10 a year to use my money, essentially, for that debt. And then in case 2, right, let's go 2% interest rate. So that means if we want to make $100 or take on $100 worth of debt In case one, we're paying $10 per year. In case two, we're paying $2 per year, right? And that again is the price of money. That's the interest that you're going to pay on those funds to take on that debt. Well, let's think about what are we going to do in case A versus case B. And to think about that, let's think about a case C over here. Case C is you can't take on debt, right? There is no debt whatsoever. And now let's say you want to make a $1 million decision as an individual. And that decision is, hey, I want to start a business, right? So you're going to consider starting your business. The startup costs are $1 million for that. You need $1 million to say, open your location, to hire your starting employees and so on. You need $1 million. You don't have $1 million. You have 10 grand, right? What are you going to do if you have 10 grand and you want to start a business, but you're very confident this business is going to work out, right? You're not completely confident. There's some element of risk, but generally you're confident that this business will work out with this $1 million investment. In the case of an economy situation, case C, in which there's no debt, right? You're not going to get your $1 million from anyone or anywhere. You just can't. The debt doesn't exist, right? Which means you're not going to start your business in this situation. You can't get the $1 million. You have 10 grand. You're going to keep doing whatever else you were doing. Now, in case A, the interest on that is 10%, meaning to get $1 million loan, you can go to a bank, you can go to individuals, you can get the $1 million, but your costs on that are going to be $100,000 a year. Now remember, you have $10,000 and you need to pay back $100,000 every year for some period of time and then pay back the original $1 million. That's possible. At least you get the $1 million, but that's such an element of risk since your business has to return at least over $100,000 in the first year just to pay back your loan, right? You're not going to take a salary or make any money. It's overall just a difficult situation, right? And that's with interest rates being at 10%. Now in case B, right, and let's assume in case A, you're not going to start the business, there's too much risk. In case B, with this 2% interest rate, you can get your $1 million from a bank to start your business, and you only have to pay $20,000 a year, right? That means if your business just makes a 2%, say, net return off of that $1 million, you're going to be able to pay back your loan. If the business makes the 100 grand, you're going to have $80,000 left over to reinvest into the business, to pay yourself, or so on, right? So that's not to say that's still a great decision, but compared to these two situations, right, there's such a lower element of risk here, right? So since the risk here is the lowest, right, this is the situation in which you're going to start the business, right? So if we generalize that, what that means is that the more debt there is, right, and let's call this IR for interest rates, and the lower interest rates are, right, then the more economic activity you're going to have, right? So again, the more debt there is, the more available that debt is, the more money you can get for cheaper, right? With interest rates being the cost of money. So if interest rates are lower and there's a lot of debt, just a lot of liquidity in the system, then you can get a lot of money for cheap. You can really leverage the funds that you have, and you can go do whatever you want with that money, whether it's start a business, it's invest in people or assets, and then basically that sums to economic activity. Now this is at its core why governments love debt, right? Why we run on a on a reserve system where banks can lend out so much more money, keep less money in reserve. And that's also why the central bank in parts sets these rates that the banks use to lend out money. And there's a lot more there that we'll touch on at some point, whether in this video or others. But at its core, that is why debt is so central to economic performance. Now I want to return to a concept that was just briefly touched on in the last video, and that is thinking of debt as in two forms versus one form, right? So thus far we've been thinking about debt as one thing, where there is debt. It is this thing where you can take on loans, get credit, you can leverage your money, you can go start a business, right? Or get a mortgage or buy a house. But really, functionally, in terms of, well, how is debt going to impact you? How are you going to use debt? And how should you approach these questions of debt when they come up in your life? You should think of it in two ways, all right? You should think of good debt and bad debt. So just to make that clear, we have good debt and we have bad debt. Now, the way I really like to think about this, and the one that I think is the most functionally helpful, is to think of good debt as buying assets, and bad debt as buying liabilities. And you'll see why this makes so much sense just in a few minutes here, so bear with me. Generally, right, an asset is something that has value, right? It is something that is productive. If you own a business, that is an asset. If you own a stock, that is an asset. If you have a piece of technology like a computer, right, or a camera, those are assets. So assets are just generally productive things that often make you money, right? A liability is something that you owe. It is something that costs you money. If you have debt, right, that costs you money. If you have a monthly car payment, that is a liability. If you have credit card debt, if you know anything that you own that regularly takes money from you or that you owe to someone else, that's going to be a liability in a functional and, again, applicable sense, right? So then we can think about good debt, right, is debt that's used to purchase assets, to purchase things that are valuable, that make you money, right? Bad debt are things that when you take on that debt, the thing that you're buying or you're using that debt for is going to cost you more money or value in some form. Now, I think this ties at its core to the question of utility versus expected value, so I do want to touch on that briefly. Let me just erase this for 1 second. Expected value is essentially the average return you expect to make, right? So if we have, let me erase this. If we have a lottery where there's a 50% chance of making $100 and a 50% chance of making, here, let's make this 50, right? In this lottery, 50% chance of $100 is 50 on average you expect to make, and a 50% chance of $50 is 25, right? So that brings your expected value from this lottery to $75. But then let's say this is, as opposed to 50, let's say there's a negative number here, right? Let's say you have a lottery, or a game if you want to think about it like that, in which, is this still on screen? Yes. In which say we have a lottery or a game in which there's a 50% chance that you're going to win $1 billion. Here, there's a 50% chance you're going to lose $10, right? And let's not make that 10. Let's make that $10,000, right? So 50% chance you win $1 billion, 50% chance you lose $10,000. Now, expected value purely mathematically looks at the returns that you're going to make. So that would say, just like in the last example, there's a 50% chance we're going to make $1 billion. So therefore, the expected payoff there is 50% times $1 billion. That's $500 million, right? And then the expected payoff over here, where there's also a 50% chance, is 50% of negative 10,000, right? Which means on average, we're going to lose, say, $5,000 from that. So the net expected value of this game is 500 million minus 5,000. That's still what, $499,995,000, right? That's a lot of money. Now, in theory, going off the premise of expected value, we should pay $400 million to play this game, because on average, we're going to make $499,995,000. Now, that doesn't hold up in theory, right? Because people are risk averse, right? Let's say individual I is risk averse generally, as people are. They don't want to risk losing the $10,000 if they don't, say, have $10,000. Because sure, they'd be very well off if they made $1 billion, but if they don't have 10 grand, they lose 10 grand, now they're in debt, and debt is bad, right? Excuse me. So expected value isn't really what we can go off for those things. And you'll see how this ties back to assets and liabilities. The better way to think about this is expected utility. And this ties into sort of information economics and domains of that sort. Generally, what I'll just say is expected utility ties in how you value it personally, right? And that's the value is just mathematically, say how much this is going to make you. Utility is how does that impact me, right? How much do I want this, right? And so on and so on. So in that case, you could have the same lottery, but with expected utility, maybe you really don't want to lose the $10,000, right? So that may skew the calculations. So whereas now, as opposed to the expected value being 500 million, your expected utility might generally conclude to, hey, I don't want to do this because I don't have 10 grand, right? So in that sense, this is somewhat more valuable. So now if we think about that as related to assets versus liabilities, we want to think of assets and liabilities in terms of expected utility as opposed to expected value. And by that, I mean, we can think of, let's say, a house, right, as a liability, and that if you buy a house and it goes down, right, next year in terms of its market value. Let's say it was $1 million, now it's $900,000, and you're paying monthly on the mortgage. You just lost 100 grand in equity. That's not even really yours since you took on a mortgage for it, and you pay every month to own it. That, functionally speaking, ignore the definition, functionally speaking, that is a liability since it loses you money every month. And we can think about assets like that and liabilities, and in a lot of ways we should, but you get to live in the house, right? You get the utility, the value of living in the house. And for that reason, purely approaching that through expected value ignores the utility of living in the house. So we want to look at, again, both assets and liabilities, not just in terms of its return, but how that return impacts us. What cohesively, right, holistically, we get out of either these assets or liabilities. So now let's think about some common forms of debt, right, through the lens of good and bad debt, as in whether it gives you, it's an asset, or you use it to purchase an asset or use it to purchase a liability, right? Generally, right, if you take out, if you have a credit card and there's a $2,000 credit limit on this credit card, right, and you go to a Gucci store and you buy a $1,000 handbag, right, is that $1,000 handbag going to go up in value? No. You walk out of the store, decreases in value by 20%. Over the next year, let's say, you drop it in a puddle. At the end of the year, it's worth $300, right? That is an asset that will only lose you money. So in that case, and you can make the argument that, hey, expected utility-wise, that you really enjoy the bag. And we'll talk about that in a second. I'll explain why that doesn't hold up. But we can think of that as a liability. So let's go credit card debt slash luxury goods. We can think of that as a liability and a form of bad debt, right? Then we can think about starting a business, right? If you are confident that you're going to make $100,000 with this business, and it costs you $500,000 of debt that you have to, with say 1% interest rate, right? It's a great deal. For your $100,000, you're paying $1,000 a year. You think you're going to make a lot more than that. That's great, right? So let's say small business loan, right, to start a business, right? And then we can think about, let's do a few more, right? A mortgage to buy your house. Let's just write that as house. And then liability as well. Let's say you make $1,000 a month and you book an all-inclusive hotel, right, or a resort that's, $1,000 a night for 3 nights, right? You're going to spend 3 months of your income on something. It's not going to end well. So let's say, just generally, anything you can't afford. We can also do, let's say, a really expensive car right? A car loan that you have to pay for, let's say, again, you make $1,000 a month and this car payment is $400 a month, right? 40% of your income on a car is just not reasonably worth it. These are all examples of good debt versus bad debt. And in some cases, you purchase an asset, and in some you purchase a liability. But we are running into some slight difficulties here, that being, well, expected utility-wise, right? Let's say I really enjoy the Gucci bag, right? Is that worth it then, even if expected value-wise, in terms of its return, it's going to decrease in value, and vice versa, right? There's a risk element to business. What if the business fails? So to just expand upon this model, the way we can think about good and bad debt as purchasing assets and liabilities is within bounds of risk, right? So risk U. Okay, so here we have risk upper, we have risk U. Here we have risk lower or risk L, right? So the way to conceptually to frame this is if you make $10,000 a year, right? And let's say you want to start a business and you need to take on $10 million of debt to start the business. You're confident it works, but let's say there's a 30% probability of failure. If it fails and you make $10,000 a year and you have $10 million worth of debt that you're financing, that's bad. You're going to be in debt for a long time, right? And sure, you can make the bankruptcy argument, but let's think about that then in terms of, say, student loan debt, right, for college, because you can't get out of student loan debt even if you declare bankruptcy. College essentially is a gamble, it's a game, it's a lottery where you say, hey, I'm going to make that much more money in the future, I'm going to meet people, I'm going to make connections, I'm going to learn, therefore I should spend a certain amount of money. If you make $10,000 a year, right, and you have to go into $300,000 of debt for college, right? That's a gamble. Let's say it's $3 million, right? In a $3 million scenario, $3 million is not worth it, right? For 4 years, if you make $10,000 a year, if you make no money. So in that case, that's too risky, right? That is way too risky. That's $3 million of debt we take on. So in that case, we're running into our upper bound of risk, into the limit of risk within our model that even utility-wise we should consider, right? So again, that's say $3 million, right? When you make no money. If we think about a lower bound of risk, that just means, hey, what is the least amount of risk we'll accept for a given return? Functionally, there is none, right? I just wrote this out so you can see it that way, but less risk is always better, right? If you have no risk without compromising returns, with returns as a constant, that's amazing, right? So really, we only want to think of this through the lens of an upper risk bound, right? So again, with the credit card, let's return to this situation with the Gucci bag. Expected value-wise, it will decrease in value. You're going to lose money. That's not good. Expected utility-wise, you may love the bag. But again, let's say this is $1,000 bag and you make $1,000 a month. Or worse, let's say it's a $10,000 bag and you make $1,000 a month, right? Is going into $10,000 of debt when you make $12,000 a year worth it whatsoever? It might be expected utility-wise, but in terms of how it could materially impact your future, if that goes south, right? You're now in debt that you just can't afford. You have to declare bankruptcy. You might have to leave, whatever place you're living in, and so on. All these bad things could happen, and that's because this credit card, this Gucci bag, just based off your income level and based on the amount of debt taken on, hits this upper level of risk, right? It is too risky. So even with the fact that, say, you really, really want that bag, that's just not worth it risk-wise. So I think that is how you can think about good debt and bad debt in terms of not just how it impacts you, right, but also in terms of, well, what's actually responsible, right? That's the risk variable that we need. So materially, I think, again, it is useful to think of situations in which you're going to take on debt or you're considering taking on debt in terms of, hey, is what I get from this debt productive? Is it valuable? Will it make me money, right? Am I buying assets? Or the opposite, right? Is this bad debt where what I get from this debt, whether that's college, whether it's an experience, a material good, or so on, is going to, lose me money or decrease in value over time. So let's think of some more examples here, right? If you are a student and you're considering going on a trip, right? And let's say it's a $20,000 trip, you have to go into debt, it's a 6% interest rate, right? You're gonna have to pay 6% of 20%, which is, a few $100 a year. Is that worth it to you, right? Is that worth it in terms of this model where we consider assets with a risk variable and liabilities with a risk variable? Let's say in one case the trip is so you can learn with someone, with some sort of mentor that's going to teach you something. You're going to walk out of there with an applicable skill, right? That's an asset you're going to get from this trip. That is something that will make you more money, that will increase your economic value now and in the future, and you're going to really enjoy that. Let's say you like spending time with this teacher, you like the subject, right? In that case, it's an asset, right? In another case, let's say this is to Ibiza, and you want to go and go clubbing for 3 weeks straight, right? And that's your dream. That's great. Expected utility-wise, you probably love that. Maybe you even wouldn't, right? So there's some risk factor there as well. But generally, risk-wise, that's a liability. That's going to cost you money for years, right? And then it's just too risky, right? So in that case, that would be bad debt. So we have, and you can see in that case, we have a very, one type of debt, one debt decision to make. It can be both good and bad debt depending on what we get out of it. And it really is, again, what we get out of it. So if we think about, again, some of those common decisions that people make, right? Like college. College is essentially a gamble, right? It's a game. It's this question for people at least who have to go into debt for it. Is this good debt or bad debt? And that's based on the outcome, right? If you meet incredible people in college, you meet your best friends, you meet your future spouse, and you would have made 60 grand a year in a minimum wage job prior, or 40 grand a year, and then after college you're going to make 150 grand a year, right? That's good debt. That is great debt. You had this life experience, you met all these people, expected utility-wise, that's amazing, and you're going to materially make more money because of it. But also if you fail all your classes, you don't meet anyone, you're kind of depressed, and then you drop out or even, not even drop out, you finish college, say with an English major or what have you, and you go and you make 60 grand a year, and now you have $300,000 worth of debt, right? Is 300 grand of debt worth it for something that makes you 80 grand? Potentially expected utility-wise, but in terms of risk, again, that's just not really worth it in a financial sense, and in the sense that money is important, and to some extent you do need to support yourself and the people around you, right? So in that case, it'd be bad. Now what that essentially means is the game that you're playing, here I'll make this a little larger, here, right? The expected utility of college is a game, right, where you think some sort of thing can happen. Either you get good debt or you get bad debt, right? And I think what you need to consider in all these situations is there may be many things that could happen, right? Like, let's say in this case, you're going to make a lot of money, you're going to meet great people. That's the best possible case. In this case, you make a lot of money, but you don't meet anyone, right? Is that good debt or is that bad debt, right? In this situation, right, you don't meet anyone, you're not going to make more money, generally bad debt, right? And so on and so on. Generally, what you need to consider going into situations like these with debt is, well, what do I expect to get out of it? What will it cost me? What will I gain from it? How does all of that impact me? So not just expected value, but expected utility. Like what do I want beyond just the monetary value of those things? And then what are the probabilities in your mind of all those things happening, right? That's a very pragmatic way of approaching risk, with at its core the question being, am I purchasing something valuable, or am I purchasing something that will add to my life in a monetary sense? Is well in a utility sense as related to risk. I know I'm beating a dead horse here, or the opposite, where that's just not worth it, right? So I hope that model can help you when it comes to considering debt in your own life. Now what I want to do is touch on some of those debt instruments, right? So these are things like bonds, CDs, money market funds, and so on. So essentially, there are a number of asset classes. I'll touch on this, I'm sure, more so in another video, but we can think of this as, right, the stock market, which are equities, equity just being shares of a company. In the case of the stock market, it's just publicly tradable. We have real estate. We have, let's say crypto, and we have collectibles. And then we have, I think I lost you there, we're back. We have varying others. And then we have debt instruments, right? All of these really are debt. Real estate, you buy everything with debt. In terms of the stock market, these are private companies that use loans, use debt to do things. Crypto and collectibles, less so about debt, but in terms of luxury things, right, and especially trading and things like crypto, you use a lot of debt for leverage, sort of margin trading. Then you have debt instruments, right, and these are the asset class that I want to focus on. So that's just a genre of investments. Now, debt instruments are basically all loans that are used in the financial world for people, for companies to do things, or even the government to do things, right? So debt instruments sounds very fancy. All that means is financial tools, financial things that incorporate debt, right? And the main one is a bond, and all a bond is a loan, right? So let's say, and we talked earlier about the issue, or excuse me, the bridge that the town wants to build, and they issue a bond to, or a debt essentially to make that bridge. Let's just generalize that into a bond is a loan. That's literally all it is. It's an IOU, where let's say I am a company. I want $100, right? I want to make $100, or excuse me, I want to use $100 to go and hire a new employee who, let's say, theoretically is going to work for $100. So right now, I want my $100, right? But I don't have $100. So where am I going to get the $100 from? Let's say we have, let's call him Bob. Forgive my lack of imagination, but we have Bob right here. Bob has $100, right? Bob says, okay, I'll give you $100, but on certain conditions. Those conditions being, we have year 1, year 2, year 3, year 4. On year 1, you're going to pay me 4%. On year 2, you'll pay me 4%. On year 3, you'll pay me 4%. And then on year 4, you give me back the $100. And this is 4% on this amount. So what that means is, I as a company can get this $100 now, but then I pay $4 in year 1. I pay $4 all to Bob in year 2. I pay $4 in year 3, then I return the 100 in year 4. That means my effective cost, right, is $112, meaning Bob makes $112. Over 4 years, Bob makes 12% return, right, or a 3% return per year. So Bob's happy because he just made money. Now let's say this employee for me goes and makes me $10 a year, right? I just spent $4 a year to make $10 a year. I'm happy overall, right? So, and that ignores that you have to return the principal. So let's say it's $50 a year the employee makes, right? It's profitable for the business. The business is happy. Bob is happy. He makes a return. The employee's happy because they get paid. Everyone generally is better off. And that is basically what a bond is. And it's just an IOU with a set repayment schedule, except what the actual model by which bonds function in major financial markets is in the debt instrument of bond, or the asset class, you can think of it as, is a company, a state, etc., will issue a bond offering, right? And they'll say, we need $100 million, and we're going to pay you, let's go back, 4% a year, and we're going to do that on an annual basis for 10 years. So that essentially is a government, a state, a business, etc., being like, hey, we need $100 million, we need to do something with that money, we'll pay you 4% a year, and then 10 years later, we're going to return that $100 for you, right? And then they put that on a market online where a whole bunch of investors can be like, oh, the state of India wants $100 million for 4%. You know, I'm going to throw in my 4%, and then, or I'm going to throw in, let's say this is $100 million divided into 100 million shares, so it's $1 a piece. Investor A might be like, I'm going to throw in $50, right? I'm going to make 4% on my $50 for each year for 10 years, then I'm going to get back my $50. Someone else might throw in $1 million, you know, whatever those numbers are. And then the state of India goes and uses the $100 million, does whatever they want, and life is good for everyone. That's obviously a very simplified view of bonds, but that is pretty much exactly what it is. You can get really short-term bonds, 1 month, 3 months, 6 months, 12 months, all the way up to, say, 30 years. And a core concept in bonds is the credit worthiness of the issuer, right? The issuer being the one, the business, the state, et cetera, that says, hey, I want money, here's my loan offering. So AAA is like, the best rating. Anything lower, just the worse the letters get, right? B, C, D, et cetera, the worse off you are. AAA is great. That basically means they're 100% going to have the money to pay you back, right? Because anyone can say, I'm going to pay you 10% a year and give you back your money in 10 years, right? Do you actually trust them, right? Now, your credit score, the credit worthiness of your business, right, or your state or your individual is just, well, how much do I trust them based on their history to pay back that amount of money? And you can see that in the terms, right? Like credit worthiness. Credit just kind of means debt or like on credit. That just means how worthy are you in terms of debt? How much can I trust you with my money? So if you have the state of India, right, versus the United States government. The United States government, not AAA anymore, but it is as good as it gets when it comes to your credit worthiness, because no one thinks the U.S. government is going to fall. They're like, hey, the U.S. government is always going to pay us back. Therefore, they're they're trustworthy. I will trust them with my money, right? The state of India, slightly less trustworthy. They're still generally trustworthy, but let's say let's just think of this as a single A versus triple A, right? The more trustworthy you are, the issuer is on the bond market, the lower rates, right, they can offer interest rate wise. So let's say the United States government is going to pay 2%, and the state of India is going to pay 4%. Now it's again not actually that much of a difference, but in this case with the 2%, we're very, very certain that the U.S. is going to pay us back, right? So we're going to go 2%. Here, there's an element of risk. We don't know if they're going to pay us back. They could default. They could, just a lot of money and be in a big deficit and decide just default on their loans or debt. So we're going to charge 4%, or they're going to have to charge 4% for the market to want that debt. Now with India, it makes less sense, right? But if we think of that in terms of a startup versus Apple, right? Apple can offer 2% and people will still buy those bonds. If a startup offers 2%, everyone is going to go to Apple, right? Because Apple is more trustworthy than the startup. And this is in terms of a public market, again, not, say, a private investor that wants equity, say, in the business. So that's bonds. I also want to touch on that is bad handwriting, but money market funds and CDs. A CD is a certificate of deposit. It is basically the same thing as a bond in terms of how it impacts you, right? You buy them and there will be some sort of return, there's some sort of amount they pay you per year, just percent-wise or dollar-wise. There will be a cost to purchase it, and then there will be a repayment, a date at which they repay some amount, right? So this could cost $90. It might pay you $4 a year, and it'll pay you $80 in 10 years, right? So it costs $90, you make $4 a year for 10 years, so $40 total, and then you make your $80 back, so that's $120 you make off your 90, that's 30 over the 90, and right, that's a 30% or so return over those 10 years, which averages out to 3% a year, right? So that would be a basic example of a CD. You can basically buy them anywhere. You can buy a bond. You can buy all types of these things in brokerage accounts. So Charles Schwab, E-Trade, Fidelity, Vanguard, and so on. Now, in the case of both CDs and bonds, right, you do get your money back at some point in time, right? There is now, and then there is, let's call that, there is repayment, right? So you spend money now, you make money here, you get your money back. But you can't take your money out prior, right? Your money is stuck in there. You can, in some cases, sell on a market, but let's just think of this as terms of, hey, your money's stuck for 5 years, 10 years, etc. Money market funds are not like that. Money market funds are 100% liquid, and that's MMF. Again, that is very bad handwriting. A money market fund is also a debt instrument in a sense, but let's say it pays 5%. If you put your money in a money market fund, it will make 5%, say, every day, basically constantly, right? But let's say it pays out every day. So you're going to make 5% over 365 days every single day, right? That's your daily return. So while for a bond you may get paid out every year and you get your money back in 5 years, in a money market fund, you can take the money out in a week and you will have made, right, 5% over 365 times 7, right? Times 7 days for the week. Now we are living in a very strange environment right now when it comes to your bonds, your money market funds, CDs, just returns as a whole. Historically, bond returns have been much lower. Right now, they're well over 4%, right? And money market funds are at 5%. That's a really good return. You can throw $1 million in and you're going to make $40,000 a year off bonds or $50,000 a year off a money market fund. It will probably not be like that forever. That's just because the feds are taking the reserve rate, which is the amount of money that banks are required to keep in reserve when they lend out money, and they're keeping that very high, right? Because they're trying to still bring down inflation, right? So this ties into monetary policy and fiscal policy as a whole, right? The federal bank generally wants to keep inflation low. Since they're not seeing low inflation, they are making the price of money or interest rates high. When it costs more to make more money, there's less economic activity. When there's less economic activity, in a sense, there is lower inflation. That's a very, very, very simplified look at that. But that is why, essentially, right now you're seeing these, especially in part, these very high returns on debt instruments. So the last applicable question surrounding debt or context that I want to provide for you is that of credit. And we just touched on this a few minutes ago, as in your credit worthiness, your trust is associated with the good rates you can get if you're issuing bonds, or the cheap versus expensive nature of those. The generalized view on that is the more people, the more institutions trust you, right? The better rates they're going to give you. The cheaper money is going to be, the better rates on all forms of debt you can get, right? So if your mortgage, let's say, could be 4% a year, right? if the bank really trusts you, if you always pay your money, your debt, your credit card payments back on time, right, and you've done that for a long time and you make a lot of money, maybe that's 2%, right? Now, if they really don't trust you, if you never pay your debt back, etc., maybe they won't give you the loan for the house, or maybe they'll charge 8%, right? And that's just based on how much they trust you. Now, the metric that they use to assess your credit worthiness, right, is your credit score. And this functionally, you've probably heard about a credit score, but this is why credit scores are so important, right? This is how banks, how the government, how institutions, how individuals assess how much they can trust you with their money. And the lower your credit score is, right, the higher interest rates are going to be, the more amount of money you're going to have to pay for debt. And if you want to buy a house, if you want to get a car, any sort of tech, right, credit cards, loans for businesses, right, if you have a low credit score, you're either not going to get that kind of debt or you're going to pay a lot of money. That's not good, right? So the higher your credit score is, right, then the less money you pay, and theoretically, the more money you're going to make. That is why you want a good credit score. Now, your credit score breaks into a whole number of things. The number of cards that you have, the length of your credit history, so how long it's been around, your payments, and whether you never pay back on time or you always pay back on time, your utilization, and that just means if you have $100,000 of credit available on your credit card and you spend $1,000 a month, that's 1% utilization or usage in a sense. If that's 50 grand that you spend, then that's a 50% utilization rate. Generally, you want to keep utilization somewhere around 30% or less. That is usually best. Payment-wise, always pay back on time. And I highly suggest, especially if you're younger and you're working through your first few credit cards, always pay the full balance back every month, right? So if you spend $300 this month, don't pay the minimum like $20 that you have to pay. Just pay the $300 back, right? Length of time, right? More is better. If you've been paying, or you've been on time with your payments for 10 years, that's better than being on time with payments for 1 year. And then for number of cards, there's a lot of variables that go into that. Generally, there's a soft credit pull and a hard credit pull, right? When you open new sort of credit accounts. Now, a hard credit pull, if you are opening a credit card, means they do basically a full check, right, on your credit history. Hard credit pulls make your credit score go down. Soft credit pulls do not. Some cards you can get for a soft credit pull. For other ones, you just have to get a hard credit pull to say just get the card if you say don't have, right, a credit card. Generally, if you open a bunch of cards and those all require hard credit checks or pulls, right, your credit score will go down. That will climb back over time, but in accordance with these other variables. But in some, that would be the factor there that really drops your credit score. There's a few other elements as well, but generally it's going to be these things. So just generally, if you pay your payments on time, if you use less than a third of the credit line available to you, and then you just keep at it and build that length, and also just have, say, sub 4 cards, right? You're generally going to have a great credit score. Credit scores generally operate on a scale where 850 is the max. If you're in the 600 to 700 range, that's just about average. If you're 700 to 800, that's great. If you're 850, you're quite literally perfect in a credit score sense. So those are the general ranges that you're going to want to aim for. Okay, so that will wrap up this conversation about debt. I think generally if I had to summarize what I've been trying to say in, say, 60 seconds, it is that debt is neither totally good nor totally bad. If it is anything, it is everywhere. It is what every institution, in large part, every government and a lot of individuals run upon. It is the blood of the financial system, right? So you can't ignore it. I think it's really more a question of, well, how do you use it? How do you use it to your advantage as opposed to something that takes away, right, from your financial health and ability. And if you use it right, you can do a lot with it, right? It is very powerful. And in another video, I'll go over some examples of how I've, say, personally used debt, right, to accelerate returns, like by buying a business. So in terms of how you approach debt making decisions, again, good debt, bad debt. Good debt helps you in the future, it makes you money, it brings you things, and increases your value, right? Bad debt is debt used to purchase liabilities, to things that take money away from you, that take time and effort and so on from you. So that's generally, I think, the easiest frame for good debt, debt as a whole. And then as the final note there that we touched upon, just make sure your credit score is good. That really does matter when it comes to debt. That is the video. Again, this is the first sort of lecture in a series that I will be doing on personal finance. Just let me know what type of videos you want to see, what concepts there. Some ones I want to do are assets and liabilities, taxes, the banking system as a whole, and then just varying ways of, I think, making money as well. So again, just put in the comments what you want to see. Please do subscribe if you want to see more, and I'll see you in the next one.
If you want to invest in the stock market, or you just want to learn about the stock market and you have limited prior experience, then this video is for you. I'm going to break down over the next hour or so really everything you need to know if you want to start investing in the stock market. I think this is a really important video and one I've been looking forward to making, because if you look over the last, say, 100 years, just in terms of wealth generation, the stock market is pretty much, apart from real estate and home ownership, the #1 creator of millionaires and wealthy people, right? And at its core, investing is such an impactful and important thing. And in terms of really accelerating the financial opportunities available to you, making more money and retiring with money and being financially free, right? Nearly everyone is going to do that through the stock market if they are going to get there. So that's why I think this is such an important video. And again, if that's you, then stick around. So if we look at what this video is going to consist of with regard to just a general transfer of information about stocks and the stock market and how you can actually go and invest today, right? We're going to start off with why investing. Like, hey, you've heard a lot about the stock market and stocks, but why is it actually important, and why is it important for you right now, right, to create an account and go start investing? Then we're going to get into terms. That's just, hey, what is a stock? What is the stock market? What are dividends? And all these terms you've probably heard a lot about. And then we're going to cover, well, the types of investments, right? Because there are multiple types of investments within the stock market. It's not just you go and you buy a stock or you sell a stock, right? There's a lot more there to cover. Then we're going to get into types of stocks, right? So how to analyze and how to look at and choose and figure out which stocks are good investments and which stocks are not good investments. Then we're going to get into fundamentals. So this is, well, you've chosen a stock, right? You think this stock could be good. What are the fundamental metrics? What are the key things to look at when it comes to figuring out whether that's a good stock, right? The fundamental metrics that drive its business. Then we're going to look at earnings, and we'll get into what earnings are, but that's important because that gives you more information about how a business is doing. Then finally, we're going to get into rules and tips. These are just the strategies, right? The practices, the actually on the ground, how do I go and invest? What shouldn't I do? What should I do? And so on. Then finally, we're going to get into, well, you've watched this whole video, you want to invest, maybe you've been wanting to you've wanted to invest for a long time. How do you open an account right now and go, say, buy a stock? And then at the end, we're going to wrap up with some resources. That's just stocks, podcasts, websites, videos,
books and so on that are great for you to go check out so you can learn a lot more. So that's the video. Let's get into it right now. So again, it really would be wrong to start this video off in any other way than why is investing actually important? Why should you go and invest today, right? And you know, we all know a lot about investing. We've probably heard various different things like, oh, it's a bull market. Oh, the federal government, right, did something with the stock market or the federal funds, or they crashed the market, or there is a market crash, right? Or the S&P reached an all-time high. Like, these are all things that we hear. But I think from an individual perspective, we have to think about why should you actually invest? And that comes down to, well, can you make money from it, right? Investing is about growing your money. And I want to show you why investing will make you so much more money versus if you don't, right? First off, if we think about, say, a job, right, where you go and, you know, you work for your money and then you spend part of it and maybe you save from some of it, right? Your earnings are going to look like this, or your savings, right? So let's say, you know, you work for a week and you make your $800. Of that $800, you spend 600, right? And then you're left with 200, right? So that $200 is the amount of money that you save, that you use on, you know, luxury, like say traveling or going to the movies or nice food or so on. If you make money like this and you spend money like this, your wealth will go like this over time, right? And that's great, right? Versus not having money. The problem with this is if you make your, say, $200 a week, you have to spend a lot of that money, right? And then this $200, if you save it, that's just sitting in a bank account and a checking account. It's not working for you. It's not making more money. So if you save, say, $200 a week, you're saving what, $800 a month. You're saving $9,600 a year. Over 50 years, right? You're going to save a few hundred grand, and that's fantastic as well. The problem is that we're living in this time when A, inflation is high, especially over the last few years, and then B, it costs a lot of money to retire. You're seeing that in the US, you're seeing that around the world as a whole, right? So again, most people they save maybe $200 a week, and that's good, right? And you save a few $100,000 if you do that over the course of a lifetime, and this translates into other countries and currencies as well. But the number you need to retire right now in the US and a lot of places is about $3 million, right? Let's assume at the very least you need, say, 1 million, right? To make $1 million linearly, like, hey, you know, you work a week, you make money, you work a week, you make some more money, and so on, that gets difficult. Because if you're saving $100, $200 you know, even $1,000 a week, right? That's not really going to add up to that $1 to $3 million range over time. And again, the same applies in every country around the world. So rather, what millions of people have done, right, over the past few hundred years is they have let people and individuals make money from companies doing well, from the overall economy doing well, right? And that is the stock market. And the reason that's so powerful is because of the law of compound interest or compound growth. And I've covered this in other videos, so if you watch those, just skip forward a minute or so. But compound growth looks like this, right? This is your money working for you. And if you save that same $200 a week, right, and you start when you're 20 years old, and you put that into stocks, right, versus saving it, if you invest it versus just, keep it in cash or put it in a checking account, right, by the time you're 50 and 60, that's going to look like this. You will be at that $3 million plus mark, right? And I'll put up a chart on the screen that shows the actual difference, right, if you say invest versus save $200 or whatever the number is. But generally, you're looking at, say, like $300,000 versus $3 million. You're looking at a 10x plus difference by just investing in the stock market versus saving, right? And that's because your money works for you. Now let's think about why that actually happens, right? And again, this is fundamentally, well, why should you invest? And again, let's say we earn $800 a week and we save $200 a week. And let's think about this in terms of years. If you save $200 a week, you're saving $800 a month. That's $9,600 a year, right? So we're saving $9,600 a year. If we do that again for 10 years, we're going to get $96,000. Now, if we invest this, let's think about this again. The first year, we put in $9,600, right? That is the balance of our, say, stock market investment portfolio. But But let's say we earn a return of 5%, and that means our money is going to make 5% because we invest it, say, in a stock. And we'll cover really what all this means in just a little bit. But let's say we make 5% on our money, right? We're going to make 10% is 960, so $480 is going to be our 5%, right? So we profit by $480 right there. Then we get into year 2, right? In year 2, we have $9,600, so the original amount we invested, in addition to this $480 in profit, which means our total balance, just off the top of my head here, is going to be $10,080, right? Now this $10,080 makes 5% again, right? Now remember, the first year, 5% was $480, but now that $480 also makes 5%. So now our 5% of $10,080 is what, $540, right? So in 1 year, in our first year, we made $480. In our second year, without adding any more money, we made $540, right? We made $60 more. And that is, again, with the same amount of money. Now, meanwhile, if we save, right, if we put another a set amount of money in, let's say another $9,600, right, that's growing like this. That's 9,600, then what, 19,200, and so on. But here, right, this $60 is everything. That's so critical, because this wasn't us working for that money to put, more money into stocks. This was the money making money, and then the money we made, this $480, also generating 5% a year, right? And then, again, let's say without putting more money and without putting another $9,600 in, this $540 brings our total balance to what, $10,620, right? So this becomes $10,620, and that's going to be in year 3. Now that $10,620 will make 5% more, right? And 5% of that is going to be a little bit more than 540. It'll be over $600, right? So in that way, by function of our money making money, right, over time, right, we're going to have an exponential increase in our portfolio, right? We're going to make a lot of money. This also illustrates why it's really important to start investing young, right? Because you'll notice, let's say this is year 5, this is year 10, this is year 20, and this is year 30, right? If you start investing when you're 40 years old, right, and you want to retire when you're 60, you only have 20 years, right? 20 years is a long time. That's fantastic, but you're only going to get, right, this amount of money. You're only going to get up to here on this exponential graph. Meanwhile, if you start when you're 20 years old, right, by the time you're 40 years old, you've been investing for 20 years, you're already there. And then when you're 50 years old, right, and let's say you want to retire at 60, your portfolio is there because that money just keeps on growing. It's like a snowball that just rolls down a hill and keeps getting larger and larger, right? And then you can just imagine when you're 40 years old, right, you're in such a better place. And that's why, any amount of money you can invest when you're really young is going to make a lot of money for you down the line, right? It might not sound like a lot to save $100 or $1,000 this year, but if that money 50x's, right, over the course, again, that's say $1,000 by the time you're 50 or 60, now you have $50,000 or $60,000 then, right? And that's going to mean a lot more when, you want to retire or just generally, right? If you want to start a business, if you want to travel, whatever you want to do, you're going to be better off having more money. That really is why investing is so important. And then also why it is so important to start investing as young as possible. And I really suggest you do send this to kids or friends if you are younger, or you have your own kids, because again, this is what will change really their financial horizon and opportunity just for the vast majority of people. Now, if we think about the stock market as a whole, right, it on average grows by about 10% a year, right? And this varies. You see 6%, 8%, 10%, various numbers at different times. And it is volatile, which means it's not always 10%. Sometimes it's 5, sometimes it's 15. But let's just, for sake of simplification, say that's 10% a year. That means every dollar, or let's say every $100 we put in will make $10 on average per year, right? So again, with compound interest, right, we put in $100, we get 110. The 110 goes to 121 because our $10 makes 10% in year 2, which is $1, and so on. So generally, you're going to make about 10% a year in the stock market, right? And we'll get into what the stock market actually is and why it functions like that. But generally, right, that reflects economic performance. So if the economy is, or the GDP is growing by, 4 to 5% a year, that's really good. Let's say more 2 to 3%. Your stocks or just the value of companies is going to grow by, say, that 8 to 10% a year. We also have to think about inflation, right? And this is what's critical to the value of investing, and also why it's really, really dangerous to not invest, right? Because in our earlier example, we thought about that $9,600 that we save over the course of a year. Let's say we don't invest this. If we don't invest this, and let's say inflation is 3%. And we've all heard a lot about inflation, right? It's all over the news all the time. All that it means is that goods and services get more expensive, right? It's like they inflate, they get larger, right? So if groceries used to cost $200, now they're going to cost $206, right, this year, and then 3% more than $206 next year, and so on. What that means is the amount of money in your bank account doesn't go down, right? But you can buy 3% less of actual things with it, right? So let's say before we could buy, again, we wanted to buy groceries or G, and we could buy 100 units of our groceries, right? Well, we have this $9,600 in a bank account, and then in 1 year, we still have $9,600 in a bank account, right? But now we can only buy 97 units of our groceries, right? Let's just say that's grapes. We used to be able to buy 100 grapes. Now we can only buy 96 grapes. Again, not at 3%, just generally let's imagine what that looks like, right? Then let's accelerate to year 4, right? And this is year 1. At year 4, we still have $9,600 in this bank account, but now we can only buy 70 grapes, right? So even though it doesn't feel like you're losing money, you can actually do less with the money, right? Which means the actual value, the real purchasing value, as it's called, is decreasing, right? So that's why if you don't invest, right, if your money doesn't make you money, you're actually losing money all the time. You're losing the value of the money. It's going down right now by over 3% a year in the US. In the UK and a lot of places, that's double digits, right? That's 8 to 15%. In Turkey and a lot of places in the world as well, that's a lot higher, right? So that really is why, again, it's so important to invest in things that will make you money. Because then what happens is, we can think about investing as this. If you just leave money, if you quote unquote save it, if you leave it in a bank account or in cash, what it's actually doing, right? Its effective purchasing value is doing this. It's just decreasing, right? So investing is your money making you money, right? Anything else than investing, in whatever form, that's going to lose you money over time. And I know I'm beating a dead horse here, but that is why investing is so important. Okay, now let's consider what a stock actually is, right? And this is the first sort of term in our terms section, right? You'll also hear this referred to as equities. They kind of mean the same thing, and we'll get into what that means. So when you start a company, right, you're going to issue a certain number of shares, and that is just a part, right, a unit of ownership, right? So let's say I start company A, right? I start company A, and to start company A, I issue 100 shares, and that just means that the value of my company, the ownership of it, is divided into 100 parts, right? So each of these shares is worth, say, 1% of the company just when I start it, right? Then let's say I own 100% of it because I started it, right? I run it for a few years, and now it's making, right, $1 billion a year. It's doing extremely well. Now I want to go public, right? And what that means is I want to list these shares, right? And I want other people to be able to buy them. I want to go on a public market with them. Any company on a stock market, and we're going to get into what a stock market means, but any company on a stock market is public, right? Anyone in the public can own shares of them. And again, shares are just well, hey, I started my company and this is a part of the company. This is a little piece of ownership, right? But now I'm making $1 billion, right? And in the case of 100 shares, the pie is somewhat like this, right? We have 100 shares, and let's say I own all 100, but then maybe I want my mom to get in on the action. I want her to own some part of my company. In that case, maybe I'll give 4 of those slices to her. If I give 4 out of 100 slices to her, she owns 4 shares in my company, right? But then now I'm making $1 billion a year, right? I'm a big deal. My company's doing very well. Now, as opposed to 100 shares, I'm going to split those into smaller parts. And let's say now I have, right, 100 million shares, right, versus 100 shares. So just, 1 million times more. It's the same exact thing as here, right? Before there were 100 parts of my company, right? It was the value of it was split 100 times over. Now it's just 100 million, right? So it's just this, but there's 1 million times more squares. Now before, again, let's say I put in $1,000 to start company A. The company was worth $1,000 and there were 100 shares. That means the value per share is $10, right? Here, let me erase this. If my company is worth $1,000 and there are 100 parts in it, right, then it's just each part is worth $10. Now I'm making $1 billion a year and my company is worth, let's say, right, $10 billion. So my company is worth $10 billion and I have 100 million shares. Well, it's the same exact calculations. It's just my company is worth, here, let's write this out, $10 billion, and then I have 100 million shares. So if each share was worth $1, it'd be a $100 million company. If they were worth $10, it'd be a $1 billion company. And if each share is worth $100, right, then you get to that $10 billion market cap. So same exact thing here, right? The company is worth this amount. We have this many parts of the company. So if you own one slice of that, one share, right, that share is worth $100. Now, that's exactly what the stock market is, right? If you go to the stock of a company, it's just a little piece of ownership of the company that you're buying. And if the company is worth $10 billion and you own one share out of 100 million, and that's say of Apple, of Nvidia, of Microsoft, of whatever the company is, right, then this is how the value is determined. It's just the value of the company divided by the number of shares that exist. So that's what a stock is, right? It's just a piece of a company. Now let's think about what the stock market is. A stock market is just a collection of stocks. So let's say, let's use real examples here, right? We have Apple, we have Microsoft, we have J&J, right? We have these 3 companies. The way it used to be, the way it was originally, was just Microsoft has its stock, right? They have their 100 million shares of their company, and Apple may have 1 million shares. J&J might have 10 million. They all have their own companies and shares. But then, right, let's say they want to raise money. They want to, let's say Apple wants $1 billion to go build a new facility. If they want to do that, they need to get the money from somewhere, right? They need to get that $1 billion. One way for them to get the $1 billion is to sell some of the shares of their company. Because again, what we just said is, every share has value, right? Every share, let's say, is worth $100. If a company is worth $10 billion and we have 100 million shares. So now Apple wants $1 billion. They need to sell some equity or some shares of their company to go get that $1 billion. So let's say they're worth 10 billion, right? And they need to raise, they need to get $1 billion. Well, if they have 1 million shares and their company is worth $10 billion, they can list 100,000 shares or sell 100,000 shares, right, to go get $1 billion. And that's because 1 billion is 10% of the value of the company. So if they sell 10% of the shares or the parts of the company, they're going to get the $1 billion. So the next question is, well, where do they go in to sell this, right? Where do they find people who want to buy their 100,000 shares? Well, let's say you think Apple is going to increase in value. It's worth $10 billion now. You think that's going to go to 100 billion. You think it's going to go up by a factor of 10. It's going to 10x in value. If you think Apple is going to go from 10 billion to 100 billion in value, right, you want to own a piece of that. Because if the value of the company goes up, then the value of the shares go up, because the shares are just parts of the company. And let's say you're a normal person, right? You go to work, you go to school, whatever it is, but you want to make money off Apple. You believe in Apple. You want to buy shares. Apple wants to sell you the shares. The natural result of that is a market, right? A public marketplace where people can buy shares of companies that they believe in, that they think are going to go up, right? And then the result here is, you give Apple $100 now for a share because you think you're going to have $1,000. You think it's going to increase by 10x, right? Apple does that and gets their $1 billion, right? Your $100 and the $100 of a lot of other people, and they go and build a facility, right? And life is great. They use that money to go and build their company to get to that 10 billion. Meanwhile, if the company goes up, you make money, right? So the company's better off, you're better off, everyone generally is better off, right? That's why the stock market works. And then all these other companies want to do the same thing. Microsoft, right, wants to list 10 million of their 100 million shares. J&J wants to list 9 million, right, of their shares, and so on and so forth. So the stock market overall is just this big bubble of all these companies, like a public marketplace, right, where you can go and buy shares of companies and they can go and sell those shares. And then what we figured out before, right, is that every share has value and you're going to invest if you think it can go up, right? Let's then think about the open price, or the price of a stock, because again, this is a market, right? There are buyers and there are sellers. So how do we figure out, what the actual stock is worth, right? And the actual value of the stock is determined by the market. So let's just illustrate that, right? Let's say I own, right, stock. I own one share of Apple stock, and I'm willing to to sell my stock for, it's worth $100. I'm willing to sell it for $102. This guy, he wants to buy it. He thinks it's going to go up, but he doesn't want to buy it at $100 because he thinks maybe it's going to go to $104, right? So he's willing to pay $96 for it, right? And then there's someone else who's willing to pay $95 and $94. There's someone else willing to sell for $103 and $104 and $101, right? So there's all these buyers and all these sellers, or people who want to buy or people who want to sell. Ultimately, the intersection of these two is the market price, and this is what determines the share price, right? So if the person who is willing to sell for the least amount of money is willing to sell for $101, right? And then the person who is willing to buy for the most amount of money is $101, and now a lot of people want to buy for $101, right? Prices are in equilibrium. You have people willing to sell for $101 and to buy for $101. If that happens, if the price used to be $100, now the price is $101, right? And if people start wanting to buy for $102 or $103, people will continue to sell only at that higher price. No one's going to sell for $97 if the stock is the market says it's worth $101. So now the price goes to $102, then $103, and so on. So in that way, the market determines, right, via just buyers and sellers, the price of a stock. And all a stock price is what people agree it's worth, because it's real time people willing to buy or sell that stock. Now, before we said, a stock market is a bubble of companies, right? A marketplace where you can buy and sell shares. Now, what I want to make clear is that a stock market, in that sense, is owned. It's like it is a marketplace, but it's a private marketplace, right? That a certain company owns. So if we think about, say, NASDAQ, right? the NASDAQ is a stock market exchange, and the stock market generally is just a market for stocks, for shares, right? A stock market exchange is where you actually go to buy and sell those, right? Because someone has to manage that. If I want to go into a computer and buy 100 shares worth of Apple, right, someone has to manage that. Someone has to make it happen. So what you see are what are called exchanges. And this is just like an exchange desk where you go, say, to exchange bills of different currencies. It's just like that for the stock market. They just manage that, right? So you can think of the US stock market, right? But the actual stock market breaks into different exchanges. And this is just the actual, the people who manage, right, the listing and the buying and selling of those stocks. So you'll never really run into this. Like you're not going to go onto NASDAQ and buy a stock through there. And we'll talk about how you actually can go and buy stocks in a little bit. But just keep in mind that generally your bubbles of stocks, right, your stock markets with Apple and Microsoft and Nvidia, they're going to be on, say, the NASDAQ exchange, right, or the Dow exchange, or every country will have their own stock market. So China will have a stock market, the Swedes have a stock market, and some stock markets may have multiple. Some countries may have multiple exchanges, right? And the biggest one in the US, right, you have the New York Stock Exchange, or the NYSE. Okay, so we looked at this example, right? All these examples of companies that issue shares or issue stocks and then join a stock market. I want to put some terms on those things, right? So if we think about an IPO, you'll hear this term often. IPO means initial public offering, right? So if I'm Apple and I completely own my own shares, right? I own all million of my shares, and then I want to list on a stock market exchange, or I want to make that public so other people can buy my shares, right? When I do that, that's called an IPO. And you'll often see videos of companies where they're ringing a bell on a stage, right? Or the people who started the company, or the executives. That is them listing for the first time. That's when their shares were private. Now they make some of them public. Now you can buy and sell them actively. And then before we spoke of the total value of the company, right? If we had the $10 billion, we had the $1 billion. Let's say your company is worth $1 million, right? And you have, let's say, 100,000 shares. And then our price, right, is going to be $1 million is the company value divided by, I've got a zero there, 100,000. That's going to give us $10 per share, right? $10 a share, 100,000 shares. It's going to give us $1 million of value, right? If a company is worth $1 million, what we're going to call that is the market cap. And this is what you hear about all stocks, right? So if you go search up any stock of any public company, you're going to see something that says market cap, and it'll have a number. That number is just the value of the company, right? So the market cap, or the market capitalization is just the value of the company. And then the number of shares outstanding, right? That's just the number of public shares. And then the price, the open price, the strike price, there's different terms for it, is just how much each of those shares are worth. Now, one core concept to touch upon here is dividends. So let me write that down. You might have heard about this as well. You may also hear about the word yield, right? And that is going to be a very similar concept here. If you own shares in a company normally, if you own all of a company, you get all the profit from it, right? Stocks don't necessarily work like that. Just because you own a part of the company doesn't actually mean you're entitled or you get some of the actual profit from the revenue of the company. Instead, some companies offer what are called dividends, and this is essentially the company paying you to own part of the company. It's them taking some of their profit or their revenue and giving that to you. So let's construct just an example here. Again, let's say you have $1 million market cap. You have 100,000 shares, and you have a $10 price, right? Let's say this company is going to make $10 million this year. And they decide we're going to with 1 million of those dollars issue dividends. And dividends are distributed equally among people who own a stock. So again, there are 100,000 shares. Let's say there are 100,000 people that own one share each, right, in this market. They're going to distribute the $1 million to the 100,000 shareholders, right? They're going to give them $10 each. Now, this would be amazing, right? If you have a stock worth $10, and then they give you $10 just to own the stock, you just made 100% return. That's incredible, right? This is fundamentally exactly what happens. It's just you see much lower numbers, right? So take J&J, right? Johnson & Johnson, it's a very big pharmaceutical company. I don't remember exactly what the stock price is at right now. Let's just say it's at $300, right? Right now, they're going to pay you, let's say, $5 a year in dividends, right? So that means for every share you own of Johnson & Johnson for $300, they're going to pay you $5 a year just to own it, right? And that's essentially, again, normally when you buy a stock, you want the value of the company to go up, and then you could sell to someone else for a higher price. This is, I get some of the profit of this company, right? I'm actually making money. They're paying me just to own this. And then the dividend yield, or that's the percent amount, right? So to make this easy, let's say their dividend is $6 per year, right? They're going to pay you $6 a year per share you own. So if you own 10 shares for $3,000, right, they're going to pay you $60 a year, and so on. The dividend yield, or the interest yield, right, is going to be the $300 divided by the $6 is going to be 0.02, or your 2%, right? And the actual here setup, let's do this correctly, is going to be 6 over 300. Again, that's going to be 2%, right? 1% of 300 is 3, 2% is going to be 6. And again, this is just how much they pay you purely to own the stock. So in that way, you can make money in different ways. You can make money just by owning a stock, right? Because let's say the price of J&J is $300 right now, but then 1 year from now they release a new drug, right? And then now they're worth $400 a share, right? Well, let's say you bought your 10 shares at $300. You still own 10 shares, except now they're worth $4,000. So you spent $3,000, you bought for $3,000, and then you're going to sell for $4,000, right? You just made $1,000, and that's one way of making money. But if you bought 10,000 shares and they offer a 2% dividend, right, you're going to make $60 a year. So 1 year from now, you're going to come out actually with $1,060 in profit. You're going to make $60 extra. Then extrapolate that into 10 years, right? Remember what we said too about compound interest, right? That $60, you can invest it back in the stock, and it can make 3% more per year. But generally, right, the longer you hold a stock, if they offer a dividend, right, the more money you're going to make from the dividend, making more money, and so on. And generally as well, you can make money either by owning a stock and then paying you dividends, or by the actual value of that stock increasing. Now let's think about the chart of a stock over time, right? Let's say this is going to be price. I'll write that out. And this is going to be the date, right? Or the time throughout which you hold a stock. If a stock right now, let's say it's at $200, right? And this is now. This is the present or end, right? If 1 year from now, I'll come over here, right? This stock is at, right, $100, and then 2 years from now, let's say it's at $400. It did really well. This is a volatile stock, and volatility is a measure of change. Volatility is rate of change, right? So this stock was break even here, it crashed over here and went down to $100, and then it went back up to $400, right? This is a very volatile stock. It goes up sometimes, it goes down sometimes, it has all this different price activity. Then let's say we have stock number 2, right? Stock number 2, as opposed to going from 100 to 400, right? Starts out at 400. In year one, right, it hits 300, and then at year two, right, it hits 400. Now, both of these stocks did in fact reach $400. And here, let me just make a smaller graph. This stock went like this to hit 400. And then let's make this cleaner as well. This stock went up to hit 400. Both of them started at 200 and ended at 400, right? But this stock is more volatile. This one is more stable. And you can think of volatility as just the opposite of stability, right? A lot of people prefer more stable stocks, right? Because, in this example, you never lose money. Your money just never goes down. While this one, you do lose money initially before it goes back up. But some people like the risk as well. They like to, make money because generally, you are going to see a correlation. And this is covered in one of my books. So if you've read that, you'll be familiar there. But there's a risk and return relationship, right? There's correlation, and that means when risk goes up, return goes up. When risk goes down, return goes down. You can think of this with everything in life, right? If you play it really, really safe, if there's very low risk, if something isn't volatile, right, you're going to see a fairly low return, right? Like let's say, again, just you're going to ask someone out, right? Let's say dating or your love life. If you ask them on a date, right, there's a level of risk there. You could get rejected. But if it goes well, you get the return, you get the payoff of going on the date. And then extrapolate that into, the second date and the third date and so on. Meanwhile, you could also just not ask them out, right? In which case the risk is 0, but the return is 0 too, right? Because you also don't get the date. Finance works exactly the same. It just works more accurately because there are lots of people involved. And the more people involved, the more stable things become in terms of this relationship. It works the exact same in the stock market, right? Your risky stocks, your stocks where you could lose money, could also make you more money. Meanwhile, your really safe stocks aren't going to make as much money. And let's take J&J, right? Let's say J&J is at $200, and a year from now, it's at $210. You made 5% on your money. That's great, right? But 5% isn't an incredible return because let's say other people are investing in Bitcoin and making 50%. That was limited risk because it's J&J. It's not going to go down, right? They sell things everyone needs like Band-Aids and drugs and so on all the time. They're not going to go down, but you're not going to make a lot of money. Let's say you make your 5%. Meanwhile, right, let's take Bitcoin. Bitcoin could be at, let's say, $100,000 a year from now. It also could be at $10,000 a year from now, theoretically, let's say, right? In this case, you could make off your, let's say, $10,000, you could make a 10x return, right? Or 1,000%. And that's really high. If you make that, that's incredible. But you also could lose your money, right? So this is a more risky asset, but there's also higher returns. In the case of J&J, right, you have lower risk and also lower returns. And you have as an individual your risk profile, right? You have the amount of risk that you want. If you're older and you're going to retire in 5 years, right, you probably want low risk. You don't want to lose your money. Meanwhile, if you are younger, right, you may seek out risk because risk on average may produce higher returns. You may make 10% versus 8%, but some years you may lose money. And I said earlier that the stock market will make, here, let's move this chart a little lower down. It'll make on average 10% a year. When I say it makes on average 10% a year, really it's more like 8%, but let's call it 10% over the past 50 years, right? It actually could look like this, right? This year you lose 5%. This year, you make 25%, and so on and so forth. So what this means is that it's much better to invest in the stock market over a long period of time because the trend line here, the average, right, is always positive. It's up. But at some points you're going to lose money right here and right here, right? Let's say year 2, year 4, year 5 and year 6 are really good. in year 3 was also good. Some years you win, some years you lose. Overall, you make money. And once more, and again, I know I'm beating a dead horse, but that's why it is important to start young and invest over a long period of time and invest consistently, right? Because if you only buy, right there, or you only buy right there, you could lose money for a year or two on this investment, right? And right here, you're going to lose money, but then it might crash after that, right? If you buy all the time, if you buy $100 a year, every year, the $100 here is going to make a lot of money. The $100 here is going to make a lot of money, and so on and so forth, because over time, things will make money. Now, there's these different periods in the stock market, right? And once more, let's clean this up. Let's say this is the overall price for the stock market. Like theoretically, if one price represents the stock market. And let's say it looks like this, right? This is price. During this period, it goes up, and you know what? Let's say this goes well. Let's say it goes up, and the stock market does usually go up. It's down here, it's down there, and it's down there, but it's usually up, right? You have what's called bear versus bull markets, right? You may have heard this term. If you go to New York, to the New York Stock Exchange, you'll see the big statue of the bull, right? Bull just means up, and bear just means down, right? So if you're in a bull market, if the stock market is in a bull market, that's one of these periods, right? Where stocks are going up, where everyone's happy and making money. And then these bear periods are when prices go down. So if you hear like, oh, it's a bear market, oh, the bulls are getting us today, and so on, that just means, bull is green, bull is you're making money, bears are losing money, bear is red, right, equivalent. And you'll hear bear market. Again, the bears are people who think the markets are going to go down, and so on. That's just some slang there. Okay, there's just 3 more terms I want to cover here. The first of those is going to be, or I guess the first 2 are going to be first quarters, and then we're going to get into analysts and insiders. This is, let's say, a year, right? We can think of anything related to finance on a yearly basis, on a calendar year, right? Because if you become a public company, you have to do a few things. There are requirements that come with that. You have to issue what's called an annual report, right? And that's just a report, right? A bunch of numbers that just say, okay, we made this much money a year, we lost this much money a year. Because if you're selling your shares to the public, you have to be transparent. You have to be honest about how the company is doing. So as a shareholder, as a part owner of this company, right, you are going to be entitled to all the information about how the company is doing, right? One of the ways you get that is the annual report. You also get those in quarterly reports, right? So we can think of the calendar year as being broken down into 4 quarters. We have quarter 1, quarter 2, quarter 3, quarter 4, and that's just every 3 months a company has to issue their quarterly report. Now this is really useful because it gives you a ton of information about how the company is performing, right? So if I'm Apple, if I'm an Apple investor, I want to know how many iPhones they sold. I want to know how much money they made, because if they made more money, the stock price could go up, I can make money. And if they didn't make as much money, if they didn't sell as many iPhones and demand was weak, or they think demand is going to get weaker, or costs rose, or whatever it may be, right? I want to know, because I may be losing money there. So every stock, every publicly issued stock will have these reports every 3 months, and you'll often see prices move because of them. So if Apple stock is at $100 now, and then there's a bad report, they may go to $80, right? And if in quarter 2, if they have a great report, if demand was strong, that may go back to $120. This is very much something every few months that moves the stock. You'll also hear your earnings season, right? And that's just every few months, a whole lot of companies come out with their quarterly reports, and that often moves the market, like the overall stock market, because if all tech companies did well, the overall market may rise, and vice versa. If a lot of companies are doing poorly, the market goes down as well. And we'll cover, in a little bit. I keep using terms like the market here. What I more mean is indexes, and we're going to talk about that shortly. But again, there's analysts, and these are just the last 2 terms we'll cover here. And then there are insiders. And you're going to hear these terms thrown around a lot as you invest, right? Analysts are people whose full-time jobs are to analyze companies and to figure out whether the stocks are going to go up or whether they're going to go down. So your Goldman Sachs, your investment banks, right? All those companies employ analysts that, again, their full-time job is to say, hey, is this stock price going to go up or is it going to go down? Is the company going to do well or is the company going to do poorly? Now, what you'll often see on brokerages, which are where you buy stocks, right? So, or just in your investment account, right? Is you're going to see a bunch of analysts that think different things about a stock. And you may have one analyst that thinks stock A is going to go up by 40% and another that thinks it's going to go down by 20%. And some analysts are better than others. Generally, analysts will often issue reports about what they think a company is going to do, as in whether they think the stock price will go up or go down. Those are often really useful to read into. What I will say is that, you have analysts A, B, C, you have all these different guys. They all think different things, right? No analyst is a genius. I highly recommend doing your own research and not listening just to one analyst. But overall, if all analysts think a company is going to do well, it's probably going to do well, and vice versa. And overall, that's a great source of information. Now, every time you go to a stock chart, right, in a brokerage or in an investment account, and we'll get into what a brokerage is as well, you're going to see a little tab as well that shows a graph, and this is in addition to the price graph, and it may look like this, and it may have a list of different insiders like the CEO, and it'll show when they bought or when they sold the stock. As a CEO, you're allowed to sell your own stock. You can also buy your own stock if you think it's going to do well. There are rules to that, but generally you can. So if you see that, the CEO of a company you want to invest in just bought, $10 million worth of that stock, that's pretty good, right? If they keep doing that over time, they probably think their own company, their stock is going to do well. Meanwhile, if you see that, say, the president and the vice president of a company just sold a lot of their own stock and they keep selling their own stock, that's probably bad, right? So cumulatively, analysts and insiders are two sources of people that generally do this for a living. Either they run the company of the stock you're thinking about buying, or their full-time job is to research companies like that. So those are both two sources you really do need to pay attention to when you're doing your research and when you own a stock. Okay, now we're going to think about different types of investments, right? We just looked at a whole bunch of terms. First, we're going to get now into types of investments and then into types of stocks specifically. Overall, stocks are the most common form of investment in the stock market, right? And that's just buying shares of a company. And shares and stocks, if I didn't make that clear, are interchangeable, right? So you buy a stock of a company, but it doesn't stop there. And let's think about, let's say you want to buy a technology stock. And let's think about this through the lens of risk, right? Pretty much everything done in finance is just, the amount of risk associated with a given asset. So let's say we'll return to Apple, right? NVIDIA, Microsoft, and let's say Activision. And even though Stripe isn't public, let's just mention it is for a second, right? These are 5 stocks. They're all in technology. So you have Apple, they sell computers. NVIDIA, they are involved in AI and GPUs and so on. Microsoft does more hardware in addition to software, so computers, but also your Office suite of apps. Activision does video games, and Stripe does payments, right? They all do different things. Now, again, you remember what I said of the stock market generally will go up over time, but sometimes, it'll go down, sometimes it'll go up. So if you buy in any one year, you might make a lot of money, you might lose some money, but overall it's going to go up. Well, the same applies to these stocks, right? If we just buy any of these stocks individually, Apple may make 20% this year, NVIDIA may make 40% this year, Microsoft may lose 40%, and Activision may go down by 10%, and Stripe goes down by 10%. if I bought any one of these stocks, right, sure, I might make some money, but I may lose some money as well. And so because of that, you see these bundles of stocks, and those are called either mutual funds or index funds. So here, this on screen. You have a mutual fund, and fund is the key word there, and then an index fund. So what a mutual fund does is it distributes money across a whole lot of different companies, right? So let's say I'm investing $100, right? And the share price of Apple is 200, the share price of Nvidia is, 1,000, Microsoft is 400, whatever it may be. And I have my $100. If I wanted to go buy, say, Apple, right? I could put all my money into Apple, but then, I may make 20%, but I might lose 40%. It's a gamble. So what the mutual fund is going to do, they're going to take $100 from 10 people, right? Or let's say from 1,000 people, right? So they have their $100,000, and they're going to go put some amount of that in Stripe, some in Activision, some in Microsoft, and Nvidia, and Apple. So that way, the price of a mutual fund, and the mutual fund does also have a share price in a sense, reflects all of these. It's an average, right? It's a weighted average of all of these stocks. So, right, in this case, we have 20%, plus 20%, plus 40%, minus 40%. These cancel, and then negative 10, and 20. So these cancel as well. So in this case, even though you have all this volatility here, the price of a mutual fund, right, is really just break even. Because if you bought just a little bit of all of these, right, the same amount of all of them, sure, each one may go up or down, but if you invest a little bit overall, that's going to break even. So what that means is, sure, you didn't make money, you didn't lose money, there's less risk. And again, more risk, more return, less risk, less return. So what a mutual fund does is just limits your risk by spreading that risk across multiple investments. So, in that example, that's break even. But let's say, right, stock A does this, stock B does this, and stock C is kind of break even. The mutual fund will be up just a little bit, right? And this stock went down a lot. This really went up. This one was kind of break even, right? By buying the mutual fund, we don't have to take the gamble of, well, am I going to buy the stock that goes down just by pure bad luck? Instead, right, we just buy this and it goes up over time. And that is essentially what a mutual fund is. It is just a collection or a bundle of stocks. Now, there are two terms here, right? There's mutual fund and then there's index fund, or two types of investments. A mutual fund is actively managed, right? So I spoke of analysts earlier whose full-time job is just to figure out what stocks are good and what aren't. A mutual fund can be managed by analysts, right? So they are going to full-time take your money, right? And then they're going to go buy, say, 100 stocks, not just 4, right? They're going to take your money to go and do that. And then hopefully, right, they make you money. And let's say, the price of a mutual fund is $50 now. Maybe they invest well, and then it goes to $60, right? And you put in $100, you bought 2 shares, you get out 120, you made your 20% return. An index fund is very similar, except it's not actively managed, right? So that just means you may have an index fund that automatically buys the top or the largest 100 companies in a country, right? So in that case, you put in $100 and the equivalent of $1 of all those 100 companies would be purchased. Now, you might think, well, why don't I just buy a mutual fund because I have professionals managing it? That's because they charge a small fee, right? Let's say they charge 1%, and this is a management fee, right? So if you buy a mutual fund, you have other people investing your money for you, and they do this full time. They're probably good at what they do, or we hope so. Sometimes they aren't. They may charge 1% to do that, right? So if it's $50 now, if the share price of the mutual fund is $50 now, and it's going to be $60, right? They actually take 1% of that. So instead of making $20, you make, say, 20 cents less than that $20. And then your index fund is just default, like, hey, you're buying Some computer will manage that. You're buying, say, the largest 100 companies in, say, the US or Mexico or something of that sort. And you do have a few very large indexes that represent generally, say, in the US economy, or in China, the Chinese economy, and so on. In the US, that's like the S&P 500 and the Dow Jones. The S&P 500 or the Standard & Poor's 500 is just the 500 largest companies with some bounds on there in terms of profitability, but generally the 500 largest companies in the country. Same with the Dow. You also have the QQQ, the Spider, and so on. These are all indexes, just funds that are in sum just a lot of different companies that are represented under one all-enveloping share price. So say $80, that buys you a little bit of all those companies. Now briefly, I want to touch on what's called a REIT, or this is REIT. This is a real estate investment trust. If you hear this term and it's somewhat niche, that just means you're buying a company that goes and buys a whole lot of buildings, right? So if you buy into a REIT, they may own 800 buildings or houses, and then they may go and develop and rent those out or so on. That's a very niche term, but you'll hear that often, and REITs are known for being fairly volatile or risky. Now I want to think about two final types of investments, right? We went over stocks, mutual funds, index funds, and then REITs. These final two are options and shorting. I think you need to know about these. They are important and fundamental parts of the stock market and financial markets as a whole. However, these are really, really risky things. They're very high return if they work, but they're very risky as well. So I don't suggest investing in these. You should really just stick with, stocks, just basic stocks first. But let's start with options, right? And let's say we have a stock that is $100, right? This is an asset. We can buy it. If we own it and it goes up, we make money. If we own it and it goes down, then we lose money. You also have what are called derivative assets. And derivative assets are based on the original asset, but there's kind of two layers there, right? You have your stock right here, and then hidden under that, right, based upon that is your derivative metric. And that may sound confusing, but let's just think about that. Let's say this stock, we don't know what the stock is going to do, right? The stock is at $100 right now. It's been going down, just came up a little bit recently, but it's at a price of $100. Now let's say we want to bet upon how it's going to do, right? Let's say I think it's going to go to $120, but you think it's going to go to $80. So we're going to bet whoever is right is going to get $50, right? And that's just between, say, a friend of mine and I. If we do that, we're entering into a derivative game, right? Because we're betting on the original amount, but this asset, this game that we're playing, this betting game, right, is based on the original, and we can make money, but it's not the original stock itself. It is based on the original. It is a derivative of it, right? And a derivative in calculus, if you're familiar with that, is just based on the original, right? Just dy over dx. So in this case, that's just a derivative asset based on the stock. And then you have a few types of very common types of derivative assets. The most common is going to be options. And again, this is really risky, so don't do this. So there are two types of options. There are call options and put options, right? Options essentially are just coupons, right? They give you the right to purchase something at a future date, at a future price. And let's think about that in terms of a coupon, right? Like literally a coupon. Let's say we have a pizza, right? And this pizza right now sells for $10. But you go to the grocery store and you get a coupon, and this coupon says, hey, you can buy this pizza for $8 for the next 6 months, right? The current price is $10. This coupon that, say, the owner gives me at a grocery store gives me the right to buy a pizza for $8 for the next 6 months. If I walk into the pizza shop at any point over the next 6 months, they're going to give me a pizza for $8, even though it says the price is $10, right? We all use coupons or just offers or discounts in our day-to-day lives. This is the exact same thing. Well, now let's say we know we have two cases in the future, right? And this is, say, 6 months out from now. Or let's say on month 5, day 20, like right before this coupon expires. Our two options are that they raise the price of their pizza and now they sell them for $12, or they dropped the price of their pizza and now they sell them for $7, right? So we have our $8 coupon, and in 5.5 months we walk into this pizza shop, right? If they lowered their price and they're selling this pizza for $7, our coupon is useless because we can get a pizza for $8, but the market price is $7, right? They're selling their pizzas for $7. So in that case, there's no point in buying this coupon. It's not worth anything, right? It's just useless. We're going to go in, we're going to pay our $7. But let's say they raise the price to $12. Now we can buy a pizza for $8, but that pizza is worth $12 to everyone else who's buying it. They're paying $12 for it. So we can buy a pizza. We can buy the pizza for $8, and then it's worth $12. What if we also just sell the coupon, right? We got it for free. It gives us the right to buy something for $8. And then a customer walks in and we tell them, hey, look, you can buy pizza for $8 with this. Why don't you give me 10? If you give me $10, I make $2. I'm very happy. And then you can buy pizza for $2, right? And you save $2 as well. We're both happy. We both save money. In this case, the coupon has value, right? Because you were able to sell it to someone because they save money as well. And maybe they think it's going to go to $14, right? And they think it's going to go to $14 next week, and the coupon is still valid for the next 2 weeks, right? They're going to buy it for me because they think, oh, I'm ripping this guy off. It's going to go to 14. I paid 10. I'm going to make $4 when he only made $2. An option is exactly this. A call option gives you the right to purchase a stock at a future time at a predetermined price. And this is exactly the same as what we just went over. So let's say a stock right now is at $100. Let's say I buy a call option, and this call option gives me the right, let me get down here, to buy the stock at, let's not say 120. Let's say it gives me the right to purchase the stock for $80. And then I pay $25 for this, right? So what this does, and let's say this is for 1 year, I'm buying this coupon that lets me buy the stock for $80, one share for $80 at any point over the next year. And right now it's trading at $100. If the stock in a year is at $150, right? So it went up by $50, right? I can still buy this stock for $80 even though it's selling for $150. Well, now I just pocket the difference and I just made $70, right? Because I just buy it for $80, I immediately sell it for the market price of for $150. But of course, this wasn't free. No one's just going to give you coupons to buy a stock. So let's say I had to pay $105 for it, right? I pay $105 to buy it at $80, and then my premium here, what I have to actually pay beyond what I can buy the stock for, is my $25. So I paid total $105, sell it for $150, and make $45. That's all an option is. I won't go more in depth than that. A put option is the exact opposite. It's just with a call option, you think the stock is going to go up. You buy a put option if the stock is going to go down, right? So in a call option, if the stock goes up, you make money. With a put option, if the stock goes down, you make money. And one other type of investment is shorting, right? That is very similar to a put, but not the same. With shorting, you are betting that the stock is going to go down, right? So if the stock price goes up, you lose money, and then if the stock price goes down, you make money. And what this really is borrowing other people's shares. But that's complicated. You can just think of it as, again, you're betting that the stock is going to go down. Now, I just did an hour-long video on debt, just a full sort of breakdown there of, I think, what most matters or should matter to you and what's most important to know when it comes to the matter of debt. I mentioned a lot of debt instruments or debt assets in there, and this is somewhat related to the stock market, but not really, by accessory. Right, you're going to see your bonds, your CDs, and your money market funds. Those are primarily what I covered in that video. These are three type of assets that are you can buy on brokerages, right, on accounts where you buy stocks that aren't exactly equities, that aren't associated with a company. But in some cases they can be, right? They don't have to be, but they can be. So if as a company, right, I want to get the $1 billion, like I'm Apple again, I want $1 billion, I can issue shares. I can also just issue a bond, and a bond is essentially debt. It's an IOU where a company says, hey, you give me $100 now, I'm going to give you $10 a year for the next 5 years, and then in 5 years I'm going to give you your $100 back, right? So in that case, they get money to do something, and then you get money. You make a return, you make a yield on your money. So these are all debt instruments. CDs means certificate of deposit. It's very similar to a bond. It's just companies offer them more so than bonds, and they're slightly different. And then a money market fund is similar to a bond and a CD, except it presents a return constantly, right? So with a bond, you may only be able to get your money back in 5 years. With a money market fund, you can buy out very quickly or instantly, right? So these are all just debt instruments and different types of investments. What's important to remember is that these are lower risk and lower return, right? So the general way to think about the risk lineup here, right? We have, let's just call this risk return, right? Again, risk and returns correlate. The more risk, the more reward, and vice versa. So what we have is, let's put stocks right in the middle. We have bonds, we have CDs, we have money market funds, we have debt instruments over here, right? We have stocks right here, and then we have options there, and then index funds and mutual funds, right, are a less risky version of stocks because you're spreading around your risk. So if stocks are this risky, index and mutual funds on average are slightly less risky. Any bonds, right, they're very, very, very low risk usually, and then options and shorting as well are very risky over here. So that's generally the different type of assets, the different type of investments you can make in the stock market, and then the risk and the return associated with them, with this being maximum risk, maximum reward, this being a lower return, so you make less money, but there's nearly no risk there. So that covers all the different types of investments that are out there. Now we're going to think about different types of stocks, so how to classify an individual stock of a company. The first way we're going to do that is by the general type, and this is sort of the slang type or the way we think about stocks when considering investments. The first of those is going to be value stocks, right? And value stocks are going to be stocks that you buy because you think they're undervalued. And that sounds obvious, but generally we think of a stock of a company as having a true price. And this is what theoretically the price should be at. And people disagree about what it is, but let's say generally the stock is making money. It's going to grow a little bit every year. We think it's worth $100 a share, right? If it's at $120 a share and we think it should be at 100, right? That's bad. We think it should go down as per its true, its fundamental, its accurate price. If the market was fair and wasn't going off hype or just wasn't, the stock price wasn't being influenced by traders trying to, say, manipulate it or make money. But also, maybe the current price is $80, and we think the true price, the true value of the stock or the company is $100 a share. If it's 80, right, it's undervalued. And this relates to value, right? So a value stock is a stock that, for example, is trading, the market says it's worth $80 a share currently, but we think it's worth 100. So you see investors like Warren Buffett, Charlie Munger, guys like that, they make investments in what they think are value stocks often. And these are all usually larger companies, sometimes not, but often large companies that for some reason, right, their price is low when they're making good money, and overall most people agree it should be higher. Then on the opposite side, you have your growth stocks. Your growth stocks are your stocks that are growing very fast. They're growing rapidly. Let's say they're young, they're startups. Often they aren't making consistent profit. Here, let's draw profit. But they're growing very fast, right? So their revenue is up, but they're not stable, right? Their revenue chart may look like this, whereas for value, maybe it's something like this. Growth stocks are your Apples, your Nvidias, your tech companies, right? That are growing fast, and then your whole host of startups like your younger companies. And again, in terms of risk and return, we can think of value stocks as being somewhat lower risk and lower return because they're usually more established companies, and growth stocks have higher risk, right? Because they're young, right? They could look like this now, but maybe they could tank because they've only been around for a few years. But then also there is those higher returns associated with them, as in if you catch them right there, you're going to make a whole lot of money. Then we have cyclical stocks. And your cyclical stocks generally perform in line with the economy, right? We think of the overall economy as going through boom and bust periods, right? So let's say this is GDP of, let's say, India, right? The GDP may do this for a few years, and then it does this, and then up and down, right? You have the booms right there, and then you have the busts right there. Your cyclical stocks are the stocks where the companies associated with them are going to do really well when the economy is doing well, and then when the economy isn't doing so well, they're going to do quite poorly, right? So you can think of an example of that as being, say, your luxury handbags, right? When the economy is doing well and everyone's making money, a lot of people are going to buy luxury handbags. They have extra cash. Then when there's, say, a recession and the economy isn't doing so well, no one's going to buy your handbags, right? Therefore, those stocks, those companies are cyclical. Then we have penny stocks, right? You've probably heard this term. It generally has a negative connotation, like, oh, it's a penny stock. Most commonly refers to stocks trading at under $5 a share, so the actual share price. You can also think of this in terms of market cap. So a small stock with, say, under $100 million market cap could be considered a penny stock. These generally just are smaller companies. Sometimes they're newer, sometimes they're not. And they are typically higher risk as well, right? Because if a penny stock is a company that's been going down for 10 years and now it's only at, say, a $3 price per share, for that to reverse and do really well is unlikely. Generally, too, just the lower the market cap, the smaller a company is, the more volatile it is, right? Because less people pay attention. One investor deciding, or one brokerage firm deciding to invest a lot of money can make it go up, and then vice versa. So penny stocks are generally just a low price. They could literally be a stock that's trading at, like, say, 80 cents a share. And generally, there's higher risk and higher returns there. Okay, there's three more types here. The first of those is going to be your blue chip stocks. So your blue chip stocks are your very established companies, your industry leaders that have been around for a long time, right? We can think of J&J again. We can think of Dell or Intel, McDonald's. These are companies that have been around, they're established, they're profitable, they're making good money. They're probably not going to crash, right? Like, no one's going to stop buying Coca-Cola. The world won't stop buying Coca-Cola next year. But it's also not going to do incredibly well, right? Coca-Cola isn't going to double in size next year. So these are very, very stable companies. They're typically large as well. And they are known for being predictable, for going up just a little bit every year over time. Then we have income stocks, right? Income stocks are stocks that make dividends, right? That pay you to own them because you get income, right, from owning the shares. So generally stocks that pay really, really high dividends, they're going to be known as income stocks. Typically, if you pay a really high dividend, your stock is probably smaller. I spoke of REITs or real estate investment trusts. when the economy is doing well and everyone's buying houses and renting from them, they may pay out 8 or 10 or 12% a year in interest. And it was the same in oil stocks, right, over the last few years. When oil was doing really well, they're paying out 15, 20% a year in dividends. Those would be income stocks. But then there's risk there, right? Because the moment the oil markets drop and the moment real estate stops doing well, then boom, right, they pay you a lot less and the stock price goes down as well. So these are generally riskier if you're talking about really high income stocks, but they also can be stable if you're talking about just stocks that offer good dividends, right? Like your 3% from J&J. Then this last bucket that we're going to think about, it's going to be international stocks. Now, this obviously varies as per the country you're in, and that's just stocks from outside the country that you're in, right? So if you live in Germany, any US stock is going to be an international stock. And if you live in, let's say, Mozambique, right, you can buy into an index of just US stocks or an index of just German stocks. And in that way, you can get international divestment or investment into, a whole variety of different, say, international firms. And the reason people do that is, again, because you're spreading risk out. If India, right, if their economy is doing really well and the economy of the US isn't doing well, if you buy an international index fund, those are going to balance out, right? You're going to be break even or you're going to make some slight amount of money. So in that way, people once more buy in international stocks to diversify, and we're going to get into what diversification really means and how you can do that just a little bit later. Right, so this is all one way of thinking about stocks. We have your value stocks, your cyclical stocks, your income stocks, and people often buy stocks based on these this classification, right? So if I want a stable stock that's going to make me a little bit of money every year, that maybe also pays a dividend, right? I'm going to look for blue chip stocks. I'm going to look for income stocks. If I want to buy a stock and I want to hold it for the next 30 years, maybe I'll buy a value stock. Or let's say I think the economy is going to do really well, maybe I'll buy a cyclical stock and so on. So you can think about the types of investments you want to make and then just work backward through the lens of these different types of stocks. So one other way of classifying stocks, again, is by market cap. We talked about market cap. This is a way of classifying stocks because the market caps infer certain things about the company. I generally just want to give you an idea of scale. So your largest companies in the world are worth just about $2 trillion right now in market cap. So that's Apple, Microsoft, Nvidia, Saudi Aramco, or their national oil company. These companies are worth just about $2 trillion. Those are the largest companies you're going to see, right? Then you have a large distribution, right, all along here. You have your $1 trillion companies, you have $500 billion companies, and so on. Generally, anything over, $100 billion is really large. Anything in the billions generally is large, but anything in the stock market over, say, $100 billion is typically going to be considered stable, right? Because if you have a $100 billion company, you know what your business is, you're making money. That doesn't mean it's a great investment, but it's not going to go anywhere, right? It's not going to go to zero next year. So in that way, 2 trillion is the largest you're going to see in the stock market and of any company in the world, and anything in the hundreds of billions is established. Then on this tail end, right, you have your $1 billion companies, which are still really large. You have your, your $10 million companies, your micro, your nano cap stocks. Anything under 100 million, and we just covered this, right, is a penny stock that's considered very small and very risky and volatile. And then between this range of 100 million and say, 100 billion, those are all stocks where they can be risky, they cannot be risky. It just really does depend on the specific stock. So thus far, we've looked at a number of ways of classifying stocks, right, that all impact how you should consider them and how the stock likely performs or acts over time, right? We looked at market cap. If you have a larger market cap, you're probably more stable. A smaller market cap, you're probably more volatile. We also looked at the type of stock by their sort of slang or their unofficial term, like your penny stocks, your blue chip, and so on. Now we're going to look at one final type of stock, and that is by the sector or the industry of the company at hand. So let me just write that out. And this is important for the same reason. It actually impacts how you should buy them. And depending on your investing goals and what you want to get out of investing in a certain stock, right, that determines the sector you should consider investing in, right? We can think about tech as an example, right? Tech is known within the stock market as being volatile, as being, very high growth and growth oriented because it is a really new industry. And you've seen in the last 20 years, right, nearly all of the world's largest companies go from nothing to being, technology leaders at multi-trillion-dollar market caps, right? Again, your Apple, your Nvidia, your Microsoft, and so on. And because of that, if you're investing in a tech stock or in the tech sector or industry, you probably, right, are going to get high returns, are going to get high growth. But there's also the risk factor of, well, if this thing slows down, it could do really poorly, right? And then that compares to something like utilities, right? With utilities being your heating and companies of that sort, right? These companies aren't going away. They're going nowhere. People are going to need electricity. They're going to need their heating and so on. And that does differ from the tech sector, in some ways for better and in some ways for worse, right? So if you invest in, say, utilities, you're probably getting a lower risk, a more stable play, even though the returns could be less there. Now I'm just going to write out some other sectors or industries that we can think about the market dynamics of those specific sectors. First off, we can think about pharmaceuticals. This is similar to the the utility sectors, and people need their drugs. If there's a recession, people are still going to go and get the basic health necessities that they need, right? So pharmaceuticals are also known for being your slightly larger, your sort of behemoths like your J&Js. They will produce more stable returns over time. But then you have niches like your biotechs, and biotechs, while still health related, right? Those are your newer companies that are smaller and focused around one very specific, say, new drug or a few drugs, right? Those may be more risky. They may be betting on one drug that if that gets FDA approval, then it'll do really well, right? So you may have a subset of, say, the pharmaceutical industry, like your quote-unquote biotechs or your biotech startups. Those are going to be more risky and higher return plays. And then we have consumer staples, right? We have energy. We have all these different industries. Here, let me write some of those out. That all have different dynamics, that are all usually trade in different ways. And we talked earlier about the cyclical stocks, right? All of these sectors or industries, they usually are cyclical in that they trade in a certain way. They group together in a certain way, right? So you rarely see half of, say, energy stocks do really well and half do really poor, right? You usually see most energy stocks move together, right? If oil prices go up, if electricity demand is strong, and those are separate energy markets, right? The oil market is not the same as the electricity market, but they're still oftentimes going to move together. And same with tech. Hardware versus software, those are very different things, but you will still generally see tech stocks move together. And that doesn't mean there's a lot of variance within there, within the tech industry or sector, but stocks still generally move together, right, in line with, say, the overall market or perhaps against it, and so on. So in that way, all of these sectors, all of these industries act in different ways, and you can backward induct which sectors or industries you should invest in, right, by considering the standard practices, the standard behavior, or just the norms of these sectors and industries. And that ties overall into how you should pick stocks, right? And we're going to get into strategy a little bit later. But one way you can figure out, and I'll just touch on this briefly, one way you can figure out which stocks you want to invest in is via sort of a funnel, with that funnel being, I want a stock that is high growth, that could do really well over the next 5 years. Well, you can start at the top with the sector, the industry, right? So let's say we want to choose energy. We think energy is going to do well, right? Then you choose the specific product or service you believe in, right? So let's say within energy, we think oil is going to do really well. There's very strong demand for oil. So then we want to go from energy into oil stocks, right? And then within oil, we want to look at, say, smaller companies because we're looking for higher, return stocks. Then we can look at a list of stocks in the energy sector that are in the oil business, whether they're refiners, whether they're drilling, or so on. And then we're going to look for companies that have, say, under $1 billion market cap, right? So relatively speaking, your small oil companies. And then finally, we're going to get a list of, say, 10 companies we can then do further research into. So starting with the sector, starting with the industry is a very common way of approaching investing via a funnel in this way, whereas the alternative is, off the bat, you know which company you want to invest in because you used a product of theirs, you used a service, you think that you had a great experience with that, and you think the company is going to do well, right? But this is a way of, hey, if you don't know what stock you want to invest in or what company you want to invest in, you start with the sector. For that reason, knowing the behavior, understanding these cycles, these standard cycles and behavior of sectors is important. So we've looked at a bunch of different ways of classifying stocks, right? By their size, by their industry. What we have yet to do is look into how to judge the quality of specific stocks, as in how to look at one company versus another and say, hey, this is a better investment, this is a better stock to invest in, given that we want to make money and we want the value of our shares to rise versus, say, another stock. So first we're going to look at fundamentals, at fundamental metrics, right? There are generally a few ways via which people choose which stocks to invest in and how they research and analyze stocks. Fundamental analysis is one of those, right? And I'll get into what that means. Another is hype analysis. And I did briefly touch on this in another video as well. And then your third is going to be technical analysis, right? So every investor in the world does one of these three things. And technical analysis is investing or trading based off the chart of the stock. And technical analysts look for patterns and they try and figure out, hey, if this pattern works in this stock, as in, let's say this is the price of a stock. They'll go and they'll say, hey, this pattern, right, means that the stock is going to go down there, right? And then they look for that pattern in other stocks. And if they see the same pattern, they'll buy, or in this case, they'll short the stock, and then they'll take profit if it does behave as they think it will. It generally is not so formulaic like that. It is more difficult, to figure out how a stock is going to move or perform based on purely its chart. And for that reason, technical analysts generally don't do well across the board. I'll put up a screenshot of that. And the ones who do well, they're there 24/7, right? It's their career is just figuring out, hey, these patterns work, these patterns don't, and creating algorithms based on that. So generally, if you're starting off investing, you're not going to touch technical analysis, right? Then hype analysis is exactly as it sounds. It's trading off hype, right? And that could be, and I think crypto is a very good example of this. And this is not as someone who dislikes crypto. I've done a lot of work in the space. I've written several books on crypto. But it is very much a hype-driven space. As in crypto, if you think a bunch of other people are going to get into a coin, right? Let's say Ethereum as an example. If everyone else, right, is buying Ethereum, then you want to get into Ethereum, not because you think Ethereum is a great coin or a great equivalent, right? It has fundamentally great value when it's going to increase in value, but just because you think it's going to go up and then it's going to crash and you want to buy here before everyone else gets in, right? And that fundamentally is trading on interest. It's trading on the hype or the fact that a lot of other people are going to invest and you just want to get there before them. In a similar manner to technical analysis, right? Hype analysis usually is not as successful as alternative means of investing. And that's just because fundamentally you're gambling, right? You're hoping that you get in sooner than other people. And some people win playing that game. Some people do really well. And if they do well, it's because, again, just like technical analysis, they're in there 24/7. They have their ear to the ground. They really know what they're doing. So hype analysis can work. Technical analysis can work. But if you're just getting into investing, you don't want to, I think, pursue those two means of analysis. That leaves us with fundamental analysis. And fundamental analysis is the way in which the vast majority of stock market investors and analysts and professionals and just everyone across the board picks stocks, right? In fundamental analysis, the key word here is just the fundamental, in that you can think of the core of a stock of shares, right, just being what does it do, right? What is the product or service, what's its revenue or what are its financials, and then what's the market and what's its strategy. And these are just some aspects that form the core of a business, right? You can say all you want about a business, about a specific company, but generally, if you consider, hey, what specifically does it do? Do people want that? Is it in demand? Is the market growing? Is the market shrinking, etc.? And then, well, okay, is it making money? Is it going to make more money? Did they make a bunch of bad decisions with debt, right? And now they can't pay people, they can't pay their loans back. And then strategy, right? Based on all these things, what do they think about the market, about their financials, about their products and services? Where do they think that's going to go? And then how are they planning? How are they changing their strategy based on their estimation of these variables? That's just part of, again, that core, that fundamental core of a stock or company. So fundamental analysts trade based off these things. And as an example of that, let's say you just moved to Mexico from the US and you try Mexican food and you say, hey, Mexican food is incredible. Mexican food is really good. It's a lot better than the food back in Nebraska where I lived in the United States. So then you go back to the US, right? And you say, hey, I want to invest in a Mexican food chain or restaurant, right? And you want to do that. Why? Because you think the market will grow. Because you said, hey, Mexican food is good. All the people in my state, I think they'd like it as well. So there's going to be a lot of demand there, right? And then fundamentally, you think the product or service itself is going to do well. So say if you invest in Taco Bell, you think the tacos are going to do well. You think Taco Bell provides great tacos and they have a lot of locations so people can access those products. So in that way, if you choose to invest in the Taco Bell stock, right, you just did so because of fundamental analysis, because you looked at some of these fundamental metrics like, well, what's the market, what's the product, and then say, is Taco Bell properly valued or does the market undervalue it? Are most people who invest not thinking about the fact that Mexican food as a business is going to expand, say, in the US? So let's break down some facets of fundamental investing. And there is a lot more to cover here. I did literally write a book about this stuff. What I will do is I'm going to put a document, I'm going to link a document in the description that has a much longer and more complete overview of fundamental analysis. Just think of this as a brief, right? We can start with just your very basic metrics about a company, right? With those being their revenue, their profit, right? And then their expenses. We can also think of expenses as costs. And now the better way, the more realistic way to think of expenses or costs, or in addition to that, right, is assets and liabilities. And this is just sort of the financial view of the fundamentals that drive certain companies and stocks, right? Revenue is just the amount of money that a company makes. Profit is the revenue minus their costs, so how much they're taking home after they pay all the bills they need to pay. Expenses is what they owe or what things cost, and then your assets are what they own, and liabilities are what they owe, right? So generally, the more profit you're making, the better. The more revenue, the better. You want costs to be as low as possible, and then the more assets versus liabilities that you own, the better, right? So, having $1 billion as assets and great. Having $1 billion in assets is great, but if you owe, say, $2 billion in liabilities, right, the actual difference there infers that you owe more than you have, which is bad. So what really matters too is, well, how much in assets do you have versus the volume of liabilities that you owe? Now let's think about how that translates into some specific fundamental metrics about a stock. First off, right, let's create a little graph here. We're going to put price on this axis, P for price, and then let's just do D for date on this axis, right? And then let's say this stock chart looks like this. This price right here is $100. This price is 60, and this price is also just about $100. We can look at the period, right, and you're going to see this with any stock market website you go to. If you just Google a stock, you're going to see what's called the 52-week range, and that is here. Let me write that out. That is going to be the high versus the low, right, of a stock price, in this case over the last year, over 52 weeks. And what this does is give you insight into how volatile the stock is. It's a really easy way of looking at that, right? So if we look at this stock chart, we saw the low was right about there, and the high, since these are about equal, this is just a little bit higher, is right about there, right? So the 52-week range is going to be this low price and this high price. So let's say $106, and then the low was, let's see, that's just about $65. Now what this does is tell us, it gives us a whole lot of information about a stock, right? Let's break that down. We know the highest price the stock has been out over the last year. Now, if the current price of a stock is right up where the high is, we know, okay, this stock is hot. It's done really well over the last year because right now the price is the highest it's been over the last 52 weeks, over the last year. Meanwhile, if the stock is near the low, right, if the 52-week range is $65 and its its open price or its strike price is $72, well, that infers, hey, the stock isn't doing so well. It's right near its low. And that can mean different things to different people. If you are fundamentally investing because you think the stock is undervalued, because you think it's under its true price, then maybe you want it to be at $65. Maybe you want it to be near its low because that means there's a lot of room to grow, right? And you may think, hey, you're investing right here, and then over time it will go up. In other cases, a stock has done really well, and maybe you think it's going to do even better. So the fact that it's near its highs doesn't mean anything to you. And if it was near its low, right, that would infer something bad. That would mean, hey, look, people don't think this is going to do well. I was really only here because other people were investing, and maybe I shouldn't invest because of that, right? So these mean different things, but what you need to consider, right, is just the information that it does provide you. Now, this also is an insight into the risk or the volatility, because generally a higher trading range, a higher 52-week range means that the stock is more volatile. This company is more likely to go up or down and have big swings. So let's think about two 52-week ranges to illustrate that. One 52-week range is $8 to $10, right? Another 52-week range is 80 cents to $120, and then let's say in this case, dropped my pen. The other case, the current price is $80, right? And then here it is $9.80. So we have two cases, right? The trading range here, 80 cents and $120. That means over the last year, at some point, the stock was as low as 80 cents, and at some point it was as high as $120. And then we know the current price is $80. And then we have this 52-week range, right, in which case the low over the last year was $8, and then the high at some point over the last year was $10, and the current price is $9.80. Well, let's think about what kind of information this gives us about these two stocks. This stock traded within a very narrow range, right? It was at $8. $8 was its absolute low. $10 was its absolute high. That means it only varied by 20% over the course of a year. And then right now, it's very near its high. And what that infers is that there's some element of stable growth, right? Because this, let's say it started out at $8 here, and then it's at $10 here. It's unlikely over that 20% to have done anything like that, right? It's much more likely to have been this sort of stable upward curve. So this is a less volatile and a less risky investment. Meanwhile, this stock started out at 80 cents, or maybe you started out at $60, whatever it started out as, it hit as low as 80 cents per share, and then now it's at $80 a share, and it used to be at some point over the last year at $120 a share, right? That chart could look something like this, right? That's just an incredible just maze of risk, essentially, because if it, if the stock acted a certain way over the last year, you can be fairly confident it's going to act that way over the next year, not in terms of it going up or down, but in terms of the spread or the risk, right? So a stock that is as volatile as this one, say that traded within a range of 80 cents and over $100, it may be less volatile the next year, but it won't be that less volatile, right? It's not going to instantly transform from a chart that looks like this into a chart that looks like this. And maybe that's good for you, right? Maybe you want the risk and you see it at 80 bucks and you think, hey, it's going back to 120. It really just does depend on what you want, and what's critical is the information that we can get from looking at something like, in this case, the 52-week range, right? And that's just one of those fundamental metrics that we're looking at. Now I want to introduce a few specific metrics, a few ratios, right, that also give you a lot of this information and insight into a company. Our first one is going to be EPS, right? EPS stands for earnings per share. Let me outline that. And that is just how much money does a company make per share. And that, here, I'll make this a little bit larger. What that ratio breaks down into is profit divided by shares, right? So what this does is give you an insight into the profitability of a company, into how much money that company makes compared to its value. Now this gives us a window into, I talked earlier about true value, into whether a stock is overvalued or whether it's undervalued, right? And we can think of that theoretical true price, like, hey, this stock is properly valued. We can think of the price as either being below that, so undervalued, or overvalued. Now, if a company has a very, very high value but makes very little money, it's more likely to be overvalued. Meanwhile, if a company makes a whole lot of money, they make $1 billion, but the company or the market only says that the market cap or the value of the company is $100 million, right? Then it's probably undervalued. And these are not rules, right? Just general trends. So let's think about, as an example, a company that makes, they do $1 billion a year in revenue, and they have $600 million a year in costs, right? And then their market cap, let's say, is $500 million. And then their market cap is 500 million, right? So let's organize this a little bit better. What this tells us, right, off the bat, $500 million market cap, $1 billion in revenue, and $600 million in costs, is that the profit, right, is the difference between revenue and cost. So they made $1 billion, they spent $600 million. That means their profit is going to be $400 million. And then we know the market cap is $500 million. And then let's say they have 100 million shares, right? So if they have $500 million, that's the value of their company, their publicly traded shares, and then they have 100 million shares on the market, then that means the value per share, the price per share is $5, right? 500 million divided by a million. So we have $400 million in profit, right? And then we have $5 per share for our 100 million shares. Well, to think about earnings per share, right, which gives us an insight into the value of the company, we just need to divide this $400 million in profit by this 100 million shares, right? So we have 400 million divided by 100 million. Let's write this out. We have, to simplify it, 400 divided by 100 is 4, or in this case, 400 million divided by 100 million is still going to be 4. So what that means is the earnings per share is $4, right? And this should be intuitive. All this is saying is that you're going to make $4, or the company makes $4 in profit for every share that's on the market. Alone, that doesn't mean anything. That doesn't mean much, right? Although it does tell you if it's profitable, right? So if this is a positive number, then you know that the company is making money, that it is profitable. And then if that is a negative number, you know, hey, the company is losing money because for every share on the market, if that's negative 3 cents, right, if it's negative $1, they're losing a certain amount of money. So that really is just, and this in this case, that just tells us this company for every share on the market makes about $4. And what is, again, less important is just this $4, and more so, did this go from $3 last year to $4 now, or did it go from $5 last year to $4 now, right? If we think or if we look at earnings per share over time, that gives us an idea of compared to the value of this company, compared to the market cap of it, right? Is it doing better now, or is it doing not as well now, right? So in this case, you may have some standout quarters like this one, say, did really well this quarter in terms of earnings per share, but this overall trend line is positive. That generally means compared to the value of the company, they're making more money, right? And that's generally a good thing. Meanwhile, again, to the inverse, if a company is making less money per share, well, that's bad. That means they're less efficient, right? And you know, an example of this is, say, Tesla versus Coca-Cola, right? Tesla, when they just started out, they were burning a whole lot of cash. They were spending a lot of money, but they had an extraordinarily high market cap, right? So in this case of Tesla, let's theoretically say they have a $600 billion market cap. They have 100 million shares on the market, and they're losing $1 billion a year. Well, their earnings per share is going to be negative $10, as in for each share on the market, for each of those 100 million shares, they're losing on average $10, right? Because this formula of profit over shares is just $1 billion over 100 million, except now this number is negative. So in that way, this tells us a lot about Tesla. This says, okay, hey, they're burning a lot of cash, but a lot of people believe in them. A lot of people think the company is going to do better because this is so high, because they have a $600 billion market cap, even though they're losing money. Meanwhile, in the case of, say, Coca-Cola, or a company that's been around for a while, they may have a $200 billion market cap and do, you know, $100 billion a year in revenue, right? And excuse me, let's say $50 billion a year in profit. And in that case, they're making a lot more money, a lot more profit per share. Now, another metric that is similar to your earnings per share is your P to E ratios, your P to E ratio. And you're going to see a lot of P over various numbers like price to sales and so on. I just want to right now focus on P to E. What P to E means is price to earnings, right? And this compares the price of the stock to their EPS, to their earnings per share, right? So earnings in this case just means EPS. And this gives us an idea of the multiple of the stock price compared to the amount of money they're making, which sounds confusing, but all that's saying is if your P to E ratio is higher, right, then you're making less and worth more, whereas the lower your price to earnings ratio is, the more you make and the less you're worth. So for example, right, let's say the stock price is $100 and their EPS is $2, right? Your P to E ratio is going to be 100 divided by 2, or 50, right? So a 50x ratio, or a 50x multiple, because the multiple of your price compared to earnings is 50, as in 100 is 50 times more than 2. If you have a 50x price to earnings ratio, right, and your competitor has a 10x, well, what does that mean? That means compared to your competitor, you are making less and worth more, as in the price per share is higher even though you're less profitable, even though you're making less money. Now again, you have to consider things like price to earnings ratio in context, because some industries are known for higher price to earnings ratio and higher P to Es and so on, while other industries are known for being more conservative. So there's a few different lenses to consider price to earnings, right? One is objectively, what's the number at? Is it 150x or is it 2x, right? Another is compared to peers, and this really is critical. And what this says is compared to similar companies, is this overvalued or is this undervalued? So let's say we have Coca-Cola. We have Coca-Cola, and then we have Red Bull, and then we have Starbucks, right? Very different businesses, but let's just say generically they're all in that beverage niche, right? Coca-Cola sells Coca-Cola and a whole host of other beverages. Red Bull is in the energy drink space, and Starbucks is in the coffee space. Now let's say Coca-Cola, right, their P/E ratio is 2x. So they may be, their earnings per share might be $8, and the price of the stock is $16, right? So there's a 2x multiple there. Red Bull, right? Red Bull is at an 8x. So say they make $4 a share and the price per share is $32, right? So P/E is 8. And then Starbucks is right in the middle. They're at a 4x, right? This gives us a lot of information about any one of these stocks compared to its peers, right? Let's take Red Bull as an example. Their price to earnings is higher, right? That means people believe in them. They're more willing to invest in Red Bull despite the fact the competitors are making more money, right? As in Red Bull is worth more despite making less. And if it's worth more despite making less, there's probably a reason for that, right? Maybe people think Red Bull is going to grow faster, or they're making a strategic acquisition and they're going to grow, they're going to do a lot more in revenue next year. So people think, hey, this is 8x now, but it's going to go to 4x because it's going to grow so fast, and then it'll be in line with these other guys, right? Whereas Coca-Cola is more, established. It's more conservative. It's not going to do anything crazy, but hey, they're making good money. They're making a 2x, so maybe you can buy them for that reason. So in that case, you can compare to peers. You can objectively just look at, hey, is this undervalued or overvalued? And then perhaps most critically, you can look at EPS or earnings, or EPS, we're on price to earnings. You can look at the P/E ratio over time. And all this says, and this is within the scope of a single company. So, let's get some more space here. Let's say we are considering investing in iRobot, right? And iRobot makes things like Roombas, so basically hardware devices that say clean your house. And the earnings per share the price to earnings ratio of Roomba or iRobot is this. What this says, and this can mean different things, but let's say this is the P/E ratio. The P/E ratio is strongly trending down. And considering the price to earnings only weighs two factors, either earnings per share or the price of the stock, this can only mean one of a few things, right? One is that the price went down, right? Because if earnings per share stays the same and the price goes down, well, the multiple collapses, right? 100 to 2 goes to, say, 50 to 2, and that's 25 versus 50x. So the price went down, or the earnings per share went up, right? Which just means really they made more profit, or that's likely the case, or some combination of these two things, right? This gives us a lot of insight into the company, because off the top of our heads, if we looked at a chart of theirs, right, and let's say the price didn't actually decrease, right? The price was stable over the last year, but your P/E ratio really went down. Well, hey, that means they made a lot more money. They made a lot more profit. And if they made a lot more profit, that's really good in the case of the stock, right? Because that means they did something internally. They cut costs. They had a new product. Now they're making more money. Meanwhile, the inverse could be true as well, right? Perhaps actually they didn't get more profitable, but they said, hey, next year we're going to come out with a really good product. And for that reason, the price went up, right? And so the P/E ratio went up as well. So that's just one of those fundamental metrics that really a lot of people look at. And that also gives you a lot of information about a stock just through the lens of that one number. Now, we talked about dividends earlier, just to touch on that again. If you see, here, let's go back to iRobot. If you see iRobot and you see the dividend yield being, say, 2%, that means for every share of the stock that you own, they're going to give you 2% of that per year in cash, right? Or just 2% of whatever dollar amount you invest. Now that people can buy fractional shares, which just means instead of buying 1 or 2 or 3 shares, now you can buy half a share, right? So if the stock is at $100 and the dividend yield is 2%, then you're going to get $2 a year per share of the $100 stock you own. If you invest, say, $533, then you're going to get $10.60 for owning it, right? Just 2% of the amount that you invest. You can also look at the next earnings date. You're going to see this on or near the chart of a stock. Next earnings date is just when those quarters are hitting, right? We have Q1, Q2, Q3, Q4. If we're right here, if we're in, say, November, and then December is coming up and they have their quarterly report for Q3 coming out in, say, late December, right? Earnings date just tells you when they're going to have that report. And that is, again, useful information for all the reasons we went into relating to their quarterly and annual reports as well. I'll also note that generally a lot of companies see very good results in the third or fourth quarter. You see, say, Walmart, Amazon, Target, like your retailers, they're going to sell a lot more because of holidays in that fourth quarter. A lot of companies also have a slow start to the year. They have a slow Q1. This also varies, obviously, as per the company in hand, but generally you are going to see sales pick up throughout the year, with your holiday season being when most companies perform the best in terms of sales, revenue, and so on. So if you see really good Q4 results, well, hey, it's probably not going to be as good for the Q1 or the first few months of the next year. Now that covers some of those core fundamentals of a stock. Now on this note, what we're going to cover next is earnings, right? So, what I said earlier was every few months stocks will have their quarterly reports, and those quarterly reports are called earnings, right? Where they detail basically how much they earned. They're going to go over and they're going to release a few documents that are really important to understand on those earnings calls. There's quarterly reports and also their annual report, which is also an earning call, right? Those are synonymous terms. Now, those few documents are also just generally really important in the business world, right? If you generally want to understand how a company works, how it operates, how it makes money, what they're spending money on, whether they're growing or getting smaller, just their whole, directly their financial situation, but just the whole situation of the company as well, you're going to need to understand these few documents. So let's just briefly cover what those are. And these generally are, this is information relating to earnings, and that this information, these documents will be discussed on an earnings call. The first of those is the income statement. The second is the balance sheet, and the third is the cash flow statement. Now, if you start a business as well, you're going to need all three of these documents. They're extremely useful just when it comes to tracking money in the operations, the financials of your company. And again, these are also, every business, whether they're public or private, that's established will have their income statements, their balance sheets, their cash flow statements, and so on. This just generally is very core, very important knowledge to just wrap your head around. Your income statement covers your revenue, your expenses, and your profit, right? And let's just focus on that for a second. Basically, the income statement is how much money you made, how much money you spent, and the difference, right? So the take-home amount of money there. And, you know, in economics, and I touched on this briefly, but we have profit, right? We have PR is equivalent to revenue, and in economics, that's called total revenue, or just overall the amount of money you brought in minus your total costs, right? So profit is revenue minus costs. And then this all breaks down, right? Total revenue breaks down very simply into the quantity of goods sold times the price, right? So if we sold 100 units of our product for $100, right? Then our total revenue is going to be just 10,000 bucks. And then total costs is going to break down into, and here I'll come over here, that's going to break down into costs multiplied by quantity, right? So your cost per unit times the amount of goods sold. This does vary as per sort of fixed and variable costs. If you know what I'm talking about, you know what I'm talking about. If not, don't worry about it. But generally, your income statement is going to break down all of these things. It's going to say, okay, this is the overall amount of money this company made, right? Based on the number of units they sold and the price they sold each unit for. And then it's going to break down where that money went, so what they spent it on, right? Did they take on debt? Did they spend it on creating, right, the products if they're a manufacturer? Just overall, right, where did that money go? So it's going to cover those revenues, those expenses, and then just the difference. So the total revenue, which is right here, minus those total costs. That's just the first. Then we're going to get on to the balance sheet, right? Income statement is very much the active nature of the business. It's, oh, right now, how much money are we making? How many units are we selling? And so on. The balance sheet is a very similar document, but very different in that it covers primarily your assets and liabilities. Right, and again, this is not the same as income. This is not the same as the amount of money you make. Here, I'll write this out. This is what you own and what you owe. So let's make that very clear. Own and owe. So if you want to see how much debt a company has, right, who they owe money to, the amount of real estate, the amount of product, right, the amount of the value of the tangible assets and intangible assets of a company, right, all you need to do is look at the balance sheet. This is very useful information. And to recap once more, an asset is just something that you own, a liability is something that you owe, right, to someone else. So if a company has $1 billion that they owe to a bank, if they owe investors money, right, if they owe their own customers or partners or suppliers money, right, those are all going to be under liabilities. Meanwhile, the amount of equipment that they own, if they own, say, company vehicles, the real estate, so the company office, the IP, right, the patents, the trademarks that they own, those are all going to be under assets. Now, objectively, right, this is useful information. Like, if we know that a company has $100 million in assets and $200 million in liabilities, that's bad. That means that they owe a lot more than they have. And generally, you want to see more assets and fewer liabilities. But also what matters is the ratio, right? Not just, hey, they have 100 million here and they have 200 million there, but how much more of one versus the other do they have? So if you have $1 billion of liabilities, that can be scary if you have only $500 million in assets. But if you have $2 billion in assets, well, that's a lot better than than owing more than you own. You also want to look at these things over time, not just in comparison to each other. So if your liabilities are, say, trending upward, and your assets are trending upward and your liabilities are trending downward, well, that's good. Even if you have, say, 100 million assets and 100 million in liabilities, if your liabilities decreased by 100 million last year and your assets increased by 100 million, right? Well, that's better than the opposite. That's pretty good in terms of where these trends are going. What also matters is the type of the assets and the liabilities that they have, right? If a company has $300 million in short-term obligations or short-term debt, that means that they're going to need to pay someone back to the tune of $300 million very, very soon, right? And to do that, they need $300 million in assets, right? So that's very different from the type of liability in that maybe they owe someone money, but it's at a 1% interest rate and they have 20 years to pay it back, right? So the type of debt, the type of, hey, how much do I owe you, but when do I pay it back, and how much do I need to pay you back? And then also the type of assets is important. If a company owns a lot of real estate, right, let's say you're WeWork, maybe you have a lot of assets now, but if you, as an investor, think the housing market is going to do poorly, well, maybe you can predict, okay, the amount of assets they have will decrease because they own all this real estate that's not going to go anywhere over the next few years. So just like earnings per share and price to earnings, or your P/E ratios, all of this matters in context. It's not just the number, it's where did the number used to be and where is the number going. Now the third statement here is the cash flow statement. This one is easier to understand in that it is exactly how it sounds, right? Let me write out. Cash flow statement describes how cash flows through a company, right? So you're going to make money in some way, you're going to make a certain amount of cash, and then things are going to be done with it, right? It's going to be spent on, say, paying your employees and investing in R&D and getting a new office, right, or expanding your production line, and then that cash leaves, right, in a certain way. Like, hey, you spent it on your own employees, you spent it on debt or liabilities. So the cash flow statement versus these other two these other two sheets gives you an idea of how the money moves internally, right? Assets and liabilities is just how much you own and how much you owe. And then your revenue, your profit, your expenses is very much just on the outside, okay, we made this much money, we spent this much money, and this was the difference. Cash flow statement is well, hey, what are we actually spending this money on, right? What did we invest in to make more revenue this year? Or why did our expenses go up, right? What do we spend the cash on, or what got more expensive, right? For our expenses to go up and then our profit to go down. So in that way, the cash flow statement is a very useful tool to understand not just these numbers of, okay, profit went up and liabilities went down, but what's actually being done with the cash, right, to go and do things and to produce these outputs like, okay, the stock price is going up because earnings per share went up, and then the value, say, of their IP went up or something of that sort. Now, those are the three main documents that are detailed on an earnings, a quarterly earnings call or report, right? Your income statement, your balance sheet, and your cash flow statement. You're going to see one more part or a few more parts at the end of those calls. And you can always join these companies' earnings calls. They're always live and recorded. In fact, companies are required to make sure their investors can access those quarterly calls. But you're also going to see a Q&A, right? And then you're going to see predictions. And these are two very useful parts of an earnings call to pay attention to and to listen to, and they do move the price of stocks. And the reason that happens is because, if one thing is being clear, hopefully over the last 30 minutes, is that once again, these things matter in context. It's not just how much money you make, but it's how you make it. It's whether you're going to make more, whether that's going to go up or down or so on. Q&A and predictions are kind of where the company can put they can give you an idea of what they're thinking about all of the context for all of their financials and the fundamentals about their company, right? So a Q&A is exactly that. It's an opportunity for your professional analysts and your just standard, say, shareholders, like someone who owns, say, 100 shares of NVIDIA, right? To ask the senior executives and the board members and so on about the company. Right, if a company has been avoiding some sort of scandal for 3 months, right, this is when the CEO, right, has to answer a question about that. And if the CEO dodges that question, well, maybe the stock will go down, right? So in that way, it's a very good public square where you can get insights into what is the CEO actually thinking, what are all these executives feeling, and what are they thinking about based on the hard questions that are asked to them by analysts and shareholders or stakeholders. Now, Q&A is them asking or answering questions, right? Predictions is a statement they'll make or a talk they'll give about where they think their own company is going. So as the CEO of a company, right, you really need to know, or you're in the best position to know how your company is going to do, right? If you think you're going to sell more, say if you're good next year, right? Or you think that there's going to be less demand, so you're going to sell less, or costs are going up, so you're going to make less profit even if you sell more units, right? All of those are forecasts and really do move stocks. So if a CEO of a company comes out and says, hey, we're going to make less money next year, right? The price of a stock will nearly always go down. Meanwhile, if a company says, hey, we're going to make a lot more money next year, we're going to do really well, right? Then obviously the stock is going to go up. People are going to take that as a good sign. And what matters is not just their predictions, but it's how their predictions lined up with analysts' predictions, right? So your stock analysts are going to go out there and say, hey, we think this company is going to make $2.3 million in profit this quarter. If they come out and say, okay, we made $2.4 million this quarter, and that's great, we beat analysts' expectations, but we're only going to make $1.8 million next quarter, and analysts said, oh, hey, they're going to make $2 million next quarter, then the stock could go down, right? So predictions matter in context. You could do better next year, but if you do less good than the analysts think you should do, or if you do worse than competitors, then you can still, the stock price can still go down. But in that way, this really, again, is the public square. It's the way for the executives of a company to share with the public and with their investors and analysts about how they think the company is going to do, and to respond to some of those common questions that investors have, whether that's about new products, whether it's about, again, a scandal, or just generally say how they think certain challenges may impact the company or opportunities. So that largely covers some of the ways in which we can understand, we can get information about a stock, whether that's reading their balance sheet, whether it's looking at the industry or the sector that they work in, or that's reading through and listening to the Q&A provided by a company at their earnings call. Now what we're going to do is we're going to get into the strategy and tips and recommendations I have when it comes to actually investing, right? So the strategy of it. Now, immediately after this, we're going to get into, the next steps you can take right now to go and open an account and make your first investment. This is just going to be, okay, hey, you decide you want to start investing. You now know how to pick good stocks. Well, how do I go and how should I act if a stock goes up or goes down? Or what rules, what guidelines, what habits should I have that will make me a better investor? And the first point I want to make clear is you absolutely should have a strategy. And this depends upon a few things, right? Number one is, what do you want to get out of investing? I think number two is, how old are you and how much money can you put into investing? And then C, what's your risk profile, right? Are you looking to take on a lot of risk and make a lot of money, or do you want something more stable? And all of those things just depend upon you and the context of your life and what you want and the kind of investor you are. Some people prefer the really exciting stocks, right? The oil stocks, the growth stocks, the startups of the world that go up and down and up and down. Other people just want to put their money in and never think about it again. And both of those are great. It just comes down to what is best for you as an investor. And if you're 20 years old, right, you have 40 years, you have a long time to invest. For that reason, you can afford to take on some more risk, right? Because on average, risk may make you more money, even if there's some losses on the way. But if you have 20 years, if you have 40 years throughout which you're investing, you can take the little down here and the little down here as long as overall things are going up. Meanwhile, again, if you just want to make some money, because in 5 years you're going to retire and you have a bunch of money sitting in cash right now, maybe you just want to put that in the S&P 500, or you want to put it in an index, right, a mutual fund where there's less risk, but you're also going to, on average, make less money. But approaching it with a strategy, starting to invest, thinking, hey, I want to invest for the next 40 years. I want to invest just in mutual funds or just in stocks, or I want to learn about options, right? Approaching it with that mindset of, okay, here's what I'm doing, here's the plan, and I'm going to stick to that plan. That is the much better way to do it. The reason for that is because money is inherently a very emotional thing, right? We all care about money. We all put a lot of effort into money, and it matters. It's an important thing at the end of the day, right? And if people hate one thing, right, it is losing money. People will do crazy things to make money. They will do even crazier things to not lose it, right? And that's why approaching investing with a plan is the best way to go about it before you experience that emotion of investing, right? Because if you put $1,000 in a growth stock tomorrow and it goes down by 8% in the next month, you just lost $80. You're probably going to feel really bad about that. Now, a lot of people, right? Let's say you buy a stock here, right? It's been going up, it's been doing consistently very well, and then again, boom, it goes down, you just lost your $80. A lot of people are going to sell here, right? They're going to be like, okay, hey, it was doing well, now it's not doing well. In the last month, it didn't do as well. I'm going to sell, I'm going to just save what money I do have, right? When really all this is, oh, it had a big run up here, made a lot of money, did really well. Now it's taking a little down, and then it's going to continue to do this. It's going to do well over the long run, even if you have this little period of it going down. And that's why emotion is just the antithesis of investing, right? Those are contrary things. You either invest and you do it in a smart way, you do it rationally, or you go in with this emotional mindset. And if you do it with emotion, you're going to lose money, and you're just going to be a lot worse off in terms of how you feel about it, right? You're going to be anxious, you're going to be stressed. The much better way to do it is just invest for the long run, and then just don't check your accounts unless you really want to, right? Just invest in the S&P every week, or pick a few stocks or companies that you believe in, right? And just let that money run for the next 10, 20, 30 years. If you do it that way, you don't have to care about this. This doesn't matter, right? Because net, right, the overall return that you're making is this whole positive trend line over here. And long-term investing really does win. There's, right, in the United States, there is the S&P 500 index. That is this very popular index that's the top 500 stocks in the US economy. If you look at the S&P chart, there were some big bumps along the way, right? It looks more so like this than a straight line. But overall, over the last, say, 80, 100 years, it's done extraordinarily well. It's produced over a 10% return per year. However, and here's the interesting thing. If you took your money out of the market for just 2 or 3 of the highest performing years of the S&P, so this year right there, maybe let's say there was a bump there, right? And so on. You'd miss out on most of the returns, not some of the returns, most of the returns. And that means if you were constantly buying in and buying out of the market, or something like the S&P, which really just represents most stocks, like a general index, a general bucket of stocks, then you're going to do worse on average than someone who just bought and held. And that is the strange phenomenon of investing, right? Most people who constantly buy and sell, who are getting in there and they're selling there and they're buying again here, and they bought there and they really bought here, right, and so on. Those people usually, nearly always, do worse than someone who just bought right there and just held throughout this entire period. And they didn't have to think about their investment, right? They just check it every few years, because if you invest in the S&P, you're investing in the US economy. If you generally think the US economy is going to do well, then who cares how it does this year or next year, right? You just care how it does over 10, 20, 30 years. So again, this depends upon you, right? If you want to retire in 5 years, it may be a different story. You may want to take on less risk. But generally, investing for the long term and just holding, right, stocks and companies and mutual funds that you believe in, That is what's going to make you money versus getting in now, getting out next month, and so on. And that's why investing as well is so important, right? The reason this logic holds, right? The logic of buying and not selling for a long time is because you have less risk, right? You're going to make just as much money, but you're going to do it without losing as much money. Whereas a day trader may make the same amount of money or even less money than you by trading all the time versus you just buying and selling. But they have to put a lot of effort in. They take on more risk. It's generally worse off, right? The diversification is valuable for very similar reasons, right? And you hear this all the time. Just don't put all your eggs in one basket. That just works for the same reason that mutual funds and index funds work, and the same reason you should buy and hold over a long period of time. Is just you take on less risk if you spread out your assets and if you hold them throughout good times and bad times, right? So as opposed to investing in one stock and holding that stock for a year, right? You can invest in 100 stocks and hold them for 5 years. Diversifying, whether it's the type of industry you invest in, whether it's the country you invest in, whether it's the dividend and income stock versus a blue chip or a growth stock or a biotech or a startup, right? Diversifying across those different types of stocks will, on average, bring you closer to the overall trend line, right? And this is kind of the phenomenon of crowd psychology as well when it comes to guessing, right? With that story being, there's a certain number of jelly beans, right, in a jar. And let's say there are 600 jelly beans in this jar, right? If you ask one person how many jelly beans they think are in the jar, they may say 400. Someone else may say 2,000. Someone may say 50, right? These people are all very, very off, right? But if you ask enough people how many jelly beans are in this jar, what you see happen is that their guesses come together, and on average, they're much closer to being correct. And the same is happening here when you diversify. When you invest for long periods of time, your returns go from being 8% one year and negative 2% the next year and 3% this year to, okay, now I'm making 3, 4, 8, 12% a year, whatever that number is. And for that reason, just diversifying your investments within the stock market, in addition to as a whole, as in you don't want all your money in the stock market versus, say, real estate, debt, not debt, but debt instruments, right, like bonds and gold and crypto and so on. These are all different types of assets that you can hold your money so that on average you're going to make money versus experiencing the highs and then experiencing the lows as well. Now I want to make one quick note here that really it does impact some people more than others when they start investing, and that is just prices don't matter, right? Price is really irrelevant. And by that I mean, if you see a stock that costs $10,000 a share and a stock that costs $100 a share, right? The stock that costs $10,000 a share is not necessarily 10 times or 100 times more valuable than the stock worth $100 a share. What really matters in terms of size is market cap, right? Price can be set. Price is totally arbitrary, right? And the reason for that is because the number of shares can be set and then changed by companies, right? So if I have a stock that's at $10,000 now, and I have 1,000 shares of this $10,000 stock, well, I can arbitrarily, and companies do this all the time, and it's called splitting your stock. I can make this 10,000 shares, right? And then boom, the price goes from $10,000 a share to $1,000 a share. And then even I could go from 10,000 to 1 million shares because I want, say, my stock to look cheaper. And then, I guess this is off the screen here, but the amount of shares or the price per share is going to go to $10, right? And a company that has a $10,000 price per share, or their stock is priced at $10,000, and they have 1,000 shares out there, is exactly the same in terms of its value, its market cap, as a company with 1 million shares where the price per share is $10. So, and companies do this all the time. Again, in that psychology does matter in the stock market, but it shouldn't, right? And if companies feel that their share price is getting too high, they will purposely make it lower. And if a company can just choose one day to make their stock price lower, right, that really shouldn't impact how you invest. So prices don't matter. And what you do see now as well is fractional investing, where you can buy 1% of a stock, right? Like if you have, right now, if you open an account and you have $18 to invest, right, you can go buy $1,000 stock. It's just you're buying, say, 1.8% of that $1,000 stock. But you can't do that nowadays. You don't need $1,000 to go buy a share of the stock that is a whole numeral, like one share, 10 shares. You can buy your 0.018 shares. So price is completely irrelevant, and I really urge you, just because the stock is cheap or just because it's expensive does not mean with all other factors at a constant that you should or you should not buy it. That just should not weigh in your investment decision. Now I want to go over 2 final suggestions here when it comes to how you should trade. These are somewhat related, and the first one is going to be trade what you know, and the second one is understand the economy, right? Trade what you know and understand the economy. And over the past few hours, I've spoken a lot about the context for a stock, right? Things like the industry it's in means that it's probably going to behave in a certain way, and the size of the company means it's going to behave in a certain way generally, not always, but most of the time. The driving factor for a lot of companies, right, and not just your cyclical stocks, but nearly all stocks, is the macroeconomic situation, or the economy of the country, the economy of the world, and so on. And you saw this during COVID, right? During COVID, the whole world, right? I'm going to very badly draw a world here. The whole world had a macroeconomic problem, as in shipping was down. There was, everyone's not buying things. They're inside, and so because of that, stock markets, if this is just a generalized index of the stock market, basically did this, and they recovered for the most part, but there was this big spike here, or this big decline. And if you just look at the balance sheet of a company, right, or you think it's undervalued and you buy it, right, you're not accounting for big declines like this that don't happen because of the company. They happen because of the world or the country. They happen because of the economy. Right, so in that way, understanding the economy of the country you're investing in and keeping up to date with the world economy as well is really important when it comes to investing in stocks, right? So if you live in India or Cambodia, right, you really need to know what's going on and what the government is doing, what the biggest companies in those countries are doing, because those are going to impact the stocks and the companies you invest in, right? That's one side of it, right? That's understanding the context or the situation that the companies that you're investing in are operating in. The flip side of that, and I think this is just as valuable, is to trade what you know. In that, generally, right, there's a lot of very smart people out there who are investing. There's a lot of analysts who do this professionally. More so than that, there are computers, right, that have algorithms that just do most of the trading nowadays, right? Like literally over 50% of trades that are done in the stock market today are done by a computer, which means how are you going to beat the market, right? How are you not going to lose money? How are you going to make more money? How are you going to beat the market on average? The way to do that is not by being smarter, right? It's not by having a better algorithm for the vast majority of people if you're not a $1 billion hedge fund. The way to do it is trading what you know. It's investing in products and services that you believe are going to win because you have unique experience with them, right? So for a lot of people, that's investing in the industry that they work in. So say you work as a secretary, right, in a private equity firm, and your private equity firm buys a juice company that uses a new fruit or a new vegetable in their beverages, right, in their juices, and you're like, hey, this is the next big thing, this is going to do really well. Well, hey, just buy the stock of that company when it goes public in 6 months, or buy a similar company, because you know this, you have experience with this, when nearly everyone hasn't heard of this, when most analysts have never heard of this company, most people generally, right? So in this way, you can beat the market by just investing in the things you have experience in. And it's the same if you go to your grocery store and you try a new product. If you go and buy shoes and you say, hey, these were really great shoes, or you go to a new doctor, a new type of doctor's office, say like one of the new virtual ones. If you have really good experiences with those products and services, hey, maybe just do some research on those specific stocks, because in that way, you are now betting on something on your experience of, hey, I as a customer had a great either I really enjoyed this product or service, it was better than competitors, whatever the experience was, you experienced that uniquely, and not because of public information, not because of something you can Google or because of a pattern in a chart, but rather because of the experiences that you have had as an individual. So in that way, by trading what you know, you can do really well, especially over the long run, right? And that doesn't mean if you buy a Tesla and you think Tesla, the cars are great, so you buy some Tesla stock, that it's going to do well over the next year. But that means if you believe in electric vehicles and you understand electric vehicles and you think the market is going to do well over the next 20 years, right, then maybe that is an investment that is going to do well. And that's what you have seen from Tesla, from Rivian initially, from a lot of these electric vehicle makers. And as one more just final note here, there's a rule that Jim Cramer, who is a very popular investor in some circles at least, or a spokesperson on the subject, that's no woulda, no shoulda, no coulda. And what that refers to is the emotional impact of investing, where this is a game of money. You're going to make money on some days, you're going to lose money on some days. And over time, you're going to make money. But it's not going to feel good in this period, right, where you're not making as much money. It's not going to feel good in this period when you're losing money. So what he says is, there's no I would have done this, there's no I should have done this, and there's no I could have done this in terms of how you should react when you lose money. And this just means if you make an investment that doesn't go well and you lose half of your money and you decide, hey, this is just going to get worse, so I have to sell, not because of the emotion, but because of the rational your analysis of the situation, where you say, hey, okay, something fundamentally changed in the company, so now I should sell even though I lost money. What you shouldn't do in those situations is, oh, I should have done this the next day, and oh, if I could do it over again, I would have done it this way. The way to deal with those is just, okay, hey, here's the lesson I took away. Here's how I'm going to change my investing behavior because of that lesson, right? And then let me go and put that into action. You are going to be much better off that way than the perspective of, oh my God, this is the end of the world, and I really messed up, and I'm just trying to daydreaming about how you can fix that or how you would have done it differently. You will have those moments, but if you just, again, invest over the long run, then those individual losses don't matter as much. It's really just over the next 10 years, am I going to make money, and not, hey, I lost $100, I lost $1,000 this week. So those largely cover my perspective on your tips and rules and habits and strategies when it comes to investing. Again, generally it's just about who you are, what you want out of investing, and then just investing over the long run in companies that you believe in. That generally will get you most of the way there. What I want to briefly touch on now, as I've been alluding to throughout the entirety of this video, is actually making your first investment. What I want to stress is that, as I've been saying, you want to invest, over the long run. You want to invest consistently, and any amount of money you can invest will leave you far better off, right? And this somewhat varies, and there are exceptions to this, and I went over this in another video, and that's my bad financial advice video. Whereas I don't think you should always, if you don't make much money, invest without at least considering how to make more money. But if you invest, especially when you're young, especially if you have a solid income, the sooner you can do it and the more you can do, the better. What that means is investing $100 a month may not sound like a lot, right? But that really will add up. That's great, right? If you can invest $100, great. If it's $1,000 a month that you can invest, fantastic. If it's $10 a month, right? Maybe that $10 won't change your life, but you can get experience from that investing. You can learn what makes companies do well and what makes them do worse. That $10 isn't going to make you rich at all, but if you focus on making more money, right, on getting to the point where you can invest $1,000 a month while you get the experience of investing with $10 a month, then that's a win in my book. So then when it comes to actually making those investments, right, I've used the word brokerages a few times throughout this video. Brokerages are companies that let you invest in stocks and other assets, right? So what you want to do is create a brokerage account. A brokerage account is just an account that lets you buy stocks, buy mutual funds, index funds, and so on. And you can think of this as a bank account, right? You have a bank account, probably a checking account or a saving account right now that lets you just hold money and say have a debit or a credit card. This is exactly the same. It's just a bank account for stocks. And for many of these, right, you can use those accounts as a checking or as a savings account. And also for a lot of 401ks and Roth IRAs and so on, you can invest in assets and stocks and into the stock market directly from those accounts. So hopefully you have experience in those ways. But if you don't, you can just go to any big brokerage provider and you can invest in those assets, right? There's Fidelity, Vanguard, E-Trade, Charles Schwab, etc. There's a lot of big, great options out there. And you can either Google just best brokerage accounts to open. I'm going to put a few up on the screen right now. The ones I personally use are E-Trade, Fidelity, and primarily Charles Schwab. So Fidelity I used to use for options and some trading of that sort, which again I don't recommend initially. Charles Schwab is a great all-around option. And then E-Trade, which got purchased by Morgan Stanley, which is another brokerage bank and firm as well, is similar to those other tools and to Charles Schwab. So largely, they're all the same. Like Fidelity isn't that different from E-Trade, which isn't that different from Charles Schwab. What you just want to do is go create an account there, and then you can start investing directly from those by just hooking up a bank account. I really do hope you start investing because of this video. If you haven't, or at least you've learned more about investing in the stock market, because again, in terms of wealth generation over the past century, there's been real estate and there's been the stock market, and that's largely been it. And in terms of real estate, right? People make money. Millionaires are created in real estate. Like you'll see the popular stats out there, because the value of their home goes up. But that is a very passive form of investing. That's just, I want to buy a house for the house, right? So I can live somewhere, and then you make money in that way. The stock market can still be passive. You don't have to day trade. You can just say buy the Dow Jones index, right, or the QQQ index, say once a week or once a month. But it is you choosing to invest your money. And the amount of people that have made an incredible amount of money that way and who have really gotten to that point of financial freedom, or at least accelerated their journey to financial freedom through investing in stocks, is just enormous over the past, century, and really as long as these markets have been around. So if you haven't invested, hopefully this is your sign to do so. With that said, I'm going to put resources up on the screen right now. So these are some stock books that you can read. Here are some stock podcasts, some websites, and then some YouTube channels. With that said, again, thank you for watching. Let me know what you want to see in future videos in the comments, and I will see you in the next one. So if you've been around this channel for a while, you know that I really like investing and that it has mattered to me and been important to my financial development for a long time. I started picking out my own stocks to buy very young. I was writing books on the stock market in middle school, and you may have seen videos on the channel like these. So what I want to do in this video is cover some basic investing mistakes. And I want to answer the question, as I'll touch on in a second, of how should you invest? Not through that lens, but through the inverse lens of how should you not invest. And I think some of the lessons there are even more valuable by far than those questions of how should you invest, because they help you limit your downside to not just lose all your money and have to restart or quit on that journey or those stages of investing for the first time. So I'll keep it quick. This whole video will be straight to the point. That said, let's get into number one. So we're obviously talking a lot about investing in this video, and the requisite step to investing is having some money to invest. And that brings me to the sponsor of today's video, Free Cash. Free Cash is an online platform where users from all over the world like you can sign up for free and earn money by playing all kinds of mobile games. You receive offers from games in the app and then complete those offers, and then you can withdraw the cash to PayPal through gift cards and through various other methods. Here's an offer for Rise of Kingdoms, which has over 100 million downloads that I claimed because I like strategy and strategy games. And to earn this money, I downloaded the app and started playing it like so. And it is important to enable in-game tracking so that Free Cash can reward you for your in-game progress. And these guys have over 4.5 stars on Trustpilot from over 160,000 reviews, so they are legit. And they make it easy to make some money doing what you probably already do otherwise, just play games in your spare time, like waiting for the stock market to open or sitting through those boring parts of an earnings call. Here's me with Rise of Kingdoms, and I did make a few in-app purchases that I got cash back for with the bonus rewards. And here is the cash out section where the funds you earn can be withdrawn to PayPal. And here's the last real cash out that I received in my PayPal account. So if you would like some extra money to invest, then by clicking the link in the description or this QR code, you can get a $5 bonus on the first offer you start in Free Cash. And note that the interface may look slightly different depending on the country you're in, but the functionality will remain the same. So again, that is a $5 bonus on your first offer, and just click that link in the description to get started. And that said, let's head back into a deep dive on navigating the minefield that is investing. Okay, now I want to start off this look at investing mistakes, not through the lens of how should you invest, but rather how should you not invest. This is a book called How to Stay in Love by a man named James Sexton. He is a famous divorce lawyer. And his lens on, well, how should you stay in love? How should you have a healthy, stable relationship and marriage isn't through the lens of what works, and rather, well, what doesn't work. And let's just avoid the things where it's really easy to go wrong. And if you do that, then maybe you arrive at this answer of, well, how do you have that positive thing? And so in this case, we're going to try and answer that question of how should you invest through the lens of how should you not invest. So that starts off with this idea, which is that everyone messes up, especially trading and investing professionals. And there is this illusion, maybe it's, big words or a lot of acronyms, maybe it's people in suits that cover up the difficulty of investing better than the quote unquote market. And a lot of the people who are professional investors, in fact, nearly all of them, are not actually as good, likely, as you think. And what that means is there is more to lose than there is to gain. I'll say that again. There is more to lose by investing wrong than there is to gain by learning about investing, by trading, technical analysis versus fundamental, by being more like the professionals, right? This image right here is a percentage of managed funds. So these are professional stock traders who manage these funds that people invest in for large companies who underperform the benchmark being the S&P 500. And the S&P 500, the Standard & Poor's, is basically the market measuring stick. And it's just a lot of big companies, the top 500 companies in the entire stock market. And if you beat the market, well, when you say you beat the market, you're talking about I beat the S&P. So if the S&P went up 10% and I made 12%, I beat the market. Well, just look at this right here, right? Over a 20-year period, 93% of professional traders actually do worse than the S&P 500, than just the market. Now, this is going to be slightly different depending on all, large cap funds, small cap, international, domestic, but these results generally hold. Whereas nearly everyone, nearly all professionals don't actually beat the market. And so what that means is, I just said this, but I'll just say it again to nail in the point. Even if you put in years of school and you're a professional and you research all your investments and make complex decisions, you're probably not going to do that much better than the market. But it is relatively easy to lose a lot of money. And so that's what we're avoiding through also how not to invest instead of, well, how do you invest? So everyone's going to make mistakes. Let's just try and limit the downside for you before or as they happen to you if you don't have a lengthy background in investing and some of the kind of calluses that come as a result of that. The next point I want to make, and this doesn't sound that important if you haven't been through it or you haven't invested, and then it starts to become a lot more important and you realize why it's so important as you or if you start consistently doing that. And what this comes down to is the fact that money is a supremely emotional thing. It's a liquid, a metric form of value in a sense, and we all care about money. We put a lot of effort into money. We don't want to lose money. And this is this is a proven psychological phenomenon that happens, whereas people really, really don't want to lose money. And so I'm not on a high horse here. I've been through this more times than I care to admit. But it doesn't feel good to lose money. And when you do lose money, you want to not lose more money. You want to make that back. And so what you get is this kind of optimism curve generally, and that applies to money as well. Whereas if you start something like investing, right, you have this uninformed optimism. You think, I can research all these stocks. I'll do more research than everyone else. I'll use AI. I'll do X, Y, and Z. It, changes by the week, and I'll get an edge, and I'm going to beat the market and get so much money. And then some time goes on. Maybe it works for a little bit, and then boom, something goes wrong. You lose all your money. You make a bad trade, and now you're down here in informed pessimism, right? You have that disappointment after those first losses. Well, if you keep learning, if you keep sticking with it, you do it for long enough and your strategy is actually solid, or you change it so it becomes solid, then you get up to this informed optimism stage where you're making as much money as the market, you're beating the market slightly, and there are great people that beat the market year over year for decades on end. That's possible. But those people went through this, right? Uninformed optimism, informed pessimism, then up to informed optimism. Probably less optimism than previously, but some measure of optimism. So because money is so emotional, this just applies on steroids, and you will likely go through that phase of uninformed optimism. Oh my God, I can make so much money. I had a great trade. And then you're going to lose all of it. Something goes south. Oh, I'm so sad. A lot of people quit investing at that point. Some others don't. And then maybe long term it works out and you settle on something stable. I'll give you a very material example to wrap this up. When I was in middle school, I started to learn about options. Options are like they're a derivative kind of bet you can make on stocks, where you're trading contracts, where the underlying asset is the stock. You can watch a video if you want to learn about them. Maybe you already do, but they're essentially just a riskier version of stocks, where you can win more money, but also you can lose more money. And I started placing big bets. Like I only had $1,000 or a few $1,000s in my account at the time, or what I earned to put into investments. But I started making 30% here or 100% there. I quadrupled that money in maybe a month or two. let's say a month. I don't remember the exact volume of time. That was this uninformed optimism period where, frankly, I got lucky. The market was going up. I did, in fact, make some good bets, and I quadrupled my money. Great. Well, then I was so uninformed, I was so optimistic that I took all that money and I put it into Tesla stock before earnings, and I was betting on news. I was betting on earnings, and I was betting on news that was coming out. So that's basically the dumbest, the riskiest. I won't say dumbest. In some situations, it works out. It's incredibly risky, though. And so I'd taken literally my whole portfolio. I stuck it in this trade. It didn't work out in my direction, and I lost the entire portfolio. Went to zero. So then I got this informed pessimism, and I quit options, and I didn't start trading them for another 4 years. And then when I did get back into it, I started looking at covered bets, covered calls, covered puts, much kind of safer bets I can make to just kind of slightly accelerate returns over time. And that is kind of this informed optimism. That's just one case, but that applies to general trading as well. So just keep this in mind as you're going through those highs and lows and experiencing that intrinsic emotion of money. That said, probably the most common way not to invest is to not trade on news. This happens a lot, whether you hear it from friends, whether you hear it from associates, whether you hear it on social media, politicians, right, whoever it may be. The problem with this is that markets nearly always price in news. There's this notion in economics of the efficient market. There's the efficient market hypothesis, the EMH. And that's the idea that markets price everything in. That may not be exactly true, but it is true that they are pretty efficient. And by the time you hear about a rumor or news, it's probably being priced in. Even if you invest because of something happening 2 years in the future, right? Like Wynn Resorts right now, it's 2025. They're opening a location in Dubai in 2027. They're building this big property. That's going to make them a lot of money. And so maybe you think, well, no one's trading on it now, right? Well, the market probably has priced that in because they price everything in. That's like the theory of the market. And there's this whole slogan that's buy the rumor, and then when the news comes out, sell it. Generally, it doesn't work. Like if you try and do this more times than not, you will lose money, and it'll feel great on the times that you win because you beat the market, right? You made some money. But other than that, just if you avoid trading news, going back to there's more to lose than there is to gain, you're going to be better off. So there we go. That is that first investing mistake to avoid. Next are to overemphasize market crashes. And I think this is a really important chart. This is US stock market returns for that S&P index that I talked about previously over a period of roughly 150 years. And this is real returns, so adjusted for inflation and reinvested dividends, so like cash payments that are put back into stocks that you get from owning those stocks as well. And a lot of these, or at least what stands out to me looking at this, a lot of these years are red, and a lot of them are pretty big red. We have lots of 10%, some 20, some even 30% negative years. And I say this right here, 10% plus drops in the market happen pretty regularly. 20% plus drops also occur, 3 times a decade, 2 times a decade, relatively often. And so what that means is it should not feel like the end of the world, going back to the emotion of money and investing as well, if these things go down. Because that's the whole market going down 10, 20, 30% plus. Imagine individual stocks. Some stocks, recession proofers like J&J, may go up in those periods. Other stocks may go down 60%. And that could happen 1, 2, 3, 4 times per decade. And so historically, I won't say what you will about the future, but recovery historically has always followed these crashes. And that's why whether it's a big up year, whether it's a big down year, that should not feel like the end of the world in either direction. And that state is not likely to continue. If you had a big up year, it's not likely to be a big up year every year. If there's a big down year, it's not likely to be a big down year every year. And it does feel like that in the moment. It really, really does when the stock market crashes or when it has this best day and everyone's euphoric and you're making so much money. Those things are so, you know, it's a numeric, it's a financial game, but they're also so emotional, and so much of it is about psychology in terms of how people, how consumers, even professional investors invest. They say time in the market wins out, so just stay in the market, stay stable, get to that point of informed relative optimism, and you'll be fine. Next, friends and family. This ties into trading on news. The big do not here is just do your own research, DYOR. It also ties back to what I said with, well, most professional investors don't actually beat the market, which basically means what they spend their whole life doing, they're not actually that good at, quote unquote. I'm not saying that about specific people. I'm just saying that about many hedge fund, many equity fund owners do not beat the market, and that's literally their whole job, to beat the market and to get stable returns. And those are professionals. So what about your friends? What about your parents? If you're talking about insider information, that's a whole different thing. That's illegal. I won't comment on what you should do if you get some inside information. But as far as people giving you advice about other companies, maybe they know what they're talking about, but chances are they don't. And no matter whether they do or they don't, just do your own research. Don't just accept what you're told and just go based off that. Do your own research, and that again limits the downside, even if you potentially could have had a winning bet by just accepting that person at face value. In a lot of cases, the bet that you don't do the research on, that's the one that goes down 60%. You get trapped in this cycle of, I don't want to sell, to materialize losses, and it gets worse and it gets worse, and you lose all your money. So don't be this guy. Don't be the trust me bro source type of investor. So next is selling too early. This is a big thing where, let's say there's a great company. Let's say you invested in Amazon in 2006, and it goes up 20% over a period of 2 months. And you're like, hey, I made my 20%. 20% is great. And then you sell. Well, did you just sell? Let's say in 2006, you viewed Amazon as a fantastic company, well-run, great CEO, wide open market. Despite all of those fundamentals, you sold just because 20% is a big number. That happens a lot. Again, you don't want to lose. You want to materialize the just on-paper gains that you made. What I urge you to do as far as the mistake goes is consider the fundamentals. If the fundamentals back the decision to sell, then sell. But do not sell too early just because the gain is big, if that makes sense. You need to contextualize that gain in the context of the company. And so if you have confidence in the company long run, if you think the valuation, given the growth, like let's say the forward earnings multiples, right, forward PEs, just whatever metrics you go off of, if that's all solid, don't sell, even if you're up big. Just hold. It's a good company. Like, why would you sell? Maybe sell some of it to recoup what you put in, but don't just sell your whole position. That's this point. And the next one is, well, selling too late. You kind of have a similar problem with selling too late, but it works in the opposite direction. This right here, CGEI, is a company I invested in. And I made some money initially. Like, I was investing back down here. I tripled my money, and this is great. You know, I'm up a few grand, however much it is. And then, I make a lot of money. I'm up like 400, 500%, and then it starts going down. And now I'm only up 150%. I'm only up 100%. I'm up 75%. And at every point as it's going down, I could have sold, but in my mind I was like, but I used to be up 150%. I can't sell now. It's going to go back up to 150%, even, and this is the critical part, as the fundamentals deteriorated, right? So same thing here. You sell too early while ignoring fundamentals. This is the opposite problem. You're still ignoring fundamentals, but it's not working out for you because you weren't selling, because you own a position where the fundamentals are really, really bad instead of selling out of a position where the fundamentals are really, really good. And so what ultimately happened is I came back down here and then zero. And then the investment quite literally went to zero. I could have sold at any point along here for a big profit as over a period of years, the fundamentals got worse, but I didn't. And this is really the sunk cost fallacy in action, where you hope that it's the best way to describe it. Losing positions are going to come back to their former glory without the fundamentals indicating that as well. Even worse than this in how not to invest is doubling down. And that's that poker logic or the blackjack logic of eventually I'm going to win, or eventually this is going to go back up. So if I just double my bet every so often, I'm always going to break even. I'm always going to make money. The silver lining that I mentioned here is just if you lose money on taxes, then that is deductible and you save a little bit of money on taxes. That is not a reason, absolutely, to lose money. So don't double down. Do not sell too late. Go off the fundamentals first and make decisions either to keep holding or to sell based on those things. Okay, next up is IPO traps. And this was a big one, like 2020 to 2023, I think, less so in the last year or two, just because there have been actually very few IPOs. But there's this notion that you're getting in early for an IPO, and that like you're special if you can get in early on an IPO, kind of in the way we described previously for rumors and trading on news. The raw numbers tell us that most IPOs underperform the market in their first few years. And what that means is if you trade just 10 IPOs in a row, you're going to lose money if you invest early or in the actual IPO of those 10 companies net. But then there's still this romantic notion that people cling to of, well, this company there's so much hype around it, it's gonna blow up. And so you have a lot of people investing in IPOs. So if you're new to investing, don't invest like this. The investing mistake is just period to invest in IPOs. Just don't for your first year or two. Maybe put a little money in after they come out, after they have a few quarters of performance, and feel those things out. And then if you'd like to start investing really early. And I say this distinction here as well, right? Most of the IPOs you hear about are going to beat the market, but you don't ever hear about all the ones that don't. Rivian is a very good example. A friend of mine actually invested in this and actually made some really good money. The stock popped on like the first few days. They sold at a 60% profit in 2 days or something like that. And good, they got out. They got really, really lucky, because then look what just happened to the stock over a period of 4 years. And that is just what happens like more often than you'd think. So I'm going to wrap this up with Wall Street Bets. Now, I love Wall Street Bets. It's a community of like degenerate traders that get really, really rich, and more often than not get really, really poor as well. And I urge you to spend some time just scrolling through Wall Street Bets, and it's people putting incredible amounts of money on the line, often with risky, option strategies and whatnot. Again, the culture, I love it so much. It's really fun, and you can learn some things as well. You can, especially in some advanced options strategies. Again, which I do not recommend, speaking from experience. And I think that the real lesson here is that this Wall Street Bets is a masterclass in how not to invest. And going back all the way through this presentation, Wall Street Bets is a masterclass in you have a lot more to lose than you have to gain by investing wrong. And it's full of people who invested wrong and who lose all their money, all their savings, their parents' life savings, etc., because of investing wrong. And yes, you can win big. But for nearly everyone who is successful long run, they make it to this informed optimism stage, and then they just accept that over the long run, you're going to make money. So, go look through Wall Street Bets, have some fun. And I hope that this has been helpful in how not to invest. I'm not telling you how to invest. I'm just saying don't do all the things that we just talked about. And then you can see a video that I'll put on the screen right here, which is a full debrief on the actual stock market and investing. You merge those two things, you will be pretty good to go. So now that you have learned about all these different traps to avoid while investing in the stock market, that gives you all the more reason to start investing and set yourself up for long-term financial success. That also gives you all the more reason to head to that link in the description or this QR code to claim that $5 bonus on your first offer with free cash. And again, the central message of this video is just start investing and avoid these things. And if you avoid the things we've talked about, I'm very confident you'll make it, you'll be fine. Worst case, you perform like the market does. Best case, you beat the market if you don't do these things. That's my hope for you. Leave any comments in the description, and we are looking to hit 1 million subscribers this year, so I hope you join the community. And that said, I'll see you in the next one. Cheers. Hello, so I am graduating this year with an undergraduate with a bachelor's degree in economics, and I'm starting a master's of science in quantitative economics next year. So I have been through the ringer at this point with economics courses, and I have finished up those first degree requirements. And I really like economics, right? I really like economics. I started writing books about finance and the stock market when I was in middle school. And then this channel, if you go to videos a year ago up through today, I've made a lot of videos like these about economics, finance, game theory, just the whole 9 yards there. But I don't think I knew how much I liked it until I started getting really deep into it. And if I had seen a video like the one I want to make today when I was a freshman or when I was considering what kind of subject to study, I think it really would have helped me. So I'm making this video for two groups of people. First, if you are a prospective student or you're thinking about studying economics, then you'll learn a lot about the degree, what it's like, what's good, what's bad, and a lot about economics itself in this video. So that's one group. And then for the second group, if you're watching this and you're just interested in economics and you want to learn about kind of what constitutes quote unquote economics and how it's actually taught, and then also just a lot about economics itself and every kind of facet of it that builds into this whole domain and this field, then this video is also for you. So there are 4 big parts to any education in economics. There is microeconomics, which focuses on individual consumers and firms and how they act, what they do. And then there is macroeconomics, which focuses on whole countries, nation states, markets. And then there is econometrics, which is much more of an applied form of economics where we use data to just answer questions, answer economic questions about the world. And then finally, there's what in the college system you'd think of as electives, and really that's just any number of kind of subfields that people go really deep into, right? Like there's sports economics, there's economics of information, there's game theory, there's political economy, there's this whole breadth of subjects where you take micro, macro, and your econometrics tool sets, and then you apply those to very specific fields. You can also kind of consider behavioral economics its own thing, and game theory is somewhat distinct as well. But those subjects are still considered kind of more niche or take a backseat to just that main educational curve that people go through of your micro, macro, and your stat and your econometrics. So I'm going to first start with microeconomics and just break that down as a whole, then get into macro, then econometrics, and then into all these various electives that I took and also just really enjoy, right? Things like game theory, economics of information, political economy, public finance, and the like. Now in this video, we're talking about economics and money, and many people are looking for ways to grow professionally and create additional income streams without sacrificing their time and freedom. So I want to share an opportunity with you to learn valuable skills and generate an income from anywhere in the world on your own schedule. So meet Prop 365. Prop 365 lets you trade financial markets using company demo accounts as opposed to your own personal funds. Unlike regular retail traders who trade with their own money, prop traders work for a firm that provides them with demo accounts in exchange for a share of the profits. And in that way, you can potentially earn from the markets without having to risk your own capital. All trading is done on simulated or demo accounts, but payouts are real and you keep up to 80% of the profits you generate. And you can trade across crypto, commodities, stocks, and Forex with account sizes ranging from $5,000 up to $100,000. This is a great way to learn new skills, develop professionally, and create an additional income source while maintaining control over your time. So to get started, just register on Prop 365, then purchase a challenge using the 30% discount code in the description, and that makes it only $39 to get started. So then once you pass a challenge, you unlock access to a funded simulated account and qualify for those real payouts. And your challenge fee is refunded after that first withdrawal. And Prop 365 recently added a new simplified challenge called Two-Step Max that's designed to be simplified and accessible for beginners. These guys are ranked number 2 among all prop firms on TradeLocker as of March. And so one last time, if you're looking to take that next step toward financial growth and develop new professional skills and create an additional income stream, then Prop 365 is a great place to start. Use that exclusive 30% promo code in the description below and start your journey today. Again, there are 0 capital requirements, fully funded accounts, and an 80% profit split. That said, let's get back to economics. Okay, so I'm going to dive into the first layer of economics as we just touched on, which is the duality of microeconomics and macroeconomics, and I'm going to do so through the lens of the classes. And you start off typically with 2 layers of micro and macro courses. So typically at most universities and whatnot, that's microeconomics 101, macroeconomics 102, and then macro 201, macro 202. So in the next few minutes, I'm going to walk through not necessarily what I find most interesting or what's most applicable, but basically a little introduction to everything that you're going to learn about should you pursue economics. And also if you don't want to study it, if you just want to learn here, this is basically a touch point on everything that you can go deeper into. So it's not going to be super academic, super mathematical, focused. We're just going to touch on kind of all the core parts of micro and macro. And that starts with microeconomics. And microeconomics is much more focused on the consumer and on the individual kind of behaviors of consumers and of firms. And so the first kind of theory there is consumer theory, and that deals with consumers, so people just like you and me, and how do we act? How do we act? Why do we act? How we act, and how can we predict our behavior? And generally, utility maximization and consumer choice is how we view consumer theory. So we view it through the lens of consumers have choices. They can buy a certain good, they have a certain amount of money, and then they want to maximize their utility or their satisfaction. And in economics, what we call utility is kind of this arbitrary kind of catch-all term for value, right? In that it's hard to categorize or it's hard to generalize the notion of how much things matter to us. Like if you had to say, bananas matter to you on an arbitrary scale of 2. They're worth 2 of this, this unit to you. And then I asked, well, how many units is a good friendship worth? And how many units is a computer worth, right? It's kind of hard in practice to say the banana's worth 2, the friendship's worth 156, and so on. But in theory, this is all utility, right? All these goods, right? So the computer, the friendship, the banana give us different value, different amounts of value, and we're going to spend and allocate our time and our money in different ways to get those things. And so what we call like value, so to speak, in economics is just utility. And so in the general consumer theory, you have limited resources, right? You have a limited amount of time, you have a limited amount of money, and so you're gonna try to get the most value out of your day, out of your money, and we call that utility. So you're trying to maximize utility given the choices you have, and then give it the limited resources or the budget constraint that you have. And so something you'll hear a lot is the notion of margin, or like at the margin, and then marginal revenue, marginal cost, and in this case, marginal utility. And what all that means, and all it means if you hear the word marginal, is just one more, like at the edge. So if you've already spent $100 and you got 8 units of utility, like it's worth 8 to you, and whatever that means, then the marginal utility is the utility you get from consuming the 101st unit. And that matters in a lot of ways. It matters in firm theory and choice that we'll look at, and also consumer theory. And rational consumers, and we're not all perfectly rational humans, in terms of how we allocate goods, but generally what we do is we allocate spending so that if we spent $1 more on any number of things, we would get the same amount of value for it. Because if that doesn't hold, if we could get more value at the margin by putting money in one place for another time and another, then that's where our money would go. And so rationally, to hit this kind of equilibrium, and an equilibrium is kind of like this stable state where no one wants to do anything differently, then, well, we're going to get the same value from spending our money in a lot of different places. And you can expand dollar to time and so on. So this is just a little equation here. It just says the marginal utility of X divided by the price of good X equals the marginal utility of Y over the price of Y. So that says for any two goods, X and Y, that we can generalize that to any goods, which is just what we said here, the marginal utility divided by the price, which is equivalent to the marginal utility per dollar, is equivalent across the board. And then you can see that the income and the substitution effect are two big things that you're going to see a lot. And what they just reflect is how the amount that you consume changes and why it changes. So if you make more money and now you buy more of one good versus another, then that was the income effect. Your income changed, you make more money, now you buy more, let's say, steak versus your kind of mac and cheese that you make at home and throw in the microwave. And then the substitution effect is the same kind of logic there, but it relates to the price of a certain good. So it says that, well, and we'll talk about kind of difference curves and all that in a minute, but it just says if the price of a comparable good changes, then, well, how are we going to allocate our spend now? So let's say if apples get more expensive, well, are we going to buy more oranges, or are we going to buy more bananas? So that is a little intro to consumer theory. Next, I want to talk about budget constraints and difference curves. You'll hear a lot about this in every economics course you take, and just in kind of every application in the real world of economics as well. And the budget constraint is just what I said here, where as consumers, we have limited resources. We don't have infinite money. We definitely don't have infinite time. And so what we call that limited kind of amount of resources is the budget constraint. So if you walk into a store, let's say a supermarket, and we're considering that supermarket to be the market, right? And you have 20 bucks in your wallet that you're willing to spend, and you want to get a snack. Like, let's say you walked in, you want some sugar, you want a drink, you want a snack. Well, the $20 is your budget constraint, and you're trying to maximize utility in this market, or basically you want to get the most enjoyment from the snacks, the candy, the drinks that you buy. And the budget constraint is going to be equivalent to the different allocations that you can make, how you can spend the price of a good X times the quantity plus the price of good Y times the quantity. And then that's going to be just the same for every good. So if your income, like let's say in that example, $20, right, is your budget constraint, then $20 has to equal the price of, let's say you can only choose between Coca-Cola and a Hershey's chocolate bar. And the price of Coca-Cola is $2, and the price of the Hershey's bar is $3. Well, your $20 has to equal some amount of Hershey's, which is just $3 times the amount that you consume, and then plus $2 for the Coca-Cola, plus the amount of Coca-Cola units that you buy. And then that translates into the idea of indifference curves. And indifference curves just say that I get the same amount of value at every point along this curve. So if I buy, let's say, 2 units of Coca-Cola and 1 unit of a Hershey's bar versus, let's say, 2 units of a Hershey's bar and 1 unit of Coca-Cola, I would be just as happy. I would be indifferent to those two what are called bundles of goods, or those two allocations. So you can see this right here, right? Like, let's say in this case you have a curved curve, like an indifference curve right here. At any point along this line, and this is actually a little bit different. This is in production possibilities frontier. But let's just think about this as a indifference curve for a second. We can say at any point along this line, we get the same amount of enjoyment from those two goods. So let's say at this point right here where my mouse is, maybe that's, let's say, 7 units of good 2 and 4 units of good 1. And if we go up along here, maybe that's 2 units of good 2 and 9 units of good 1. And what we're saying here is that at any point along this curve, so at those 2 points I just mentioned, we would get the same amount of value there. And then this relates to, again, what I said here, which is like you want to maximize utility. We can find the optimal consumption, or optimally how you can actually get the most value from the different goods you can buy, by then looking at things like derivatives and the tangential points and so on. And what we can do is compare the indifference curve and the budget constraint, and the point at which the budget constraint hits the highest or the most valuable indifference curve, since indifference curves have fixed utility. So at the highest amount of fixed utility that hits the budget line, well, that's where we want to optimally consume. Okay, so next up are demand curves and elasticity. You'll see a lot about demand curves as well. That's in every course you'll ever take. Demand curves just look at the quantity that is demanded, given typically how you'll see it orchestrated is the quantity on the x-axis and the price on the y-axis. And so typically these are downward sloping. All that means is as the quantity demanded increases, then the price is going to fall because more people are going to produce that. And for individual demand, like you could have market demanded as well, but for individual demand, it's just going to be the quantity desired at each price level. So let's say if the price is $3, we're going to want 2 units, and if the price is $4, maybe we only want 1 unit. And then we can take that from consumer theory into a more generalized, like micro or macro view, where we just sum all of the individual demands. And then elasticity is something important here. And elasticity, kind of the concept of it, is just how responsive people are to a change in price, in terms of consumer theory. And the example I would give there is, if you make, let's say, $200,000 a year, and you buy, let's say, $10,000 of luxury handbags per year. Well, let's say your income goes from $200,000 to $50,000. Like you lose your job, you become unemployed, and now you only make money from dividends in your stocks. Well, you're not going to buy those luxury handbags anymore. And so what that means is you have a very elastic response to the fact that your income changed when we think about this good of luxury handbags. But let's say you drive to the gym and back, and you're going to do that whether you make $200,000 a year or $50,000 a year. Because it's your health that really matters to you. Well, if the price of gas goes from $3 to $4 per gallon, or let's say, I don't know, up to $8, you're still going to drive to and from the gym because your health really matters to you. And in that sense, you have a very inelastic response to changes in price there. And we can think about elasticities of demand, of supply, I'd say for now, focus on that core concept of elasticity. So next, that was consumer theory. Now consumers consume goods, they buy things, producers produce goods. And so that's kind of the flip side of microeconomics and of macro economics. And there's a few just core parts here that I want to cover. The first is a production function. And a production function, and there's lots of them, but I'll just cover 2 here. Basically just describe the things that go into making stuff, right? So like the quantity that is produced, the quantity that is demanded is going to be some function of inputs to production. And typically the ones you'll see are labor, so denoted here as L,
capital, which is always denoted as K, and then the A here is technology. So all this Q equals F of L comma K means is that the quantity that is produced is going to be some function of the labor and the capital that goes into it. So maybe some machines and then paying some people to work on those machines to produce whatever good that we're producing. And then you're going to see two extremely common production functions. The one they typically introduce to you first is Cobb-Douglas, and then you'll also run into the CES as well. So the Cobb-Douglas right here just says that the quantity produced is some function of technology, capital, and labor, and then this alpha and beta, these exponents here, speak to basically elasticities as well, like we just spoke of. And that's where you can get kind of diminishing marginal return, which just means that, like we spoke of as well, at the margin, you don't get the same value per unit, right? So like the first $100 you invest, or the first, let's say, $1 billion you invest in a business is going to be more valuable and get more output per dollar for the business than the next billion, and so on. And then the CES is kind of taken in part from the Cobb-Douglas, and that's largely the same, and I won't get into the specific differences right now. And then we have isoquants and we have isocosts. And remember, previously with indifference curves, what we did here is we fixed the utility. So we're indifferent to like different bundles of goods across an indifference curve. Well, here for isoquants and isocost, what we're doing is fixing then quantity, the quantity, right, as opposed to, or the cost as opposed to the utility. So in this case, right, the combinations of inputs that produce equal output. So we can spend a certain amount of, let's say, labor on the x-axis, capital on the y-axis, and you can imagine just like a downward sloping curve there, where at any point along that graph, we can, and instead of bundles of goods, we can allocate certain bundles of labor and capital to produce the same amount of a certain good. So there we go. Next up is profit maximization. This is similar to what we just touched on, but now we're trying to maximize profit because that is what firms do, as opposed to utility, because maximizing utility is what consumers do. So just notation here, right? Profit, you'll see it as pi a lot, but basically profit equals your total revenue minus your total cost. So P equals TR minus TC. And then your revenue is equivalent to Q, or the amount of units in a sense that you sell, multiplied by the price per unit, minus total cost, which is made up of your variable costs and your fixed costs. So variable costs could be, I don't know, having to pay a $3 shipping fee per product that you sell, and a fixed cost could be, you know, your monthly rent on your factory, which you have to pay whether you sell 100 units a month or 100,000 units a month. And then we have marginal revenue and marginal cost. So this is, like I said earlier, marginal revenue is the change in revenue from selling one more unit. And then marginal cost, same as the cost of producing one more unit. And so in competitive markets, and we'll talk about this a bit later, but let's say in a market theoretically where there are lots of different people producing it, and it's not a monopoly. We can just delineate it like that for now. It's just, there's not one firm that can set whatever price they want. There are lots of firms. And so what you have to do as a firm is to maximize your profits. You produce up to the point at which marginal revenue equals marginal cost. And if you produce past that, well, what happens? That means the cost to produce the next unit is more than the revenue. You're losing money. That's bad. You don't want to do that. So at any point below this as well, so let's say right here where the marginal cost of the unit is under the marginal revenue, well, now the marginal revenue is higher, so you're profitable, so you're going to keep producing, because if you made one more unit, you would make more money. So this basically just says the point at which you aren't making any more money from producing more units, well, that's when you're not going to produce, and therefore that is or produce any more, and that's the point at which you have maximized your profits. There's also kind of different timelines or time scales or time horizons, I guess is the word here. There's the short run, then there's the long run. The long run is like when everyone has made all their moves in like the chess game of economics, you're at this kind of like static state, this equilibrium of sorts. That's going to be what happens in the long run. In the short run,
you can have a market that's out of sync, right? Like one producer could come in and dump a bunch of goods in at a very low cost. And then the short run is just when that one thing happens, right? When that firm comes in and starts selling a whole bunch of units. Okay, and so now we have supply curves and market entry exit, and what that refers to is when firms decide to enter a given market. So let's say produce a certain good, or say they used to produce like Texas Instruments, the US firm, right? They used to produce calculators and then they decide to go and produce weapons. Well, why do they decide to enter that market? When do they decide to leave it? That's the whole business we're looking at here. And then you have demand curves, right, that we talked about previously. And supply curves are the other half of that equation. And the supply curve is just going to describe the quantity supplied at each price. So how many units firms choose to produce. And firms look at this through a few of the mechanisms that we've discussed prior. So we have marginal cost curves. So again, the cost incurred by producing one more unit. And then we have average variable cost. And I mentioned previously that cost is delineated into fixed costs and variable costs. So like your rent might be fixed, like it doesn't correlate with the amount of units that you produce, while your cost of raw goods is going to scale with the amount of units that you produce, because you need a certain amount of, let's say, metal in every unit you produce. And so average variable cost is just variable cost divided by the quantity produced or supplied. And then you just get, like, you know, if it's $800 to produce 10 unit, you produce 800, that's then $1 is the average variable cost. And so if we put these two curves on a graph, so we can see the marginal cost curve right here and the average total cost curve here, this isn't variable cost, there's going to be a point there, right? And then the average variable cost, if this is the average total cost curve, is just going to be under that, right? It's just going to be somewhere like right around there. And that point, that intersection between these curves tells us something. So in the short run, if the marginal cost curve is above the average variable cost curve, then that means, right, things are getting more expensive. The marginal cost is higher than the average variable cost. And you can see that the marginal cost kind of keeps going up here to the right, and then the average total cost is more of a U-shape. And you see a lot of U-shapes, you see a lot of inverted U-shapes as well. And so we have another relationship with not the average variable cost curve, but the average total cost curve. And then we have entry and exit conditions, and this relates to where the MC, the marginal cost curve, is in relation to these variable cost and total cost curves. So if price is above the average total cost, then you're going to enter a market because a firm thinks they can make profit. And if the price is below the average variable cost, then a firm is going to exit a market. And that basically just says if you're losing money, you're not going to produce. And if you think you can make money, you're going to produce. And this is kind of that, again, that rational look at firms where they're looking at all markets and all goods, and they're saying, where can we allocate our capital and our labor and our inputs to production to turn a profit? And in nearly every economic model, like over the long run, in a competitive equilibrium, so in a market with lots of firms that compete, no one is going to make economic profit. And that is different from what we may think of as profit. I won't get into that for now, but just keep in mind that firms in competitive markets do not turn a economic profit. So next we have market structures, and I touched on this previously, where there's different kinds of markets, and even right here where I said competitive equilibrium. So we have the economic model that you'll hear a lot about and study for the most part of perfect competition, where you have lots of firms that compete, and they compete with products that are the same, right? So let's say you have 10 different, I mentioned the Texas Instruments, the calculator company. You have, let's say, 10 firms producing calculators, and all of those calculators are the same product. There's not one better calculator and they all serve the same function, right? They do math well. And so in that sense, you would have, let's say not 10, but let's say theoretically 1,000 producers like that. You would have this model of perfect competition. And in this model, those firms just accept the price that the market gives to them. They don't have control. They can't go and start selling their product at a much higher price because, well, no one would buy it because it's the same as all the other products. So instead, they're price takers, not price makers, which we'll see price makers in a second. And in this kind of the equilibrium, or kind of the steady state where the market's going to get to in this model of perfect competition, the price is going to equal the marginal revenue, which is going to equal the marginal cost over the long run. And there's a lot of theory that goes into that I won't get into. Just keep that in mind. Price equals marginal cost equals marginal revenue in the long run. And what that basically says is resources are being allocated efficiently, and these firms are not turning an economic profit in the long run. Then we have oligopoly, which ties into how you're taught about, or it's kind of how game theory is introduced as well in most kind of academic curriculums. And an oligopoly is somewhere between a monopoly or a duopoly, where you have respectively one or two firms in a market, and perfect competition, in which you have many. And it's a market in which you have a few, like let's say 3, 5, whatever the number is, a few dominant firms that aren't just accepting the price that's like given to them by the market, or that the market sets. Instead, they have this strategic decision-making power. So you have two kind of big models there. You have Bertrand and you have Cournot. And then the difference between there largely is that in one, firms compete on price. In Bertrand, in the Cournot model, firms compete on quantity. And you also have two other versions of those models where the products are all the same in one version. That's kind of like the default. Or there is some difference in the products, and then you're competing on kind of the product side as well. And that's just called like the Bertrand model with differentiated products. So then we have the game theory side of it. I've made other videos on game theory. You can check them out. I find it really interesting personally. And to illustrate kind of some game theory concepts, we can just use the very classic prisoner's dilemma setup right here. And you've probably seen it before, but it is the classic one for a reason, so I'll just run through that pretty quickly. And in this case, you have two players. It could be two firms, two just any actors who can either cooperate or they can betray. And the classic setup for the prisoner's dilemma is you and you're in prison with someone else, like let's say from your gang, like you're a gang member that's in prison, and a police officer says, well, you can either cooperate with us, or excuse me, you can cooperate with your partner, with this other person from your gang that's in prison, or you can betray them and cooperate with the police. And if both of you betray, then you're both going to get you're going to spend more time in prison because you both just ratted each other out. If you both cooperate with each other and you don't rat each other out, well then neither of you you're going to get a lighter prison sentence essentially. And if one of you rats out the other and the other person stays silent, well then that person, the person who stayed silent, is going to get a lot of jail time, and the person who ratted the other out is going to get no jail time. And that's represented here with the different kind of the rewards here, right? You and these represent kind of utilities in a sense, like we talked about previously. And so what we can see in this little setup here is the amount of years that these guys are going to spend in prison. We have 1 year. Oh, excuse me, skip the slide there. We have 1 year, 3 years, 2 years, and obviously you don't want to spend any time in prison, so a lower number here is better. But what we can do is, by looking at this, is say that the actual equilibrium here is this lower right quadrant where both players betray each other. And that's because if you're in this position, then player A has no incentive to play cooperate instead of betray, because they'll get 3 years in prison instead of 2. And same thing with player B. They're getting 2 years in prison right now. If they went over to cooperate, they would get 3 years in prison. And that is what an equilibrium is. No player, no actor has an incentive to do something else, right? They're all playing kind of optimally or rationally. And so even though cooperate right here would get both of them less time in prison, because of the threats here, they put themselves in a worse position, and that is kind of how you play the game. And that's like the super basic kind of intro to equilibriums and to, dominant versus weak strategies, and to a lot of what you see applying in economics. And then it's really the math of this that then gets taken and then applied to oligopolies in these Cournot and Bertrand models, and also just collusion and cartels and that whole 9 yards as well. We also have monopoly. I'm not sure I included that here, but monopoly is just one firm that is a price maker in a market. So instead of accepting the market price, if you're a monopoly, you set the price. And this all ties into then welfare analysis. So you have consumer kind of surplus is kind of like the value that consumers get minus what they pay. Producer surplus is the value producers get after what producing something costs them. And then you have kind of what's called the dead weight loss, which is, in the case of, say, a monopoly, like how much worse the market is, how much worse people and producers are worse off because of one monopoly that controls the whole market. So then we have market failures. And I just mentioned like dead weight loss is a market failure. Market failures generally are just problems with kind of free markets and things that go wrong that result in what's called that welfare loss. And you have externalities first off. Externalities are not by default bad for all players involved. But externalities are things that you do which affect other firms, other people. So let's say you're a firm and you, classic example is like you have a factory that produces pollution. Well, that pollution is an externality for, say, the people living in the town. And it's an externality for you in that you're not factoring the cost of that pollution into your production function or what it costs for you to produce that good. And so you can actually, and there are models in which you then take that cost that is incurred by the externality or the social cost, and you merge it into the private cost to see the actual kind of cost there. And then you have other externalities, right, like education, R&D. In that, for example, if one firm researches something and there's an innovation, then the whole market can be better off because they can, let's say, all use that new production process. And that's why we have things like patents to protect IP and to encourage people to still invest in R&D, even though it's a positive externality for their competitors. And then we have some other market failures as well. We have public goods. Public goods, like a good example is just a public bus, where if you're a taxpayer, you're funding in part that bus, but there are people who may use the bus, and let's say it's a free bus, who aren't paying taxes on it, right? Like let's say they don't make any money, they're homeless, or they just, I don't know, they are evading the law and are not paying taxes. Well, they get the public good right there. And national defense is another one there. Same thing with common resources, and you have this thing called tragedy of the commons that I've mentioned in a previous video as well. Basic example there is just there are, let's say, a certain amount of fish on a lake, and people go in and they catch all the fish, and now no one has any fish, and that's bad. But the reason and the problem there is that, well, each player or each individual fisherman has an incentive to go and fish and to go get more fish for their family and to sell. But if everyone keeps doing that, given that they all have this individual incentive to keep fishing, then, well, you run out of fish, and now everyone is vastly worse off. So it's an incentive problem in a sense. You also have information asymmetry. That just means some information is private, and people and firms and people in firms interacting, right, don't all have the same information, and that can bring about failures in certain markets. Insurance is a good example there, right? Like if you lie about your medical or your health history to a health insurance provider, they may give you a lower rate. And well, why did that happen? And why does that inefficiency happen? Because of this information asymmetry. And there's a lot more there with moral hazard as well that I also talked about in a previous video. So now we're getting more into macroeconomics. I don't think I probably should have included the title slide, but for macroeconomics, we can start off with thinking about national income accounting, which is, and we're going from one firm, a few firms in a market and consumers, we're going into the whole country now, that whole market. And we're saying, well, how do we measure how much is produced in this national market? And you have a few models as well to determine on a national level how fast do things grow, and also why do they grow. Now, national income, you can just think of that as GDP, and that's basically how we all measure how much is produced on a national level. And there are three common approaches to calculate GDP. There's the expenditure approach, the income approach, and the value-added approach. They're all just slightly different and theoretically should get you to the same number. And then the equation that is used here is output. So it's normally denoted as Y. You can also think of it as just GDP. It's consumption, investment, government spending, and then some combination of exports and imports. Now, as far as like I said, the theories go for the growth of say, a whole nation state and their market, you have this growth model. It's a very common one that just says, and this is kind of like what we talked about previously with the Cobb-Douglas and the production functions, and this kind of is a production function in that sense. But we say that capital accumulation, labor force, so amount of people working, and technological progress. So these three things right here is going to determine over the long run this steady state, this equilibrium for the market in term when we think about the growth of that market. And that's how we can get to certain facets of this model. So like, well, what happens when on a national level the saving rates goes down? What happens when people or firms invest more, and so on? So there's a lot there. You normally hit that, I think, in like macro, not 102 or like the first course where you learn about it, but kind of that one second order, the higher level course. So then we have more aggregate models. We have the ISLM model and the ADAS model. I don't want to spend too much time on these, but basically they represent the goods market in terms of the ISLM model, and then the money market as well, with the LM curve representing liquidity preference. So basically, do people want cash versus other investments? And then the ADAS model also looks at that long run kind of national level of your output and what determines, growth. And that also proves stagflation. And there's also debt cycles and traps that you'll see in these models as well that do really play out in the real world. Okay, so we can use these aggregate models to look at kind of a few components then of macroeconomics. The first of those is going to be money and banking. And specifically, we have central banking and monetary policy, which are kind of two sides of the coin that the government uses to regulate money. All different governments around the world. So you have the central bank in the US, that's the Federal Reserve Bank, the federal bank, and then you have monetary policy. So that's things that the executive branch in the US can do to influence money and banking. And they have a few goals, right? The government, the central bank, they want price stability, they want financial stability, and then they want growth. So they want prices to, not grow at a very high pace. Otherwise, people get unhappy and people vote those people out of office to bring in other guys that hopefully can stabilize or decrease prices while maintaining growth. And it is usually a kind of trade-off there. Like if you have super high growth, then you're going to get often inflation. You're going to have just the systems will be out of whack, and typically the equilibrium or the steady state of an economy is growing by a few percent a year, but it's not crazy high growth. Like that's not where markets should be. And then they have a few tools that they can use to achieve this. They have open market operations where they're buying and they're selling bonds. They have reserve requirements where they dictate the amount of money that banks have to keep on hand, which then in turn impacts the price of loans that banks give out and how many loans. Then that impacts in turn the economy because really the ease by which money can be borrowed is kind of the big determinant of growth, or one of the big determinants of growth. And then you also have money creation in the banking system, where the government actually, creates money. And we run on a fractional reserve system. And what that means is banks that loan out money don't actually have to have all of the money, all the deposits that you put in their bank on hand. They can loan out most of that money. So if you see, if you deposit $1,000 in a bank and you see your $1,000 number there, they probably went out and loaned $990 of that, or $995. But because they have the little, the 5% of your money in the bank, and they have 5% of everyone's money that's deposited it, then if you want to pull all of your $1,000 out, which presumably isn't going to happen all the time, then they can go and pull everyone's money together to pay you back. And so, is that like a Ponzi scheme? Maybe, but it works, and it is effective in practice. And the amount of money, the reserve rate that I just mentioned, that the banks have to keep on hand, that is a tool that the government can use to regulate economic growth. And you have a few different measurements of how much money exists in the system. They're called just M1, M2, and M3. They all just look at and track slightly different things. And then you also have interest rates and credit markets. And interest rates are big, right? The rates on treasuries, the implicit kind of interest rate is a really, really big thing when you think about how growth works on the national level. And you see things like the yield curve, which you hear about if you listen to stock news or stock analysis or whatnot. And the interest rate is kind of like the risk-free rate of return on money. And that determines, going back to microeconomics, how you want to invest and allocate money. Because if you're a firm and you could be earning 6% in interest with a treasury bond, right? That's very different from a world in which you can only earn 2% interest. If you can make 6% doing nothing with your money, maybe you just want to stick money there and not go invest it to make 8% a year. Because then you take on all this risk, you put in all this effort just to make an extra 2% a year. However, if you only make 2% a year with your kind of risk-free rate of return of your interest rates, well, that's a very, very different situation. And now maybe you want to go and put the effort in to make potentially 8% on an investment. And so in that sense as well, typically if interest rates are really high, if your risk-free rate of return is very high, then you're going to invest less, and vice versa. And that's one of the tools that the central bank can use then to, again, just achieve these goals of price stability, financial stability, and economic growth. So then we have international economics, and this gets into not just one nation for macroeconomics, but multiple nations that interact. So we have international trade theory, which is, well, how do nations interact? And in a lot of ways, this comes down to first factor endowments. So like maybe there's more good land that's good for farming in one nation, and there's more water, which is good for, fishing in another nation. And those are kind of endowments on a national level, or things that are implicit to those nations that help them then with, producing and with trade on a national level. You have trade policies, which is a whole thing in of itself and very on the nose right now, right? Your tariffs, especially. And then you have exchange rates and currency markets. So not how goods interact among nations, but how money and currencies interact. And that's where you get a determination of exchange rates, or the interactions between different currencies. And you get a lot more here, especially, purchasing power parity is one type of evaluation of GDP. So if you Google like GDP of China, it'll say that their PPP is bigger if you value their currency in that way versus the other ways. And there's a whole world there as well. Then we get finally into economic policy, and this is what I briefly touched on back here, where we're saying, well, there's monetary policy, where the government wants to achieve their set of goals, typically stability and growth. And well, how can they do that on the executive side? So what can, say, the president do? And so what they can do is taxes, right? You know, if you lower taxes, everyone has more money, it's better for growth. But now, well, the government revenue went down. And it's always those trade-offs again. And the same thing with debt, with government spending. And something that you'll hear a lot is kind of the government spending multiplier, where if the government puts $100 million in stimulus into the economy, it's not actually worth $100 million to the economy. It might be worth $500 million or $1 billion, because they give out directly $100 million, but then that $100 million may be paid through services to other companies, and now you get $200 million in effects, and that creates new jobs and so on, and that kind of that trickles down. And then the degree, the volume by which it trickles down, whether that's a 5x or a 10x or a 20x, is that government spending multiplier. Then in terms of monetary policy objectives, right, typically you don't want extremely high inflation, and you have liquidity traps, which I mentioned earlier, and those are things like the debt spiral that you can get into when what's called the zero lower bound is crossed. And so you have quantitative and qualitative easing. That's another monetary policy tool kind of employed by the government. And you have things like, you have things like regulation and investment in human capital. Human capital just meaning the skill of your workers. So that wraps up micro and macro economics at a very high level, just to introduce you to all of these components. Okay, so next up, and for the final component here before electives, we have the world of econometrics. And this is personally my favorite beyond a lot of the theory that we see in micro and macro economics, because econometrics is more about just answering questions using data, and specifically about answering economic questions using data. And so it feels very actionable, very grounded in reality, and also very useful for me. And this starts in just statistics, right? Econometrics in a lot of ways is just an applied form of statistics to the world and the problems presented by economics. And so it starts with probability theory and then descriptive statistics. Probability theory meaning, well, we have random variables, we have sampling distributions, and then we have, our p-values, or just a lot of numbers, and a lot of models that are used in statistics that are applied then to econometrics that you'll need to know. Same thing with descriptive statistics. These are just kind of like the tools that you use to then go and do econometrics. So mean, median, mode, variance, and then also data visualization, which I'll talk about more in a few minutes, that you need. And then, like I just mentioned, with p-values, you have what's called hypothesis testing, and this is kind of the core, the heart of a lot of econometrics, where, and this is also though just statistics, just applied again to economic problems. Whereas if you test a hypothesis, you have what's called the null and the alternative hypothesis. It's kind of weird to wrap your head around a few of these things. The null hypothesis is like the chance that you're wrong, because the null of your hypothesis is like the opposite, or the hypothesis being incorrect. And so you're trying to disprove the fact that you're wrong, or disprove the null hypothesis, which is equivalent to just different terms really to proving that you're right. And you do that through p-values and significance levels. And in a lot of like what are called regressions, which I'll get to in a second, but in a lot of these tables, you'll see the significance, and then you'll see dot, and then some number, some fraction. And what you want, and what the most significant results are significant to the 1% level. And that basically means that you're 99% or more confident that the null hypothesis is wrong, which is to say, you're 99% confident that the fact that you are incorrect, which is to say you are 99% confident that you're not wrong, or basically that you're right. It's just, we call it the null hypothesis. And so by technicality, it's disproving the fact that you could be wrong. And then you also have the 5% and the 10% significant levels. And of course, lower number is better, right? You would rather be 99.9% chance that you are right versus 89.2% or 95.6%. And then you have t-tests, f-tests. You really are just, the core of this is going to be p-values and significance levels. And then you use that to run what are called regressions. And regressions is just a thing you can do with statistics. It's an approach to solving a problem that helps you look for patterns in that data and basically to analyze kind of the fit. And that's really useful in a lot of ways. And regressions really are how the whole world in econometrics and beyond as well solves a lot of very big problems and questions and explains a lot. Like most statistics that you see, like there's a 18% chance that something happens if something else happens. Those all come from regressions. And the standard regression model is right here. It's the y, so the dependent variable equals this beta 0 value, which is you can think of this as like y equals mx plus b, or this is going to be the y-intercept. Or if your independent variable is 0, then what is your intercept? So that's like the value. If on this line, if you were at 0 down here, where would you be on the y-axis? And then you have some coefficient multiplied by that independent variable, and then the error term as well. And so basically the unknowns here are these coefficients, right? The intercept and the coefficient on the dependent variable. And so what regression analysis does is it minimizes the sum of the squared residuals, which basically just means it figures out the numbers that work or predict the result the best. So in this case, the line of best fit, and the line right here, that equation is just literally this, right? It's just like, again, y equals mx plus b. You have mx right here, you have b right there, if you're familiar with just algebra, basically. So this so I would say this is like top 5 important thing all around. Like go watch some videos on regressions if you're interested, or if you want to get into this. And then this is a simple linear regression. We just have one coefficient. We have the intercept, the error term. In the multiple regressions model, right, we can have a whole lot. We can have control variables, dummy variables. So in this case, right, you just expand that same model, but the fundamental model is the same. We're just throwing more of these potential independent variables with coefficients in there, right? So we can generalize that to beta k, x, k. So that's regression analysis. You'll also need different kinds of models potentially, and you'll need to kind of adjust these base regression models or the data itself just to answer the question you're trying to answer better. So you can do, for example, you can throw in a quadratic element. So there's no exponents here. And if you want to test for a relationship that has inflection points, for example, like it's not just a downward, like a straight line like this. Let's say it goes up, it goes down, it goes up, it goes down. Well, then you can throw in your higher order exponents. You also need to, a lot of the time, take the log of certain variables and then use those. And there's just a whole world of other little changes, little things you can do to, again, the model and to the variables, so variable transformation as well. And then finally, all of this comes down, or what you feed into these models is data. And so, at least in my academic experience, we're taught using stata or stata, however you say it, to do a lot of the actual math of the regression for us and to manipulate our data. And then coding wise, Python is super useful to do all of this stuff in and really helpful across the board for econometrics. I prefer it, and I do a lot more work in Python than I do in R, but R is kind of a coding language that is designed specifically for statistics. And so that's also taught more on the master's level as opposed to undergraduate in my experience. But it is useful
for sure as well. In some ways, I'd say Python is still the more general skill that you want to know. And so when you feed that data into your regression models, you're going to have missing values, you're going to have outliers, and you're going to need to do a lot of work to this data. And that is one big part of the whole kind of econometrics process of I have a question, I'm building a model to answer the question, and then I have the data that I can use to feed into that model. And then finally, you also need to visualize that data effectively. And I think that is one kind of underappreciated part of econometrics, where if you want to share your results, sure, you can do it through a bunch of tables like this, but people respond in a lot of ways to, to your graphs, to your plots, to just clear ways of seeing the impact of your data. And so you can do a lot of that work in Python. Most chatbots today, to be honest, can probably do help you out with that if you're not familiar with the actual programming. But that is one core part after you have your results as well, of like, how do I format, how do I share this data? So there we go. That is econometrics. That was a super quick and dirty rundown, but that is generally, that touches on the whole process of econometrics. Okay, so now we're on to electives, and the first there is game theory that I want to discuss. Now, I made a full video, you can see that right here, about game theory and also mechanism design. I love it as a subject, I find it really interesting, and if you do want a kind of a deeper dive, you can check out that one. Generally, and we'll get a little bit deeper into it in just a second, but game theory is about strategy. It's about decision making, and there are two sides to that coin. Game theory essentially says we have a fixed game, and then we have people or actors in the game that can make decisions. And what kind of decisions are they going to make, and what kind of decisions should they optimally, rationally make? And when you think about that, that is a host of applications, right? Like nuclear proliferation is just the classic one, right? War, negotiation, politics, business, all of that is fundamentally in a lot of ways about optimal decision making given other actors, given decisions that can be made, and given kind of the outcome set, and given the outcomes that could happen and how likely you think each of those outcomes are. And then the opposite of game theory is mechanism design, where the behavior of individuals is fixed. Like, let's say an individual is fully rational, these are their risk preferences and so on, and then you design the game to get an optimal outcome. So in one case, in game theory, which is far more popular as a field, you want to get the optimal outcome. You want to maximize your utility as an actor in a game. And so you use math, ranges from mostly algebra, but all the way up through calculus. And you just have to figure out, what are people going to do? Now, game theory under the hood is it has two parts as far as the approach goes, I think. The first one there is just pure logic and thinking through things. And a lot of game theory makes sense, like most of it makes sense when you just think about it. It just can seem counterintuitive at first. But once it's explained to you, it's like, oh yeah, that makes sense. I just didn't view it in that angle. And that's what I really love about game theory. It's a kind of way of viewing the world. It's a perspective that may not draw direct parallels into all situations, because life isn't as simple as, a theoretical kind of example. But that perspective is extremely valuable because it forces this kind of rational lens on decision making and this process of thinking through problems. And then the other part to it is just math under the hood, so just a lot of equations. It gets up through calculus, and the math isn't that bad. I would say it's much more about the logic of it, but there is that component in terms of how you actually solve problems. So next is economics of information. This was a very high-level class that I took as a freshman, and I had no clue what I was doing. I really, really enjoyed the subject. Like, it expanded my perspective in a lot of ways, but it was a really difficult one as well. And that's because it's not game theory per se, but what it is a lot of kind of optimization problems. And there's a thing called a Lagrangian, like a Lagrangian multiplier that you use to solve either constrained or some kind of just optimization problem. You use this in a lot of places in economics once you get up to a certain level. And I didn't know any of this when I took the course, but basically you have a utility function, you have a budget constraint, and the utility function is just defines kind of the
The way in which someone gets utility just describes it's some function for the utility that an individual kind of gets. And then the budget constraint is, well, how much can they spend? How many resources do they have to go and get that utility, right? Like if I have $10 and I'm choosing between bananas and oranges, I could have a different utility function for each of those, and I'm going to allocate my budget constraint or my $10 depending on the kind of utility that I get from oranges versus apples. And then to solve that kind of problem with Lagrangian, you take first order conditions and then you do a whole bunch of derivatives and you get some kind of answer. So there was a lot of that in economics of information. More generally, what that refers to is especially, or really I think, how do you value information? How do you put a price tag and kind of really define information? Because when you think about it, information runs the world in a lot of ways. The way we act is a function of the information we have, the way the stock market works, politics, it all reflects information. So there's a whole field there that is abstract in a lot of ways, but can also seem, once you get into it, and in some applications, really practical. And it's also a very interesting perspective on the world that it imbues, just that field as a whole, where when you look at a decision, you look at it through, okay, these are the costs, this is the set of probabilities that I associate with some set of kind of states of worlds, they're called, or just outcomes. And so there could be 6 things that could happen. I'm going to weigh them with these probabilities. And then these are the costs, this is the utility I would get, and then you can do a lot of math there to figure out what you should do optimally. That, to me at least, is just really interesting subject and a really interesting way of approaching things. So I would recommend doing a little deep dive into that if you're interested. Okay, next up is antitrust law. And this is a really fascinating one, actually, and it concerns, I think, a very practical thing, which is how do government bodies, like let's say in the US or in another country around the world, how do they determine whether a company is large enough where the government should regulate it or break it up? That's the main question. There's other ones there about just more the legal side of it, like are they too large? Did they break the law? What laws are there to break? But the more economics side of it is just at what point and how do we calculate how large this company is and how much market power they have. And that's because in a truly competitive, like theoretically perfectly competitive market, firms are not going to turn a profit. But then you get beyond that. You get into monopolistic kind of competitive markets, you get into oligopolies and then actual monopolies. And in those market structures, firms can make a lot of money, and what they can do is raise their price above their marginal cost. And what that does is produce what's called deadweight loss, which just means the market is inefficient and consumers, the net benefit, the net yield for consumers and firms is lower. So across the board, you're losing out because firms have market and pricing power. And so in that field, in antitrust regulation, that whole 9 yards, you do a lot of calculations to figure out what kind of market power does a firm have, and are they raising their price over their marginal cost? And then you look at the average cost, average variable cost, just all of that stuff that you likely would have learned, or if you've dealt with micro before, you'll see a lot of kind of crossovers there. And that's another one I would recommend just because it's so useful and kind of applicable to a lot about just what you hear in the news and also a lot of the work you could potentially get into. Number 4 is political economy. My experience with this in terms of academics has had a lot of crossovers with econometrics, where what we would do is just read a large number of kind of research papers in the field. I personally don't like the more political side of political kind of economics. But it is a really interesting field, I think, in that it takes a lot of the economic lessons and approaches, and it applies that to the field of politics and behavior. And in that way, it is kind of this second order, much more practical application of a lot of what you learn. And especially just studies and research on the subject that takes real data and then tests all these economic hypotheses about politics. Really interesting, and I do recommend you keep up with that kind of work if it's a subject that you're interested in. Okay, so the last elective, the last sub-subject I want to touch on here is public finance. It's a big term that can refer to a lot of things, My experience with it academically has been a lot about tax incidents. So who and where does the actual kind of burden of a tax fall on? And then excess burden, so what's the net loss due to taxes of some sort? And also just what are called life cycle, kind of dynamic life cycle models, in that you can have models in economics that are static, which means it refers to kind of one period in time, some fixed set kind of functions, or you can have a dynamic model, and a dynamic model may incorporate multiple time periods. And specifically what I've done a lot of work with in public finance is kind of multi-generational, temporal, again, life cycle models, where you look at the whole kind of life cycle of a market, the world, just whatever that context may be. This one is definitely more abstract, or at least that side of it, but it is really applicable in terms of especially policy. So if you want to get into policy, that's something you're thinking about, then 100% go learn about public finance. So there you go, that's the video. I do hope you enjoyed, and I want this to be informative as well and actually useful to you. So make sure to leave any comments or just, shoot me an email if you're thinking about pursuing something like this. And if you're just curious, again, just drop a comment and we can discuss any kind of economic subject that you are interested in. And that said, again, make sure to go check out that exclusive promo code for Prop 365, and I'll see you in the next one. Cheers.
That said, y'all, that was the video. If I missed anything, if there's any questions you have, drop them in the comments, and I appreciate your time and you being here. As always, I'll see you in the next one.